Good morning, everyone. Welcome to the third and final day of the eighth Alternative Investment Summit. We'll be starting another couple of minutes once Karan joins in. Till then, please enjoy the auditorium. You can, of course, use the virtual platform to network with other participants as well. We'll be starting another couple of minutes, and then we have sessions back to back today. So I'll see you in just about a few minutes. So, all right. Till Karan logs in, let me quickly take you through the details of the summit as well as some history about what is the summit all about and what we are doing, why we are doing, and all that. So, as you all know, this is the eighth year of this Alternative Investment Summit. We started it in 2013 purely as an academic exercise. Then we were hearing a lot about alternative investments and AIFs, which were relatively new. SEBI had come up with a few diktats, and we were just about putting our heads around it. And we thought we need a conference on this subject to get all the thought leaders together and create some better clarity for one North. So the first ever conference was organized in November 2013, if I remember correctly, and we had a terrific response. And before we could realize, it became like an annual gathering for all the people from the asset and wealth management industry. And it was just our first ever initiative in the alternative investment space. The next year, we had participation from various regulatory bodies, and idea was mooted that since the IWMI is doing some work on alternative investments education, and then it was only one which was doing something. If a request was made, if the IWMI could take a step ahead and set up something like an industry association. So we were very happy to kind of follow on that, and that is when the entire foundation of the Indian Association of Alternative Investment Funds was set. Idea was to create an AMFI kind of a body for the AIFs, something which can represent the true voice of AIF ecosystem, as well as work on the investor education and advocacy initiatives. And that kind of really changed a lot of things for us, because with an association of almost 45 prominent members, it became all the more exciting. At the same time, there was a lot of responsibility to do a lot of interesting work, represent the cases correctly to the regulators and to the concerned government departments, and try our best in terms of bringing more awareness about the sector, as well as in helping regulators get the policies right. So for last 8 years, this is all one thing has led to other, and then we in between also designed a program on alternative investments for the wealth advisors, which was a very first of its kind program. To partnered with NISM, sorry, to launch it. And so since then, a number of different activities that we've been doing are all have kind of contributed towards our work to bring better clarity and better professional standards in alternative investment sector. And we've been duly acknowledged now by SEBI and other regulators and concerned authorities. And I would like to say this is just the start for us and the start for the alternative investment sector, because from 100 plus funds to almost 700 plus funds and billions of dollars of investments raised, I think we're just about scratching the surface. I think the actual action is yet to come. And in a post-COVID world, hey Karan, welcome.
Hi.
Are you able to hear me?
Yes, absolutely. Can you hear me?
Yeah. So I was just setting up the background for this event, and from 2013 when we started this as a first ever alternative investment conference in India to this year, which is the 8th edition. A lot of water has flown under the bridge, and in some way or other, how we have been working with all the stakeholders to bring more clarity and to enhance professional standards in the industry. So that's about it. So coming to the 8th event today, I think the participants have already been asked for the last 2 days. Unfortunately, due to COVID, we're not organizing it online, so virtual. It was important that we spread it out so that it doesn't get fatigue for the candidates, so for the participants. So this year, the entire event was designed in 3 days. The first 2 days were all about some very technical, deep diving master classes, which were conducted by some of the most prominent experts in the field. And today's day, the third and final day, is all about panel discussions by the industry thought leaders. We'll be covering more about the macro things which are going on in the AIF sector and how this sector can go ahead and contribute majorly to building a $5 trillion kind of an economy. I can't help but must thank all our IAAF members, and more importantly, presenting partner, IIFL Asset Management, for helping us put this up together. We are privileged to work with some other partners as well, like Edelweiss, Finolutions, Crystal, Vivin, and Dillian. And thanks to all of you guys, we've been able to put this summit together. I know the times are tough, but looking at the registration, the participants, and the questions, etc., for the last 2 days, I'm sure in tough times like this also, a gathering like this is going to help a lot of people, and I think that achieves the purpose for us. So talking about the day today, we are starting with an opening address by Karan now, and followed by that we'll have a first keynote panel discussion of the day. All the panels today are designed in a way to cover different perspectives from the CEO's side, or the fund manager side, or people from the legal and other service providers in this field. And we are hoping that all of you have an insightful day. End of the day, we are going to have a brief award felicitation ceremony for the top 140 awards for this year. So stay tuned. Don't go anywhere. That ceremony is going to be at 7 o'clock, and we need all of you to kind of be there to cheer our winners for the year. So on that note, I think I will now hand over this session to Karan, who honestly needs no introduction, and has been someone who's contributed majorly to the wealth and asset management industry in India. He's the founder, MD, and CEO of IIFL Wealth and Asset Management, and someone who has, in a true sense of reflection, of this entire ecosystem. Someone who's built a wealth business from scratch and today manage more than $30 billion of assets. Karan, welcome. And thanks again for joining in. Karan, you're not audible. You're on mute.
Thank you, Aditya. Thanks a lot. And thanks to the entire AIWM team to successfully keep organizing this conference and getting all of us together once in a year to be able to learn from each other much more and more. And I'm sure even though it's virtual, I'm sure the learning is not reduced. And, we will hopefully kind of keep learning from here. Thank you. So I'll kind of quickly start off and, I'll spend 10 minutes about what I think is really credible and a big opportunity for the entire alternative investment fund industry in itself. I think, if you go back and look at all developed countries, including especially the US, the biggest development of the alternate asset management industry really started when two big, or rather three things happened. Number one, interest rates reached new lows, and post-tax returns for high net worth individuals as well as institutions became substantially lower than what would work for them. In India, for the last 12 to 18 months, also, we've reached that situation. We see a lot of high net worth individuals, a lot of institutions, a lot of ultra and high net worth individuals who are no longer satisfied with getting 2.5%, 3%, 3.5% post-tax returns. And that's kind of forcefully, in some ways, getting them to look beyond. And that's extremely, extremely important and critical, and maybe serving as a catalyst to the growth of the alternate asset management industry. The second thing, which is extremely important, is regulation. So we've seen a lot of proactive regulation from SEBI, starting from 2013-14, from the evolution of the license, from a tax perspective as well as from a regulatory perspective. We'll never be perfect, but we've come a long way from 2014. And even the discussion paper on sophisticated investors, is going to help in a big way. And I think both Cat 1, Cat 2, Cat 3, especially Cat 2 and Cat 3, have seen phenomenal growth over the last 6 to 7 years. So from a regulatory perspective, also, we've seen large strides on the alternate asset management industry. And in some senses, it's kind of now today a fairly recognized force. What we've also seen, there's a massive maturity in the distribution ecosystem. I think if you just go back 6, 7, 8 years back, there was a lot of hesitancy in alternative investment funds. The documentation has become substantially simpler. The ability to deal with a single custodian with a single NAV, like is in the case of mutual funds, is extremely makes the process extremely easy. A single NAV makes things much more easier. Distributors today are much more open to the entire concept of an alternative investment fund than where they were 6 to 7 years back. We've definitely seen a lot of maturity with some of the larger distributors. There's a lot of excitement also with a lot of the independent financial advisors, especially those who are handling mid to large size clients. And over a period of time, I think alternates will kind of become a core part of everybody's portfolio. Having said that, obviously, it may not be more than 5 to 10% of one's portfolio, because by nature of the instrument itself is slightly illiquid. But having said that, it will definitely become a core part of everybody's portfolio. Lastly, we've seen the client ecosystem also mature substantially over the last 7 to 8 years. I think there was a patch in the middle, obviously when mid-caps were not doing well and some AIFs were mid-cap dominated, that there was a general feeling that AIFs don't serve any purpose. But what we've really seen, especially on the alternate side, which is essentially performing credit as well as unlisted equity and parts of listed equity, we've seen AIFs do extremely well. And most importantly, it's giving a chance to our local investors to become a part of the ecosystem and essentially participate in the growth journey of companies, which was something which was largely the domain of large foreign institutions. We've seen the advent. The other thing which has really led to the large growth of AIFs is all the multiple strategies which have kind of emerged over the last 5 to 6 years. We as a firm have been blessed to be able to take advantage some of these strategies. Other firms have also done extremely well. If I was to look today and see now 10 years back, I think there are multiple strategies across the listed side, unlisted funds, especially early stage private equity, then fund of funds, mid stage private equity funds, as well as late stage crossover funds. Within private equity itself, we've seen the emergence of 3 or 4 different categories. Within credit, we've got performing credit, which has emerged to be a big category. Obviously, it's not is not conducive for investors who want liquidity. But at the same point of time, it allows us to take exposure to performing credit without being worried about daily redemptions. Performing credit, structured credit, and in some very, very few cases, distressed credit have emerged as very, very relevant categories. We've also seen long short become a fairly large category. Hopefully, there will be some bit of more tax clarity within this segment. But overall, as a product, I think the ability to give close to 7.5, 8% with an extremely low drawdown is something which has emerged extremely well. So overall, I think the emergence of these 7 or 8 different strategies and the ability to attract domestic capital in each of these 7, 8 strategies is also going to provide a massive impetus for growth. The most important thing is, we've had some excellent talent within the country, and also talent which is coming from outside the country, having spent some time doing this outside. Is immensely valuable and allows us to be able to kind of take advantage and harness those talents to be able to kind of give a fillip to the industry. It's a big opportunity for all of us. We've only seen the large firms like Tiger Global, to a certain extent, Tiger Global and Sequoia obviously being the largest, followed by many others who have really been the largest recipients, and the LPs there have been the largest recipients of wealth creation through domestic Indian home-grade tech companies over the last 7 to 8 years. I think alternative investment funds in its own way provide a great opportunity through early stage and mid-stage private equity and even late-stage private equity into tech, combined with even ideas like venture debt, which essentially allow us to be able to take domestic investors as domestic LPs into funds. Domestic investors are now able to and open to contributing 3 years, 5 years, 7, 8 years, 9-year capital to be able to take advantage of these opportunities. And I think one of the biggest opportunities in India really continues to be on the consumer tech side, both in terms of process disruption as well as in terms of the size of the market. And honestly, our clients have not had the opportunity to participate in this over the last decade. And over the last 3 to 4 years, through the advent of the alternative investment funds, we are now able to raise fairly large funds where all these domestic investors are able to come in as domestic LPs and hopefully benefit from the larger growth in the ecosystem over the next 8 to 10 years. Obviously, within the larger ecosystem, there will be pluses, there will be minuses, there will be successes, and there will be failures. But having said that, given the fact that we are a country of entrepreneurs, I think the opportunities out there are extremely, extremely large. And, it allows us to kind of take part in an opportunity and be part of a change which we've really not been able to benefit out of. Having said that, obviously, it's very important for us as an industry and an alternative investment fund unit to not move ahead of ourselves very quickly. We still need to be very, very cognizant of the fact that the regulator expects us to be self-regulated. Pretty much like mutual funds started out a couple of decades ago. The angle of self-regulation over a period of many years really helped. It's associations and bodies like AIWM, IAIWM, as well as other institutions which are fairly active in this space, which will help shape the policy and interaction with the regulator to ensure that we don't get ahead of ourselves. The only risk we run is if we go ahead of ourselves, if we take clients for granted or we take the regulator for granted, then obviously we run the risk of a lot of the regulations getting tighter without the growth of the industry. So it's something which we need to be fairly careful about. CRISIL has taken a very good initiative of getting into benchmarking of alternative investment funds across categories. I think it's a good initiative as it goes, and maybe over the next 6 to 8 months, as it becomes extremely standardized, hopefully we will be able to have value research kind of reports like we have for mutual funds, even for AIFs. And hopefully at that point of time, both self-reliance on data and ability to kind of be 100% accurate in terms of performance and the ability of investors to be able to see performance and decipher performance clearly will emerge, and that too will facilitate the growth of the industry. So very critical for us to not lose this opportunity. All in all, it's an opportunity which is fairly large. Alternates have the ability to become a very large piece of the cake, and especially on the active mutual fund side, as ETFs and advisory regulations take over, you will see emergence of alternate asset classes as a very viable opportunity to outside of the core portfolio. I think the core portfolio for clients will become largely ETFs and fixed income instruments, which are liquid on a daily basis. And all of us as advisors and asset allocators, both on the manufacturing side, distribution side, and advisory side, will have the ability to kind of take part in this entire ecosystem. So I think overall, both on the listed equity side as well as on the fixed income side, it's a large opportunity. I think we also see an opportunity not only for large players like us, but we've actually seen the ability of a lot of independent fund managers, and I can, without getting into names, there are at least 10 on the equity side and maybe 5 or 6 on the fixed income side, where the managers are able to kind of very quickly get licenses over 6 to 12 months and be able to kind of launch their funds. And even if they launch small, they have the ability of showing consistent performance for 1, 2, 3, 4 years, and potentially kind of get into the big league. An opportunity which is not really available if you wanted to run a mutual fund. So it's not only a big opportunity available for large firms, but it's also a very viable opportunity available for managers who've kind of excelled on their own and are able to kind of build track records with maybe relatively smaller corpuses, but are able to scale up substantially later, depending on performance. So overall, if I look at the, just to sum up and kind of sign off, if I was to look at the entire ecosystem, and I would say the overall growth of the industry, the economy, and the size of the market is extremely large. That's on one side. The second is the investment management stroke the talent side. That's also extremely large, and something which a country like ours has enough access to. Third, obviously, is the multiple strategies and products, which again, as we've discussed, are multiple and are able to meet the needs of clients very efficiently. Fourth, both on the investing company side and the universe of where we can invest. We've seen India being a great creator of wealth creation, not only on the listed side, but even on the unlisted side, and also some very interesting opportunities on the credit side. I think on the investing strategy side, all of these three things together with the long short piece gives us huge amount of variety and the ability to add value to a client's portfolio. And lastly, we've got a regulator who's kind of supporting this entire growth of the alternate industry. So if I was to kind of sum it up, all the 5 specters put together point towards an opportunity which is going to be extremely large over the next decade. And I think alternates as a business, like it's been across the world, with some hiccups up and down, if you do it intelligently and as they say, do everything which is logical and not something which is illogical, I think the industry's got a long way to go. And all in all, it's an opportunity for us to lose. The size of the industry is going to grow for sure, and all of us have a big opportunity to be a big part of that ecosystem, whether we are big or we are small. And hopefully all of us can play a meaningful role as we go along for the next 5 to 10 years. So thanks for inviting me, and thanks Aditya for hosting this for the last 8 years and being able to get a large number of participants of the ecosystem together. Thank you.
Thank you so much, Karan. So if we have another few minutes to go and get into the next panel, would you like to take a few questions?
Absolutely.
So participants, if you have any questions for Karan, please use the Ask a Question tab on your screen. So till we wait for the questions from the audience, Karan, any suggestions from the for the independent wealth management community in terms of how do they build up the advising skills, alternative investment advising skills?
So I personally feel it's something which requires a little bit of time, effort, and dedication. So it's a great place to start would be what to see all the products over the last 6 to 7 years, and maybe see all the fact sheets, see the products which have matured, see the things which have gone right, see the things which have gone wrong, and possibly use that as a backstop. Because at the end of the day, I think nothing sells as much as conviction. And I think it's extremely important for all of us to be convinced that while doing an alternate, we are compromising something. We are compromising liquidity, but at the same point of time, we are able to add an extra value to the client's portfolio. And it's only then we'll be able to kind of look at this with an independent, objective mind. And so it's got a balance. It's got a balance of maybe consistent returns for the right risk appetite, but at the same point it has to be balanced with liquidity. So I think that's and a great way to do it today. I think you would have at least 40, 50, 60 schemes which have spent over 3 to 4 5 years in the ecosystem. I'm not saying just invest in those 40, 50, but the ability to look at those 40, 50 and convince yourself about the strengths, weaknesses, opportunities it was able to capture, and the mistakes these schemes made might be a great starting point for people to kind of understand this.
Hello.
Yeah, hi. Can you hear me?
Yeah, now I can. So where do you see cryptocurrencies going ahead?
So honestly, I'm not an expert on cryptocurrencies. I've been a bit of a non-believer, and obviously I've been proved wrong. So I didn't understand Bitcoins when it was 18,000, didn't understand it when it was 8,000, still not understanding it, but I'm guilty of not having spent enough time to understand it. So unfortunately, us as a firm, we've not kind of spent enough time and energy to be able to kind of get into it. It's something which we'll definitely invest some energy, time, and intellect over the next 6 to 12 months. But to a certain extent, markets are always right. So I don't want to dismiss it, but at the same point of time, we've not kind of had the opportunity to study it.
Sure. So I'll just take this as the last question for you, Karan. Do you see a scope for bringing down the minimum investment limit of 1 crore in AIFs? Do you see a case there?
So I think it's definitely an instrument which is for a sophisticated investor. Now, whether the investment should be at a scheme level of a minimum of 1 crore, or it should be defined like it is globally at as suitable only for investors who have certain qualifications of net worth and investment experience, is something which is, I think, a little bit more debatable. I think fortunately the regulator is looking at the second portion, where depending on the net worth and the investment qualification of the investor, I think if that is a tick box, then we can push to kind of get the amount down lower. So I think that might be a good approach, and that's really hopefully something which may come out of us being able to recognize sophisticated investors as a separate investor class. So I'm hoping this is a discussion which can kind of come through post the recognition of sophisticated investors.
Sure. So thank you so much, Karan. On that note, I think we'll have to move on to the next panel. Thank you for your time.
Thank you. Thank you.
Maybe hopefully next time a longer session with you.
Thank you.
So moving on to our next panel quickly. I believe all of our speakers are already here. May I request all of you to please put on your audios.
Hello.
Yeah. Hello. Yeah. Hi. Morning, Shrija.
Yeah. Hi, Aditya.
Hi, Manoj.
Hey
Welcome.
Aditya, and hello Shrija,
Hi, Anjali.
and morning
Hi.
everyone.
Hi,
Hi,
Shrija.
Anju.
Hello.
Uh,
Hi, Sunil.
we
Hi, Anju.
have
Good morning.
okay. Sunil also here. Do we
It's
have
great
Andrew?
to hear Karan to have been on for some time. So, yeah.
Okay, super. So I think everyone is here. So audience, jumping into the power-packed first keynote session of the day with a very heavy-duty panel. We have Shrija Agarwal, who's the executive editor of Hindustan's Digital, moderating the session, and our panelists include Anjali Bansal, founder of Havana Capital, Manoj Shenoy, CEO of IFL Asset Management, Andrew Holland, CEO of Avendus Capital Public Markets Alternate Strategies, and none other than Sunil Singhania, founder of Abacus Asset Management. So can't really be between you and the audience. So Shrija, over to you.
Thank you, Aditya, and it's my sheer pleasure and privilege to be here with this August panel here today. First of all, I'd just like to sort of check, am I audible properly to everybody?
Yes.
Yes,
Okay.
you're audible.
Yes.
Thank you. Hello and a very warm welcome to everybody. I am Shrija Agarwal and you are watching the 8th edition of the annual India Alternative Investment Summit. I would like to thank the organizers, AIWM and Aditya, for putting this together. We have a pretty meaningful panel today, but before that, let's do some context setting. The topic for today's discussion is a pretty straightforward one. The role of AIFs in making India a $5 trillion economy. When we are talking about growing India's economy to a $5 trillion economy, what really are we talking about? We are talking about financing countries' huge infrastructure requirement, which stand at $1.5 trillion today. We are talking about long-term annuity-seeking investments here. When we're talking about growing India's economy to a $5 trillion economy, we're talking about long-term investments in building up the MSME sector, where startups and early-stage businesses contribute to jobs and value creation. When we're talking about India's economy to a $5 trillion economy, we're talking about developing the entrepreneurial ecosystem in the country. And when we're talking about growing India's economy to a $5 trillion economy, we're talking about massive capital infusion across several segments: healthcare, infrastructure, affordable housing, manufacturing, logistics, IT, financial inclusion, banking, financial services, insurance, consumer product services, education, etc. All of this means that it is locked in sophisticated capital and it cannot be met by hot money, which is subject to the vagaries of FIIs, institutional investors, and stock markets. Given there are various constraints faced by the traditional lending ecosystem in the last decade, the role of alternative capital in supporting India's economic growth aspirations and reducing the strain on government finances has been immense. Just to give you some data and some pointers here, Indian market received an all-time record of $48 billion of private investment in 2019 and roughly a similar amount in 2020. Aggregate private capital investment in 2009-20 period reached $250 billion. Alternative investment funds, an innovative product which mobilizes investments in real estate, private equity, land, venture capital, intellectual property, and equity long-short strategies are all alternative investments, have really been at the heart of it. The AIF industry in India has been evolving at a rapid pace and invested over 1.8 lakh crore across ventures at the December 31, 2020. India being a high-performance market with a stable GDP will see a quantum increase in capital flow into the capital markets, and AIFs are no exception. Alternative investments have grown rapidly in the past 3 years on account of proactive regulatory reforms such as foreign investments in AIFs and the automatic route, tax pass-through structure implemented for category 1 and 2 funds, and permission to invest in commodity derivatives, etc. In my next 45 minutes that I have with this August panel, my endeavor here will be to really understand what role have AIFs played in mobilizing India's economy to a $5 trillion economy when we start by the year 2025. This is the inaugural session. Please help me welcome Andrew Holland, CEO of Avendus Capital Public Market Strategies, Manoj Shenoy, Chief Executive Officer, IFL Asset Management, Anjali Bansal, Founder, Havana Capital, Sunil Singhania, Founder, Abacus Asset Manager. Gentlemen and ladies, it's my sheer pleasure and privilege to welcome you all to this. Let me just begin with you, Andrew, in no particular order, just going alphabetically. On this entire moot point of AIFs really being the next cutting edge option for foreign investors. I think the government's intention is pretty clear, whether in the form of AIFs or the GIFT City or relaxation, the tax laws, and allowing fund managers to operate from India. I mean, the intent is pretty clear, is to create an ecosystem and in some sense replicate or move some of the fund management activities from Hong Kong, Singapore, and other jurisdictions. And AIF is a wonderful product to do that. Can one really say that when you talk about investments and foreign investments in India, perhaps AIF is the future in many ways? What really is your argument in this direction?
I think a lot of the initiatives by the government have been, very encouraging. I mean, GIFT City, which you mentioned, does allow funds like ourselves and others to set up shop there. If you go offshore, basically there's a few ways to do that. One is, to have someone based offshore, and obviously all your management fees go there. You can try and use 9A, which obviously you can have your, you can have your managers sat in India, but you still have to have an offshore structure. So GIFT City brings everything together in one go. So that's the good news. Now, as a jurisdiction, obviously it's going to be new to investors. So I think it'll take a little bit of time for people to adjust to this, and investors to feel comfortable coming to India as an alternative to, say, Singapore or Ireland or Luxembourg or those places. But I think once a number of funds start up and investors can see it's actually very successful, which we expect it will be, because all the tax rules are exactly the same as if you were offshore. So there's nothing there for the foreign investor to worry about. I just think it's that bedding in process which takes a little bit of time. But I suspect that you'll see quite a number of funds over the next 1 month launch from GIFT City, which will start that ball rolling about bringing confidence to GIFT City, and therefore the regulations that have been put in place around it. So I'm very encouraged by that, and I think it will lead to a lot of funds. Particularly one of the problems I think in India for long short funds is two facts. One, we've been a long only kind of regime anyway in terms of the mutual fund industry. So we've really just started to build the capability, and therefore, trying to build a track record and then go offshore with the kind of high costs that it is to set up offshore. GIFT City really kind of helps a lot of fund managers going forward, to kind of raise money offshore as well.
I would like to bring you in, Sunil, here. We just heard from Andrew, and he sort of mentioned that, the entire GIFT City move will bring confidence to investors and perhaps is a huge measure to boost the economy here. This entire argument that we're talking really about, that AIFs really to be labeled as a future for sophisticated investing, do you really think that the future in many ways can be labeled to AIFs and that really has arrived? What really is the sense that you can give us?
Thanks a lot for giving me this opportunity and sharing my views. So I think, AIF obviously has added to the options available to the investors. It brings in a lot of flexibility. It also allows, portfolio managers like myself to branch out on their own. SEBI also recognizes that AIF is light touch, catered to sophisticated and large mature investors. And I think it definitely adds in a lot of options. At the same time, for any country and economy and the financial market, I think all segments of the financial markets are important. So I would say mutual funds, AIFs, private equity, venture funds, they will all go together in ensuring that we are able to attract the capital which the country needs to grow rapidly in its quest to maybe have a sustainable 7.5–8% GDP. GIFT City is also a step in that direction to ease, managing offshore money by domestic in portfolio managers like ourselves. It's early days, but we have seen in other parts of the world, ultimately these kind of initiatives and specific zones are becoming very successful. There is no reason to believe that in India we will not have that. So, within obviously I represent an AIF company, so my bias will be towards the AIF. But I would say that if you just mentioned all the numbers and one like 80,000 crores and all, I think in the last 5-6 years where AIFs have been operational, this is a huge amount of capital which they've been able to attract. And there is no doubt in our, at least our minds, that this corpus is going to double in the next 3 years. So that would be a big achievement, given the fact that mutual funds took almost 20 years to reach that kind of size, and then they took off. So it's a good sort of a beginning, and I would say that AIFs have played a vital role, and they will continue to play an even important role as we move forward.
Thank you, Sunil, for that. I come to you now, Manoj. Manoj, you heard both your co-participants, Andrew and Sunil. I think huge optimism coming in the way of AIF here. And just to take a segue from what Sunil just mentioned, that mutual funds perhaps took 20 years to reach where AIFs have reached in a very short span of time. So one can really see the momentum and the optimism. I mean, the way you grew IIFL, Taran was here prior to you, raised funding from investors like GA, and what the kind of franchise that you all have grown. So you have seen the life cycle coming from mutual fund to investing in all across asset classes to now AIF. Manoj, if I were to ask you a question, and Sunil pointed that out, that he's an independent asset manager. If somebody were to branch out as an independent manager in 2021, wouldn't the natural recourse be to set up an AIF rather than going for a mutual fund? What really is your sense? I would like an honest answer here.
Okay, thank you very much for having me here. And also I would like to wish Sunil a very happy birthday. I heard it's his birthday today.
Thanks a lot.
Sunil, yeah. So, okay, let me step back a little bit. I think we need to look at, see, when we talk about AIF and how it is going to grow, obviously, Sunil said it's going to double and, next 3 years and stuff like that. And I think we are actually underballing the opportunity, number one. Second, I think the second thing what we need to look at is how AIFs operate globally and what is the share of AIFs as a percentage of the managed market funds. So if you take a US example, it is the AIF market is around $11 trillion. It is we are not even scratching the bottom of anything. We are just about $27 billion today. And even if you take Europe, it is close to about, these are last year's figures, these are about $7 trillion again. So if you take as a composition of the managed markets in both these jurisdictions, whether it is US or even in Europe, it is in excess of about 30-35% compared to mutual funds. Mutual funds are about 65% in US and it's 60% in Europe. So that itself, according to me, gives us a big picture in terms of how AIFs can grow in India. And to a large extent, I also agree in terms of whether, fund managers like Sunil moving on and then setting up their own alternates. Yes. See, today, I think, if you want a normal investment, structure, the mutual funds are already there. And it is, anyway, it is growing. It will grow because it's a retail. It's meant for retail. And also, the kind of retail participation is growing. That will certainly grow in any way. But the kind of wealth that is being created today, compared to what it was 10 years back or 15 years back, 20 years back, a whole lot of wealth is being created because of ESOPs, because of people selling out companies and, all those kind of stuff. Now, this set of people are keen and interested in taking a slightly higher risk and a investment stuff where they can customize to their risk appetite and how they want to grow their assets and stuff like that. So given that, my feeling is that a whole lot of the new strategies, if new fund managers bring on the table, there is no reason why these AMCs can do extremely well just doing the AIF and not having a mutual fund. But the mutual fund will certainly continue to be the main stable, because that's a way to channelize actually the retail money, and this will be for sophisticated and professional investors.
Thanks for that, Manoj. I would sort of come to you, Anjali, before sort of coming to you and talking about really the entrepreneurial ecosystem and what role it has really played for the AIF. I want to sort of bring in you, Andrew, and Sunil again to sort of just the point which Manoj just mentioned right now, that while the mutual fund industry will continue to grow, he does not really see a problem with independent asset managers really going through the AIF route. As somebody who has covered the private markets for more than a decade right now, I have really seen this actually happening in the private equity space also. First came the international PE funds, the Blackstones, the Carlyles, the GAs, and then we actually saw a lot of high-profile fund managers transitioning out of these international PVC firms and setting up their own shops. Some of them have actually become pretty large established shops right now. Also, look at the likes of Chris Capital or a Kidara or a True North or a Multiples Equity Partners. So, Andrew, my question to you really is that what remains the future of the mutual fund industry then? Will it be a vehicle, the mainstream vehicle, again going forward to mobilize the retail participation, the number one vehicle? And will AIFs constitute a space for a more sophisticated or a more sort of polished HNI audiences? What really is your sense there? Will we see complete demarcation going forward in the financial services stroke asset management industry?
I mean, some of that will depend obviously on regulation, as you're probably all aware that any investment in an alternative investment fund in India, whether it's category 1, 2, or 3, there's a minimum investment of 1 crore. So that does take away a lot of the kind of investors, retail investors to that. And I think SEBI are wanting to make sure that, and quite rightly so, that the investors coming into the types of products which are sophisticated, either have the wealth or the knowledge to be able to kind of understand the risks that are involved. And I think that's a key element. But let me put it this way: I have investments in mutual funds, debt equity, and I have alternative assets. I don't think that's going to change overnight. I mean, the product might change. People might go for more ETFs and active management, which we're seeing globally. But I think we'll all do our savings on a regular basis through mutual funds, because the threshold to 1 crore is quite high for people starting off on the ladder of investing. So you're not going to put that much into a fund straight away. So I think the SIPs are always going to be through retail and through mutual funds. So it's an industry that's not going to go away. It's going to continue to grow very rapidly. Over the next 10 to 15 years, that's for sure, with many new products coming in. But the alternatives is what it is, right? You put a certain amount of your asset allocation towards alternative assets. Now, it can be private equity, it can be real estate, it can be art, it can be wine, it can be anything it wants to be in that. And obviously, the alternative investments that we're talking about do form overseas anywhere up to 20% of people's asset allocation outside of their mutual funds. So that's really how I don't see that it's us versus them. I think there's enough for our industry to grow multifold if you're going to be a $5 trillion economy, and it has to do that. So I think the outlook for both mutual funds and alternatives is very high.
Okay. Anjali, I would like to bring you in. I think you heard from all your co-participants, Sunil, Manoj, and Andrew here on, what really is the future growth path for AIF industry. We also spoke a bit about, how does it compare vis-a-vis the mutual fund industry. And the big takeaway one is really getting is that one is not eating into another, given the fact that even the AIF has really seen a rapid growth. And while the mutual fund industry took about 20 years to reach where AIF has grown in the past, like 7 to 8 years. Anjali, I would like to bring you in here. I mean, you bring a very interesting perspective to the table, coming from, a very active VC background, really. And I want to sort of, ask you, Anjali, that, when you talk about AIFs, or you see the investor participation into AIFs, what really is the role they're really playing in propping up the entrepreneurial ecosystem? I ask you this also just given the amount of capital available on the sidelines right now. Do you think that just the amount of dry powder that we are seeing in private equity, venture capital, combine that with talent pool of managers like yours, can surely assist in economic recovery of India, and AIF can play a huge role here?
Thank you, Shrija. It's a big question. I do want to add, I also sit on the board of a very large public market asset management company. So I don't think mutual funds are going away anywhere, and they should not. That industry will continue to grow. It will continue to see fund inflows. That industry will also have to innovate. Just as AIFs are an innovation in the private space, the public space will have to innovate with new products, maybe more technology-enabled sachetized products and so on. We are seeing the emergence of players like a Zerodha and a Grow and so on. So there is innovation and disruption happening in that space as well. ETFs, clearly, sort of whether it's actively managed, passively managed, crypto, all of these are new products and asset classes that will emerge. On the AIF side, to me, AIFs actually are a very, very positive development in India. The right policy framework, lots of enabling regulation, and continuing engagement between the regulator, so SEBI, the government, so Ministry of Finance, and industry. So this continuous dialogue, I think, will continue to provide the innovation required also, and the continuing evolution of the AIF regime itself. So Gift City, IFSC, the enabling tax regulations there allows us to onshore what used to be previously offshore. It brings a lot of benefits here, which have been talked about, so I will not go into detail. The biggest advantage, and I think the raison d'etre almost for AIFs, is to allow domestic capital to participate in some of the highest return categories, which is why it is fair that AIF participation be somewhat focused and limited to sophisticated investors. Typically, private investing is long-term illiquid asset class. And yes, of course, we are seeing the emergence of lots of unicorns, but remember, they are not overnight. It takes anywhere between sort of 3 to 10 years to build a really big company out of a startup. But the pace, the energy, the variety, and the excitement of the startup ecosystem should be accessible to Indian investors as well. And not just HNIs and individuals. And I think we are now starting to see some signs and the right policy support for the participation of our large domestic institutions as well. So globally, if you look at alternative assets, the limited partners or investors in those funds tend to be pension funds, endowments, foundations, and so on. In India, this space has not seen the participation of, say, our large insurers. So, the LICs, GICs, EPFO, and so on. So opening this up, I think, will add more capital. It is the AIF regime makes it easier for also entrepreneurship to emerge in the fund management space. You no longer have to think about setting up overseas and they're doing a sort of nudge, wink, wink as to where is your poem and so on. It gives you a very straightforward way to invest in the Indian startup ecosystem, which is where I typically participate, and capture the returns from some of the startup outcomes that we are seeing now.
Mm-hmm. So I want to sort of bring you in, Sunil, to sort of what Anjali just mentioned. I think if there are two words that I've heard the maximum in the entire pandemic phase is this digital transformation. And, rightly so, if you speak to VCs, it really has been a tale of two cities. While some boats are low, some boats are really high. We are seeing unprecedented amount of deal making in the private investment space. I'm talking about startups from Series A to Series B to Series C to Series D. And at the point which Anjali mentioned that, AIFs really have a great gateway in them. It provides domestic investors to also partake some of the upside of investing into startups. So do you think that, in that way, just in terms of product innovation, which AIF brings to the table, you think the other capital market instruments like mutual funds also need to really innovate in that regard? the product assortment for AIF just becomes so much higher and deeper compared to other products that we have right now.
See, we have to understand the whole ecosystem. I've also been in the mutual fund for a long, long time. Most part of my professional life I've spent in the mutual fund industry, and I've seen it grow exponentially right from 2002-03 when I joined, right till 2018 when I left the mutual fund industry to start up my AIF. So mutual fund industry predominantly cater to the retail segment. And obviously it's a high regulation, industry, because obviously the regulators are very concerned about the retail investors. When you talk about startups or PE and venture funds, we all like to glorify companies which have become unicorns and which have become 10 billion and 20 billion and 50 billion. But for every one unicorn, there are 100,000 startups which have gone to zero. We don't even talk about it. You don't want a scenario where you offer some exotic products to retail investors who don't understand it. And I think that is the reason why the regulator also is very clear that these are the instruments and these are the investment opportunities which are suitable for so-called accredited investors. The term is prevalent in global markets. It is now slowly being introduced in India also. And there are some investment opportunities which are simple and which are suitable for the retail. So I think that is one thing. The other thing is because of their very nature, and you have like 7 million, 8 million, 10 million investors for mutual fund, they would want to first try and increase the penetration of that segment itself. I think even on the retail side, and I think Andrew pointed out, which was very relevant, that in India, the whole ecosystem has huge potential to grow. We don't even have 4 or 5 crore unique investors. I think that number itself can grow 5-10 times. So the mutual funds are doing the right thing by increasing their penetration and into going into different cities, towns. The regulator is encouraging them by giving incentives for beyond 15 cities and beyond 30 cities. So let the mutual funds concentrate on that. The high net worth individuals, family offices are people who are sort of in inverted commas, knowing what they're doing. They can take some high risks. So whether it is venture funds or AIF 1, 2, 3 or some other instruments, let them cater to this large family offices. As far as the insurance companies and all are concerned, I think recently the regulator has started to allow them to invest in AIFs, which is a welcome decision. And hopefully, as and when they start to get comfort, that flow will only increase. The last bit I would like to add is that in India, the startup culture and venture investing and high risk investing is new, and the regulations are also not very conducive for any company to raise capital in India. So if you actually see, most of the very successful unicorns in India have structures which are investable by overseas investors by being outside of India. And I think that also will gradually change. So we have a long way to go, but we have come much ahead of where we were in the last 4 or 5 years. And, we have to have patience and we have to be optimistic. I think there will be many, many opportunities across this ecosystem. That is what I can say. You just have to remember one thing.
I can see Anjali smiling to your point where you mentioned that a lot of unicorns are foreign funded. I think that is actually a pity that we are not using local rupee capital to have more homegrown unicorns, just given the kind of local technology pool and talent that we're sitting on. We don't really need a SoftBank and a Tiger Global to come and tell us which is the next unicorn. We should have more AIFs, more insurance companies, more local banks, financial institutions, and HNIs to come and spot those unicorns. And I think,
if I may, I would, it's not either or. We need them all. India needs a lot of capital to really meet our full potential and get to the $5 trillion economy and so on. So I think all capital, if it's the right kind of capital with the right intent, is welcome. So whether it is SoftBank, Tiger, they actually provide that late stage, large check capital that gives that big scaling up boost to a lot of companies. So that is also required, but this is also required. So as India goes through the journey really of financializing of savings, then a lot of those savings at the retail level will move into mutual funds, the SIPs and so on. That's where they should be, instead of sitting sort of idly in bank deposits necessarily. At the same time, for those who are sophisticated, understand the risk, where not every startup becomes a unicorn, right? Very few actually do. And there is value creation, even if it is not a unicorn. So to be able to participate for domestic investors, and absolutely, when whoever participates in the capital of a successful business is who benefits from it, right? You get the returns. So for us to capture the returns in India, the financial returns coming to India in the pockets of both individual and institutional investors is where I think AIF plays a very positive and important role.
Yeah, so I think 2 or 3 key sort of takeaways are becoming very clear here in terms of the investor class bifurcation between the mutual fund industry and the AIF. It's not really one versus the other. And I think the risk profile for both the asset classes are becoming increasingly defined. I want to sort of bring you, Andrew, in here. And, this entire question of, one not sort of eating versus the other, there's a large market and all of us can coexist. So what about this entire disruption factor that one talks about? I think there was a mention of the likes of Zerodha and Upstocks and Grow coming onto the fore. How does the way fintech really came a big part of the lexicon, with neo-banking and open banking really being seen as threat to the large banking industry? And perhaps I would not use the word threat, but perhaps coexisting, where banks are clearly embracing the value of technology that brings to the table. How are big asset managers really seeing the likes of Zerodha or the Upstocks or the Grow coming in to the fore, especially when they're so hugely funded?
I think it still has some way to go. I mean, I think from the mutual fund industry, as we've seen in developed markets, is that ETF, smart beta, ESG, all of these are going to be products which are going to be off the shelf, low cost. Now it depends on which of the mutual funds want to kind of eat into their own products very quickly. So I'm not an expert on that. Maybe Sunil will have a better idea in terms of the mutual fund industry. But that would be disruption, right? Disruption in terms of ETF, smart beta, and those kind of products, which are will have a very, very small cost to invest, and you're just replicating or beating the index, which everyone is finding hard to do at the moment. So that's obviously technology will play a role in that. Not just for managing the product, but for distribution as well. Maybe the old kind of go through distributors and investment managers might just change because of these products. In terms of my world, quants I think is starting to rise in terms of hedge funds and people's acceptance of quants. And then of course AI will, artificial intelligence at some point will, I'm sure, come to India's shores. But I think we're some way away from all of these at the moment. Where investors, I think, will probably latch on to more of the lower cost type ETF product quicker than maybe a more sophisticated quants model or AI type of model on the Cat3 type of investors. So that will take a bit more time, in my view.
Okay, Manoj, I wanted to sort of like to bring you in that why is that every conversation about AIFs is usually marred with this mumbo jumbo around taxation? We saw some clearance on category 1, category 2, but why is this that category 3 funds, wherever that question brings in, it always is laced with this entire taxation issue? That is number one. And why is it that AIF are always being construed as something just complicated? First understand the risks better and then jump into it, as compared to a mutual fund where this is entire machinery by the government which tells you mutual fund sahi hai. It's more retail, it's more appealing. Why don't we see a similar level playing field, or would you say a more perhaps a more level playing investor education, if you will, around AIF? What does it come in the first blush being something which is, okay, complicated, I would get there later?
Okay, so this is one is we need to understand that alternate industry itself is just about evolving in the last 5 years. It all started in 2012, last 5 years. So it looks a little complicated for a layman when you take a product which is differentiated, number one. I think as Anjali said, these are highly illiquid investments in some case. In some case, what Andrew does, he was the pioneer in getting the long short in the country way back in 2013. People didn't understand what it was, but then within the next 2-3 years, people understood that, okay, it's actually a hedge fund, and then you get a debt plus kind of a return. What you can expect from there, and what you can expect from a venture fund, and what you can expect from a. So I think it's an evolving story. So I don't think we can rush into getting people to understand things and stuff like that quickly. I think to a large extent, I believe what will change all this, including the taxation and the understanding of all this, is just like how it works globally. What is called as a professional investor. So we are today in India, the regulator is already started a discussion paper on how to classify a professional or a qualified investor. So once that category is identified, and a person is identified as a professional or a qualified investor, then the investment, it's understood that this person is qualified to understand what is given to him, and including illiquid stuff, long the gestation in terms of 3 years, 5 years, 8 years, kind of a stuff. All these misgivings will go away. So today it should be sold to whatever product that is being created has to be sold to just the right kind of an investor. If you sell it to an investor who is expecting, just like a mutual fund unit, that he can get an exit in next 6 months, 1 year, obviously, not only is misunderstood, he will always, throughout his life, he will complain saying that, something wrong has happened to him, and some wrong product he has got into, though he would not have understood. So I think the most important thing here is whether it is, yes, a lot of things will have to happen on the taxation side. Again, if you look at the global example, a lot of benefits are given to AIF investors. So probably those things will evolve once the size of the industry also grows, and then there is a representation from the industry also, and things will change. But the most important thing here, I would say, is that things will change drastically in the country once we are able to identify and say that he or she is a qualified investor, and then the regulation reduces for him or her, and then it is easy to sell stuff to them, and all this misunderstandings and misgivings and whatever is happening today will all vanish, and things will be normal, and the people will be able to invest as easy as what they are doing through the mutual fund, because they understand the whole thing.
Sure. Sunil, I would like to bring you in, and then I would sort of bring you, Anjali, in for the solutions. You are an independent asset manager, AIF, Sunil. So tell me, what are the concerns that you have heard from HNIs, when investing into an AIF? What really are the key questions that you have had to deal with? One is, of course, the taxation, the regulatory aspect of it. But seeing the enthusiasm and the interest and just the amount that AIFs have mobilized, there seems to be perhaps much clarity and understanding about AIFs. Do you think it's a much easy sell right now, AIF, compared to perhaps 3 or 4 years vis-a-vis earlier? Of course, that is how the products would have evolved. And what really are the concerns playing in the minds of investors even now? And I would sort of bring you in, Anjali, and then perhaps for the questions and the asks from the regulators to ease the process for AIFs in India going forward. Yeah.
I will have to step off at about 11:15. So I may not be able to stay for the questions. I just wanted to mention that too.
Okay, so Anjali, you want to sort of...
No, please, first Sunil and then I. And then I'll
Okay.
step off. Thank you.
So very clearly, taxation is an issue, but at least my perspective in life is that worry about something which is in your hand, something which is not in your hand, no use worrying. So we'll just keep that out. So obviously, when we meet investors, one is this concept is still new and it's not as widespread. So you have to explain to the investors the difference between a PMS and an AIF and a mutual fund. I think that is a major question mark. The second, I would say, is I would say it's not about the structure, it is more about the markets, whether to invest or not. So I would say that 9 out of 10 investors I meet don't ask me about what AIF and PMS and mutual fund is. It is predominantly about whether to invest now or not. I just wanted to make that clear. So I think the awareness has increased. Obviously, it still has to go to a wider section. I would say out of the 60,000 odd IFAs which are there, who take mutual funds to their clients, not even 1% have either the interest or the kind of investors, Andrew mentioned about 1 crore ticket size. They don't have that kind of investors who would be, keen to invest in an AIF/PMS. And therefore, the awareness to that extent is limited to maybe a handful of cities and a handful of very mature, private wealth guys like IIFL and the others.
Okay, Anjali, the solutions and asks from the regulator, so boosting the AIF industry further, what would those really be?
I think the regulator is fairly responsive at this point, and whatever enabling regulations the industry puts forward go through the due process, but are being given to industry. I do think it is important to keep that threshold on what defines a sophisticated investor. So I'll go back. It's actually, I completely agree with Sunil. I think solving for tax is, as a fund manager, the wrong thing to solve for. You should solve for returns. And if you have returns, then the happy part of paying taxes, you have income to pay tax on. Now, how much that tax is and all of that is a different matter. The second point is, for AIF investors, actually, as a fund manager, we talk about this all the time in the industry, you are better off taking a sophisticated investor who understands what they're getting into and don't think that this is something that can be redeemed like a mutual fund, because that then runs into issues later on. The third piece I want to say is, there are two different ways of thinking about this, which is, even in AIF, you have debt AIFs, which generate income more regularly and start creating returns right away. Whereas the equity AIFs, which is the private equity or venture type AIFs, category 1 and 2, and debt AIFs are separate. The equity AIFs take much longer. So your lock-in is longer. So it's very important that the industry understands this, the regulator understands this. Debt and equity are different. Debt AIFs actually are doing very well right now in India. And there's a lot of investor appetite for that also. And then publics are a completely different segment. So whether you set it up as a mutual fund, as a PMS, or an AIF, again, I fully agree with Sunil. I think the bigger question is, should I invest or not, versus what is the nature of the instrument?
I think that question, should I invest or not, will be a perpetual question always for markets. I think we had a very interesting discussion here. We spoke about mutual funds, vis-a-vis AIFs, the market for each other, the investor education, the kind of role a qualified investor brings to the table. If independent managers were to venture out now, what the risks and concerns they have to sort of be careful about, what really is there for the regulators. And I think there are two key aspects which I really want to dwell upon, and I think time is running out. And I think I would really like to have this August panel really sort of answer to that. This entire question of tech solutionism. For instance, right now what we are going through in the COVID scenario is that we see so many people reach out to startups on Twitter handles that suggest solutions on how to handle the COVID aftermath. If I were to put you on a situation where this reverse pitch, where suppose an Andrew or a Sunil were to pitch two ideas for AIFs in India from product innovation perspective, which they don't see right now, what would those really be? I see a lot of narrative building around the credit AIF, which I'm also seeing in the private equity space playing out in a big way. I know funds like True North getting into private credit space. So if you were to give me two examples, maybe one from you, Sunil, and one from you, Andrew, on the product innovation for AIF, which you don't see prevalent right now, what would those really be? Yeah. And Anjali, please stay back. I have a question for you too towards the end. Yeah, Anjali, I'll begin with you.
So I'll be very short. I think I adore IIFL asset management, and not because Manoj is here, but the kind of innovation they have been doing over the last 3-4 years is really commendable. The pre-IPO AIF was a phenomenal idea. They have a CAT2 AIF which invests in a mix of unlisted and listed company. I think that's a great idea. I think if I were to launch something which is not in the pure listed space, it would be maybe a CAT2 hybrid kind of an AIF, which will be a mix of investing in unlisted tech companies and listed tech companies. So I would say that at this point of time, it would make great sense. It would balance the risk, because you have 50% or more of your assets in an unlisted component, and almost as much in the listed component, which will give you the stability and also ensure that capital loss because of your investment in unlisted space will not be there. So I would say that would be at this point of time the thought process.
Quickly, Andrew, anything you need to sort of add to what Sunil said?
Yeah, well, I think two things here. One, I just want to just very quickly just mention on this tax, because I listened to everyone else, but what it is, and I think the problem that category 3 AIS hedge funds in particular have seen degrowth, because when they increased the tax rate in 2019 to 42% derivatives, it's not then about performance, it does become about tax. Even if you make 15 to 20%, after fees and everything, 50% has gone away. So that is, I think, is something that the government should look at. Because if you invest today in our fund and your tax is less than 42%, the fund pays tax on your behalf. So you don't get the benefit of a setup. So that, to my mind, is not correct. But anyway, in terms of new funds, well, hopefully we'll be launching some of these. One thing that we probably won't be launching, or we might do in the future, is something not dissimilar to what Sunil was saying, is where you've got something which is kind of CAT2, kind of investing in, not kind of venture capital, but more towards those companies which maybe are listing in 1 to 2 years' time. So you've got tied in liquidity there, alongside a kind of a hedge fund, which is giving you some kind of returns in the shorter term, whilst you're waiting for your longer term investments to come to fruition. That's the kind of fund. So little kind of private equity with public markets would be something I think would be certain investors would, I think, welcome something like that.
Anjali, you heard both your colleagues on product innovation. If you were to give an answer or a solution or a suggestion to them, what would that really be?
So as a personal investor in both public markets as well as structures and so on, I would welcome such a product which allowed you to do income generation immediately if that is desired, but also balance out your risk a little bit. But with my investor hat on, not as an individual, but as an investor hat on, I think it's really a matter of who is your target customer and what do they need. So if somebody has risk appetite, and we are seeing a proliferation now of micro VCs who are going even earlier, even riskier. So micro VCs, AngelList, Let's Venture, it's becoming much easier to start pooling capital even outside an AIF structure to do the participation in this very, very early seed stage, idea level type companies, right? So I think there are those who have the appetite for that, and they will carve out some part of their savings or net worth or investable pool for that kind of asset class. And then there are others who will want to see more of a balance in a larger portfolio.
I think Manoj is back here. Manoj, you heard all your colleagues in product innovation. Do you have any suggestions to add on, one interesting product innovation that we can see from IIFL, or sort of what you're perhaps thinking on?
Yeah, sorry.
You should talk about SPAC before you let all of us know.
Exactly.
But if I may take your lead.
Anybody, I just came back. Yeah, I think, product innovation is, it all depends on the time and, what is available at, there are certain things that you bring well ahead of time, it doesn't work. You bring it after the story is over, it doesn't work. So you have to actually think in terms of, you have to be quick to turn around and bring something on the table. And I think that is where, though I have just taken over IIFL Asset Management just about 2 months back. But I think that has been one of the reasons for the success, is that you decide something and then you quickly turn around and then make it happen. So I think I can discuss some 5-10 things. They're not just one, but I think it all is required at that particular time and whether it suits. In fact, we are recently now the kind of response what we are getting in terms of our Special Opportunity Fund 8, especially on the digital explosion that is happening. I mean, the kind of response what we are getting is tremendous, and the kind of investors what we are getting is not just the professional investors. It is, I would say that even people from the private equity fund managers are also investing. I mean, that's the kind of thing. So you have to just anything, whatever it is, you have to bring that one particular killer idea at that point of time, and then turn around and quickly do that, and before the juice is out. So I think that's all I would say. I would not say anything specific what is possible or what should be done.
Okay, I think Anjali had to sort of jump on, but I think she really mentioned a very interesting word, SPACs here. And I would sort of wanted to pick the brains on the SPACs investing in startups. Any sort of thought, Andrew, on that? You know, we are seeing really a surge in the West. I mean, would you see that in India anytime soon, where SPACs could really become a mainstream conversation here also?
I mean, they could well do. I think actually, if you look at the performance of a lot of the SPACs now in the US, I think you'll find that they're actually losing money for people. See, it's very easy to come, and say we're going to go to the moon and back because you don't have any, regulations around that. It's not like an IPO, so you can just kind of, say we're going to, raise this money and then acquire something. It's fraught to my mind with danger because some of these people haven't managed businesses before and so forth and so on. So they're raising easy capital. They're getting great valuations for doing it. But if you look over the last 2 to 3 months, you'll find that most of these SPACs are now underperforming the market or have lost you money from when you originally invested. So it's a bit like sometimes, buying it into an IPO and taking the premium. But once you're listed, then, you take your money off the table. I think that's maybe what's happening. So you could well see SPACs from overseas buying Indian companies. I'm not sure we're quite ready for a SPAC in India.
Okay.
I might be wrong.
Okay, my last question to you, Sunil, and I think it's an interesting sort of narrative that we are seeing, especially in the financial services space, about this entire concept of DeFi, which is essentially the decentralization of finance. When you talk about this, people, and especially millennials and younger investors, are perhaps losing confidence in a very trusted and very regulated way of managing money, right? I mean, they want something which is more peer-to-peer, which is more decentralized. And this entire question of, Bitcoin or cryptocurrencies sort of has come in as sort of a very mainstream form of investment, especially in the West. I want to sort of get your view that how do you see these kind of narratives playing into innovative products like, AIFs, or where we are in the value chain of managing personal finances of people?
So first of all, a disclaimer, I have studied a lot on blockchain, but despite, I would say, spending a lot of man hours studying that, I have still not been able to understand the concept of cryptocurrency. So I am happy to not understand it and not invest. Coming to the millennials, I think obviously there are many of them, and obviously they collectively have the power of more than the biggest of biggest funds in terms of moving asset prices. But at this point of time, I have a 23-year-old son who's in San Jose, US. I don't think they understand what they are getting into in terms of valuations. I think it's a lot of hearsay, a lot of trending thing. One prominent investor comes and buys something, then you suddenly have 40-50% prices moving up, and then you have short squeezes and so on and so forth. So I would say that these millennials will learn, and they will learn the hard way. No amount of books can teach you, but some amount of losses can definitely teach you and have a more lasting memories rather than any books. In terms of changes, I'm sure that, as mankind, we will continuously evolve. So from horse cart, we came into cars, and from cars, we'll come to EVs, and maybe after EVs, there will be flying cars, and so on and so forth. We will evolve. I think we are meeting virtually. Otherwise, most of our conferences have been in person, and it's a very convenient way of doing it. No one has to wear suits except Andrew, and we all can be in the comfort of our own homes. Things will evolve, and I think that is where understanding what the millennials are going to do is very important for any forward-looking investor. So I would say rather than just getting into something because it's a fashion, try and see how we can take advantage by learning from them.
Okay, so there's a big word of caution coming in that fashion can soon become fad. And I think perhaps the millennials would learn more from their losses, and no books can teach them. Quick rapid fire. Andrew, what are you Netflixing these days?
I watched Rocket Man last night because I'm a big Elton John fan. So I saw him in Las Vegas once. He did the Red Piano. So I saw it had just come there, so I just thought I'd go and watch it.
Okay. Sunil, your one advice to your colleague, to your asset managers and mutual fund industry.
Be positive on India. There's a lot of money to be made.
Okay. Manoj, 5 years from now, if people were to look at this coronavirus pandemic, how will they remember this?
I don't think anybody will remember this. It is just a passing phase. We don't even remember what we did last year, same time. And it's just that as long as economy does well, people are growing, incomes are growing, and like what Sunil said, he's positive on India. And next, he said 5 years, I'm positive for the next 10 years. I don't think anybody will remember what happened today. And they will just say that, okay, it was just a passing phase, and then we are back to normal. So I think that is what will happen 5 years down the line.
Okay, thank you, gentlemen. I think we have so much to cover, and I think it's a very interesting conversation here, a very wide-ranging one, and we could cover as much as we wanted. I think the time was short, and we could not have Anchi, and I think Sunil also has to jump out. So Aditya, any questions from the audiences before we sort of sign off? Because I already see the panelists for your next session waiting in the queue. You're not audible, Aditya. I think you're on mute.
Yeah, am I audible?
Yeah,
You're audible.
I'm so sorry, I'm so some issue with this Bluetooth. So we would have loved to ask audience for the questions, but unfortunately we're already out of the time for this particular session. I think the next session starts at 11:30. I'm sorry. So
okay.
These guys are waiting. So at the expense of my next co-panelist, I'll just quickly ask the audience if there are any questions. Maybe we can push our luck and, because a panel like this, we don't get to meet every day. So guys,
maybe we can take one question, one or two questions for the audiences, I think.
Yeah. So, okay, the first question, any significant opportunities you're seeing out of the GIFT City for AIFs? Anyone can answer.
Who will want to take a stab at that? Maybe so Andrew, the GIFT for AIFs opportunities.
Yeah, as I said, at the very beginning, that GIFT City, affords us an opportunity to have a reputable jurisdiction which will compete with the rest of the world at very much a lower cost, and we can all manage the funds, set in India rather than having to have an offshore presence, which you don't really need. So because on being on the ground, I think gives you much better advantage than people be set offshore as well. So I think this will evolve, and I think it's a very big opportunity. And if we can do it, I'm not just talking about hedge funds, or if we do it across the board from from venture capital through to private equity, and put ourselves on the map and put GIFT City on the map, then I think the opportunity is very significant for foreign funds flows to India to become more directed away from, I'm just talking about equity for the moment, but away from some of those kind of emerging market funds to India-focused funds as well, which I think has been lacking for some time.
Okay, Aditya, any one question, maybe Sunil or Manoj can take that up.
Yeah, I'm just quickly checking if there's a question. Audience, if you have any questions, please quickly post on the Ask a Question tab.
So I think we have covered it quite fairly well. I think the audience is pretty satiated. And thank you for being such an amazing audience, patient listening. And thank you, Sunil, Andrew, Manoj, and Anjali for being such amazing panelists. And Sunil, wishing you happy birthday once again. And Andrew and Manoj, thank you.
Thanks a lot.
Thank you for having us.
And thank you, Aditya, for organizing this. Thank you.
All of you. It was a pleasure having all of you here, and thank you so much for taking out time. Looking forward to keep engaging with all of you in our future events as well.
Thank you.
Thank you. Sure.
Audience, moving on to the next panel, which is already here with us, and it's a very, very important panel because this panel is been designed by the IAAIF committee, and it's going to discuss various policy and advocacy recommendations on behalf of the AIF industry. So we have with us Ms. Leelavati Naidu from Avendus. We have Ritesh Agarwal from Indus Law. We have Rishi Sancheti from Algo Legal. And we have Mr. Devasthi Singh from Kitan and Company. So Leela, we've already out of our, I mean, we already a bit late with the session, so I'll not take too much.
Yes.
You can start with your panelists.
Yes, thank you, Aditya. Good morning, everyone. Thank you for joining us today. As the topic says, it is advocacy session. While it is one of my favorite topics and we can go on the entire day, what we have done is we have picked up few topics which the industry is grappling with so that the panelists can dwell more deeper and the session is more informative. As Aditya already introduced, these are the set of panelists who are part of the advocacy committee who constantly work together to strive the difference between the industry players and the regulators. To quickly begin without wasting much time, the first one is Devas, if you may lead. As you would know that AIF is a macro managed industry. Last year in 2020, SEBI came out with a very interesting concept of investment decision making. Who is responsible to make the investment decision making? Interestingly, it also passed on the joint responsibility to the investment committee for the set of investment managers who are responsible for managing investments along with the investment committee. We did a series of representations with SEBI. We spoke with them. They were part of the entire discussions that we were having with SEBI. It would be interesting to get your thought process on the background and how the industry is spread across for the investment committee setup.
Thank you, Leela, for setting the background, and very good morning to everyone present with us on this interesting session. So just before we delve into the changes which came about, and IC and all of these changes have been one of the most hotly debated and discussed topics since the last 6 to 8 months. I think it'll be important to also get a bit of an understanding of the background, what possibly led to these changes. Just quickly, an IC is classically a delegated decision-making body, which is usually set up either at the manager level or at the fund level. And the key role of the IC is basically to act as a screening committee for all investments and divestments. So the groundwork is done, say, by an investment team. They do the diligence, they do the groundwork, they arrive at a particular decision. That decision is classically screened through the IC before the investment or divestment is actually undertaken. Now, the IC could effectively be a final determining authority in terms of being the final check before the investment is done. or it could be the penultimate decision-making authority where the IC takes the decision, and then the final decision is, say, ratified by the board of the manager, or say in certain offshore funds, it is ratified by the board of the fund before the final decision is actually made. So this is typically the role of the IC. Now, when we look at the composition of IC, at least what we've seen in the industry, composition of the IC is classically individuals with some expertise, some backgrounds, and these are individuals with gray hair, and Richie may disagree with me there. But typically, these are individuals classically with a gray hair who have a certain standing in the market, because investors from their side also would look, okay, who is the repository of all decision making? Well, yes, these are 3-4 members on the IC, and we are fairly comfortable. Now, how are ICs classically composed? IC, you will not see these IC constructs in entrepreneurial funds. Say, if Ritesh were to launch a fund, he may be the sole decision-making person there. But we've seen IC in classically large group structures where it's, a fairly large group where senior individuals from other group entities would want to come and would want to showcase the expertise to the larger investor base. We've seen IC being fairly common in joint venture funds where two GPs from diverse backgrounds come together to manage or set up a particular fund. There they would want to place certain senior key managerial persons from their respective groups on the IC to ensure that they have some say in the decision making. So this is where we've seen ICs being classically composed, and I would say the last situation, though it's fairly rare, and I think with these SEBI changes, it may completely go out of the window, is certain large institutional investors have also at times in the past asked for a seat in the IC. And this is where you have a fund where 40-50% is being contributed by a large investor. Of course, they may be justified in asking for a seat on the IC because there is a significant capital at play for them. Now, with this background, when we look at SEBI approval mechanism in terms of when and how SEBI approves, when we file the application with SEBI, classically the kind of information, the kind of KYC diligence which SEBI does is basically, of course, on the 3-4 entities: manager, sponsor, fund, trustee, and on the directors of these 3 entities, and perhaps on the key managing person. Now, key managing person is somebody with the requisite track record experience. We need to showcase that, of course, there's one person with 5 years track record who is going to be leading the charge at the manager level. This individual is supposed to be either an employee or a director of the manager. SEBI, at least in our experience in the past, has not really gone into that, okay, if there's an IC also, let me see who the individuals are, let me do a diligence on these IC members. Now, basis this background, what we understand, this could be purely apocryphal, and is that in some investigation which SEBI was conducting, there was some discussion in terms of why certain decisions were made in terms of investments, divestments, etc. And when SEBI raised the question, the fund manager that time raised their hand that, see, we had nothing to do. We did the diligence, passed on the decision to the IC. It's an independent committee which took its own decisions, so don't question us if you won't question the IC, which is why SEBI suddenly realized that, what is this new animal which is being thrown to us? We don't understand this. Neither do we recognize this in the regulations, at least. Of course, it is a fairly standard industry practice, but as a regulator, they have not really been diligencing or applying their mind behind the construct, composition, role of the IC, etc., which is what led to some of these changes. I would just perhaps pause here and pass on the baton to Richie to just throw some light in terms of the changes and our ask to the regulators.
Yeah. One more thing, Richie, one more thing, if you can highlight on, because of the changes that the investment committee has brought in, you have been part of a lot of fund structures. What is the changes that you've seen from the industry players in terms of setting up their IC? Because I believe global investors usually love to be part of IC, to be part of the decision making. Do you see any obstruction? Do you see increase in demand in terms of having a DNO insurance? What is it that you've seen over a period of time?
No, sure. Thanks, Leela, and thanks, Divas, for the input. See, I think to begin with, ICs were constructed to bring a lot more fluid process to the entire decision making and how you construct the portfolio. So can we keep it outside the board of directors or those who are sort of recognized under law to be cast with fiduciary obligations and so on and so forth? So it is pretty much always the senior most members of the team who are part of the IC. And it's not as if, IC is bereft of any obligations. The law of a fund pretty much comes from what the investor is expected to do. So when we draft the investor documents, the fund PPM, etc., that frankly is the real framework of the law, because investors sort of tie in the fund manager with what are the processes they want the IC meetings to sort of follow to come to certain decisions. So which is where when we thought that, and when we saw that SEBI is coming back with rules and trying to tighten how ICs looked at, how the construct sort of works, it came as a bit of a surprise, because ultimately, if the objective was that we want Indian owned and controlled theme to sort of flow through, ICs are always constructed by the board of the investment manager in an Indian context. The manager retains the ability to replace one or more members of the IC. And accordingly, when we are looking at it from a perspective of Indian owned and control, I think pretty much looking at the board composition of the manager could have sufficed. Having said that, now we are in a space today where IC is put pretty much on the same pedestal as the rest of the management team and the board of directors. So in this case, I think from an investor perspective, we have always seen an initial seeking of perhaps an observer seat on the IC, or maybe even a member on the IC. That's when, and I'm talking about 2007, 10, 11 vintages. That time there was still some fancy attached to being part of the IC, either as an observer or as a pure member. Suddenly, a lot of jurisprudence came in, a lot of sophistication also came into the Indian LP class when they realized that there are a lot of fiduciary obligations attached to being part of the IC. And accordingly, they realized that if there are meaningful third-party investors coming apart from them, they would rather step away from the IC and focus more on strengthening the LPAC, the Investors Advisory Board, and so on and so forth. They could make the investment manager a lot more accountable to the LPAC, so that they achieve their objectives, but at the same time, they don't take up the fiduciary obligations. I think coming back to finally where we are from a SEBI perspective, SEBI obviously does recognize the distinction between internal members and external members, like Devas was summarizing. Internal members are anyone who's a director or a partner of the manager. And accordingly, if let's say the fund manager is a joint venture where some overseas GP has also participated, then in that case, them being a part of the IC, even though they are a non-resident, still makes them an internal member, not an external member. That is perfectly fine. If an entity does not own any stake in the fund manager entity, then they're an external member. In which case, if they are a non-resident, only then do we see the rigor of the law that SEBI has said that, okay, we may not be comfortable clearing these applications right now. So today, Leela, I think just to summarize where we are, a lot of confusion in the market as to what situations are allowed, what situations are not allowed. And frankly, it's about making the meeting of minds happen between LP and GP, and to put the SEBI regulations into perspective. I can go on, but I think I'll take a pause.
Yeah. Thanks, Rishi. Ritesh, coming to you, tax is your forte. Where is the issue that you've seen in terms of tax? Do you see any complications that have come up because of this changes from SEBI?
Sure, Leela. I think I'll pick up from where perhaps Rishi left, in terms of the confusion that has been created. And at least from a tax perspective, now there is an interesting conundrum that has now come up, right? Because all throughout, we were of the view that a fund manager is responsible to determine whether a fund is a resident of India or a non-resident of India from a tax perspective, because most often fund managers were constituted as LLPs. And if you looked at LLP, control and management became a determinative test. Now with the role of IC being highlighted in the manner SEBI has, and looking at the constitution of the IC in terms of resident, non-resident status, both for tax and for exchange control purposes, I think this brings up a whole new twist to how a fund will be taxed in itself. Say, for example, in a given year, 4 out of the 5 IC members are non-residents. And picking on, what Devas was just saying, that look, IC makes the decision, manager did the diligence and made a recommendation, etc. If a construct of that kind was to follow, would you believe the fund is a non-resident? Because the change in the tax rate is quite drastic. It's possibly from 34 to 44, and therefore that changes your entire return equation in an ordinary in an ordinary year, assuming it's a Cat 3, but it's a Cat 1, Cat 2, you still have pass through. And therefore, to that extent, Leela, this proposal and this idea has only resulted in more confusion rather than making life simple for any one of us.
Thanks, Ritesh. While from an industry perspective, what I see is still there is a lot of lack of clarity in terms of who the external members is, because I get a lot of calls from the industry keeping on asking who is defined as an external member. There are a lot of investment committee members who are just for corporate governance, which is basically giving a holistic framework, approving the policies. A lot of people are still confused as to what exactly it means. If I have to say a quick takeaway, I think a tax clarity and a clarity on how the external IC members play will be very helpful to the industry, while a good corporate governance is always welcome from the industry for a good strong base for the industry to grow, but making it too onerous sometimes makes it slightly restrictive for the external mind to get into the organization to help us and launch new products in the market. Thanks. This was interesting. We move on to the next topic, which is while most of the people who would be doing offshore marketing would be very well aware of the term sophisticated investors, qualified investors, accredited investors. In March, SEBI came out with a very Indianized version of accredited investors. Rishi, since you are very excited about this topic, I would want you to hold this baton and help us deep dive into this concept and what is your view?
No, sure. Thank you. I think the way this paper has to be received is from a perspective that SEBI is realizing increasingly that it has for long worn the mantle of being very keen for investor protection. And it is in line with the different products that have been launched historically, the mutual funds, the portfolio management, which started at a 5 lakh rupee ticket size, and so on and so forth. But increasingly, SEBI is also getting a lot of feedback from the industry that there is enough sophistication in the investor base, that the time should be ripe to try out newer products. I think this is where IFSC sort of also came into play. That IFSC for the first time, SEBI did take up the AIF regulations, but relaxed a lot of norms. All the concentration norms around the 25% on Cat 1, Cat 2, and 10% Cat 3. All of those were relaxed, and so on and so forth. So I think it is time that a certain segment of the Indian investor base be recognized as accredited investors. So far, SEBI has been taking an approach that, okay, if an investor is committing 70 crores or more, which is equivalent to $10 million at that point in time, they are sophisticated enough to understand the risk return profile of the product. And accordingly, they need not be sheltered by the regulatory mechanisms out there. And accordingly, the manager dealing with such sophisticated, large ticket size investor would have been allowed to have some fine tuning, some finesse on the product. And SEBI would have been a little more accommodating that, okay, this is somewhat, it's a diversion from what the law says, but at the same time, we are comfortable because these are conversations between two absolutely sophisticated parties. Now, what the paper does is that it introduces the concept of accredited investors. There are, sort of eligibility criteria, both from an income perspective and from an asset test net worth perspective. What it does is that it would reduce the ticket size expected from an accredited investor. Instead of expecting somebody to be deemed sophisticated only on account of $10 million of allocation, maybe a much smaller allocation, maybe 1 crore rupee of commitment to an AI product or whatever, as long as you are sophisticated with what you are as an investor. And accordingly, SEBI does sort of seem to be thinking that can we relax all the concentration limits, the leverage rules, and so on and so forth. What enthusiasms us about all this is that SEBI is looking to try out new products. Otherwise, there was no development in the financial services industry. And unless you test it out in a larger ticket size environment of an AIF, that I think would be a good gateway to start the entire process. Or the portfolio management regulations where the ticket size is now 50 lakhs. So there is a lot of appetite to do some sophistication in the product. Maybe the leverage rules also can be relooked for the PMS product, which is so far allowed only 1x. So a lot more products can be introduced, and this would definitely help push India to the next phase of growth. More interestingly, internationally, it is the fund managers who are regulated. It's only in India in an AIF environment where you see the actual pot of the capital, the fund itself being regulated. The manager is regulated, sort of as a tertiary point because a lot of obligations are cast. So hopefully with the introduction of accredited investor, maybe the regulations could focus less on the funds themselves, but more on the investor manager, so that the ecosystem sort of develops and there are lesser concerns coming from that space. So I think the whole thinking in this direction is what is the most exciting part about all this.
Thanks, Rishi. That's helpful. One thing I would like to add to Divas and Divas and Ritesh, it also talks about accredited certification status. While Rishi rightfully pointed out that offshore in the global market, you always see accredited investors either to be relying on a self-certification or relying on the fund manager to do the due diligence and figure out whether an investor is accredited or not. But this accreditation status, because already the investors are grappling with CKYC, linking of their PAN to Aadhaar, adding a more layer of complication of maintaining a certification of accreditation and sophistication slightly adds more complication to this path of moving to the accredited. Divas or Ritesh, if you can throw some light on it, on your view.
So, Leela, the way I were to look at it, of course, no changes would come with its own share of pitfalls and certain challenges. But the way I see it is, I would say it would be the lesser of an evil in the larger scheme of things, as Richie was mentioning, if we were to look for a fair bit of sophistication coming from investors, and we're talking about fairly large investors who have a significant asset base. I would say it would not be onerous on them to just refer back to their respective chartered accountants or compliance professionals and get that certification that, yes, we do meet some of these norms. And this is also the practice globally, whether you see it in the Singapore context, in the European context, in the American context. It is predominantly a self-certification norm. Well, of course, now as an additional check and balance, it would be the manager's KYC, whether the manager is comfortable taking self-certification, or because the manager is asking for certain leeways and rebates from the regulatory standpoint, whether the manager would want to go a step further and say that, of course, self-certification is fine, but I would also want to couple it with a CA certificate or a compliance professional who does really confirm the income and asset test. So I would say that this is something which would be a minimal, which the regulators may also expect.
Yeah, thanks, Divas.
Yeah.
I will take a quick pause over here. I would request the audience to pose their questions in case we'd be happy to take your questions at the end of the session. We move on to a third session, which is, while we spoke about the investment decision making, we also spoke about investors. The third most important part for the AIF industry is to have a lot of gamut of products to come out, because it is known as a high leverage industry. It is known as coming up with innovative products. So the third product that I've always seen fund managers asking is, can we do a fund of fund, which is investing and relying on talent of other fund managers and also doing some bit of direct investment. So it's a combination, it's the best combination of two fund managers applying their mind. Ritesh, you have been part of a lot of fund structuring and discussions with SEBI. What is your view, and where is SEBI leading to in terms of this fund type?
Sure. I think at the moment where we stand, Leela, is that fund of funds are possible, except with the restriction that some amount of direct investment may not be possible, right? So essentially, as a fund of fund, you could consider investing in other funds, but not in another portfolio directly. And at some point, I think the theory behind all of this is backed by the economics of, the layering of cost, etc. And how does this sort of turn out in terms of efficiency insofar as the ultimate LP is concerned? And therefore, there has been that bit of, I suppose, lack of commercial clarity in a regulator's mind. And this is something that also, in terms of the position to make direct investments, SEBI has also recently clarified it in its board meeting. But what we are hoping is that in the near future, SEBI will really come back and revisit this entire proposal, understand the merits of it, especially now given that the government itself has announced a whole bunch of fund of funds in terms of supporting real estate sector or the startups or some bit of the industrial infra, etc. So I think in that direction, a little bit of openness to the idea of, allowing for some direct investments is there is a good case for it, if I may sort of put it that way. I think the industry is open to having some kind of a checklist or sort of checks and balances in its entire process. But I think this is really an idea we should open ourselves to.
Yeah. Thanks, Ritesh. Divas, you have been speaking with the regulators quite often on this fund structure. So your views on it?
Yeah. So on this one, Leela, I think where we see the key challenge in the regulators' mind is basically somewhere they feel that this could be used where the fund of fund is, of course, investing in its daughter funds and also investing directly in underlying companies. This could be used as sort of a roundabout or a conduit to breach the concentration norms or breach the diversification norms which are typically otherwise applicable. Because as a fund of fund, you could invest 100% of your corpus in a daughter fund, but your direct investments in portfolio companies is restricted to 25%. So they feel that somewhere using these structures, fund managers may potentially get a higher share of an underlying portfolio company, which is otherwise permissible under the regulations. So I think with that background is why they were a little hesitant to allow fund of funds also to invest or to make direct investment. But as Ritesh was also saying, we've seen some positive development on this one in the SEBI board meeting pursuant to all our joint efforts which we made with the regulators. So hoping something positive should come out of it, because it's definitely a need of the hour. And we've seen this across global fund structures. If you see any of the large global fund of funds, while they, of course, partake in fund-specific opportunities, but they always have that additional or a part of their portfolio which is also in direct investment. So it's definitely something which is required by the industry, and we hope that SEBI would listen, which they seem to have, and come out with some positive changes.
Yeah, thanks, Divas. We move on to the last topic of our discussion, which is which you keep on spotting in the newspapers, which is co-investment structures to be allowed with a fund. While the panelists are very excited about this discussion, we'll quickly bifurcate the section into 3 portions. Rishi, if you may highlight on what are the options for the people, because if you see industry with this digi tech economy which is spotted up suddenly, there are a lot of interest from the global investors to come into the PE funds. While they want to come into the PE funds, they also want their share of more participation in these set of investors, but they don't want to deal with the daily rigmarole of getting into SPAs, SHAs, and MISs. So what is this type of structure that you suggest, or you usually suggest to your clients in terms of structuring a co-investment?
Sure. See, I think to begin with, co-investments obviously have been in vogue for a significant amount of time. What was happening is that most of the BCP funds were largely overseas vehicles. It's only since 2017-18 when the AIF regulations opened up that despite absorbing foreign investments, if the manager is India-owned controlled, it would be sort of tagged as a domestic investor. That's when the value of an AIF really unlocked as a mechanism to sort of get investments into India, which frankly then also highlighted the struggle between and the differences between overseas investors and domestic investors. Suddenly, overseas LPs who wanted a deeper participation in a portfolio realized that coming directly under the FDI program could be undermining the way they participate. It could sort of also undermine the kind of rights they have, the pricing guidelines, the put call options, and so on and so forth. Which is where suddenly after 2018, we saw a flurry of queries that how can we innovatively look at the AI format to have a deeper participation in the portfolio, such that while there is co-mingling at the pool level, yet could we activate a new class of units or something on a segregated basis, such that the common pool investors have a mechanism to have a deeper participation. Now, while in the past we're aware that some of the structures have gone live with something like this, in one of the recent cases, we did get feedback from SEBI that, okay, they feel that this disturbs the blind pool nature of the entire, the format that they're trying to regulate. But thankfully, they were open. And when IFSC sort of came into play, one of the first circulars that was issued that, okay, we sort of knocked down the concentration limits of 10 and 25, the leverage rules. And more importantly, we also allow you to have a segregated sort of structure through a separate class of units through which you can have a deeper participation. So in some form or shape, with IFSCA now coming into play, we can look at slightly more structured format of organizing co-investments, where you set up the feeder perhaps in Mauritius, Singapore, or IFSC, you activate a new class of units for the co-investments, which now the regulator seems to be comfortable with from IFSCA perspective. Otherwise, you had the slightly suboptimal situations like, could we look at the portfolio manager regime, which also underwent a change. Now, portfolio managers, if they're operating on a non-discretionary basis, which means that there is one more layer of feedback taken from the client, as opposed to discretionary when the manager takes a final call. So which is where some amount of illiquidity is allowed to be injected in the portfolio, which is where the AIFs and other products sort of come into play. But that frankly is not a great way to tailor a co-investment. So unless the clients are comfortable with an FDI route, co-investment route, IFSCA seems to be the only other sustainable or scalable co-investment option out there.
Thanks, Rishi. Ritesh, if you may want to throw some light from the tax perspective or your discussions with the investors that you usually have while you structure the co-investment.
No, I think from a tax perspective, essentially the only item that surfaces is how do you regard the coming together of people with a common investment objective, right? Because in tax, you have this concept of what is called as an association of persons, which is really a collective agency mechanism to tax people who have a common pool of income. And that really is, that really is one of the most difficult mechanisms to subject someone to tax, because if you look at the rates that will apply, the division of income, and the controversy around whether income has overridden by title or does it belong to a common pool, I think those are really the complex aspects of really how co-investment is now mushrooming. And is like Richie said, if investors are comfortable with using the FDI route, life is perhaps a little more simpler. But if not, some of this really from a tax perspective is, so to put it, as venturing into uncharted territories, especially in the funds space. We've seen AOP as a risk in government contracts and turnkey contracts. We've had some bit of judicial views on it, but in a fund mechanism, really, how should the principle be construed, etc., is really uncharted territories.
Thanks, Ritesh. Divas, you also do a lot of structuring with global investors in terms of fund launch, and I see a lot of demand coming from the tech side for having a co-investment. What is your perspective in terms of what is an alternative suggestion that you give to your investors?
Richie and Ritesh have summed it up very well, and I'm conscious of the time. So just quickly, I think the key demand is co-investment. There is a commercial need of the hour, as Richie also said. What we need to ensure co-investment is done in a proper manner is that there should be alignment of interest, where the fund manager takes a call that, okay, as the fund is exiting, the co-investors also exit. And secondly, there should also be the flexibility for the fund manager to charge fee and carry on that co-investment part. Now, if not the AIF, what are the alternative mechanisms? PMS, but the changes in 2019 where discretionary cannot invest in unlisted and non-discretionary cannot do more than 25% in unlisted, really put a stop to all of these co-investment related structures through PMS. Advisory's inherent challenge that it has to be non-binding. Then there is a SEBI guidance also which says that you really can't charge performance-linked incentive on the advisory construct. And because it's non-binding, investors may take their own calls in terms of exits, and it could create a messy situation at the portfolio company level. And the last is, of course, is a co-investment vehicle. We've seen some of these structures at play, but these structures also have an inherent regulatory risk that tomorrow can a co-investment vehicle which is set up outside the AIF in itself constitute as an AIF because it meets with the pooling criteria and all of those things. And while those structures have been there, but of course, fraught with their own risks and challenges. So now with all of these, I think the demand from the industry is that, at least give us some flexibility on some aspect, right? You can't, because this is a commercial need of the hour. This is what Indian investors are demanding. This is what all overseas investors are demanding. So give us some flexibility, give us some leeway to ensure that we function in a fair manner and there is no challenge of an Indian AIF vis-a-vis any offshore product.
Thanks, this is very helpful. While IFSC has started out the co-investment criteria, it would be very helpful for the domestic fund managers to also have that flexibility, because the brain the most of the brain for the Indian fund managers sits in India. They wouldn't want to move to GIFT City, which gives us a very slow growth in terms of the co-investment demand. While we have come to the fag end of the session, and being part of advocacy committee, we are always been demanding, but one ask from the regulators that you would want to have. I'm not sure whether SEBI would be hearing us today, but it's worth the while to put our demands to SEBI. Rishi, I will go with you first.
Sure. I think maybe a pass-through status even on the GST aspects, because a lot of the VCP industry is struggling with that. It puts the difference between an offshore structure and an onshore AIF structure into stark differences. The leakages are huge, and maybe something there. Yeah, that'll be great.
Yeah, thanks, Vijay. Devas, what about you?
Well, I
have a list, I'm sure.
Or some tax clarity for Cat 3 AIFs, and it's something which the industry has been asking for many years. Even if not a pass-through status, at least some clarity that let it be a single point of taxation, so that there is no issue tomorrow when assessments, etc.
Yeah, thanks, Ritesh. I'm sure you would have a list of tax issues, but just one.
No, I think both of them spoke of tax, so I'll rest my case. So you know what is the most complex issue, really. So, no, I think in fairness, the accredited investors approach is actually a very welcome step. But what we should do is extend this to applying under the income tax law also. You don't want to get under issues of 68, 69. And India, unfortunately, has always had that history of doubting people with money. Right. So if the minute you've put in cash into a company as subscription, you've always been questioned. So coming from that historical background all the way back since 1961, I think it's just about time we sort of let ourselves believe in the governance ecosystem we create. I think have that openness in mind when you look at especially AIFs. That's, if at all, the only request I can put at a very policy level.
Yeah, and as an industry player, I would come to the very basic of my demand, which is please approve our products soon, because we're seeing a lack of 3 to 4 months in product, and business has been bashing us left, right. So I will just demand one thing from SEBI is please approve our products. We have come to the fag end of the session. Aditi, you have any questions for us?
Not really. Let me quickly check with the audience. Audience, if you have any questions, can you quickly put up in the Ask a Question tab? Let's just wait for a minute to see.
Sure.
See any questions? I don't see any questions, so we can.
Okay, thank you. You've been a great panel today. Had a good discussion. I enjoyed thoroughly this discussion, and thank you everyone for being a great audience. Hopefully the session was informative. God bless you. Take care. Stay safe. Thank you.
Thank you all. Bye bye.
Thank you all. Stay safe, guys.
Bye.
We have you go ahead to start.
Hi, Jyoti.
Hi, Shiv.
Yeah.
Jyoti, go ahead.
Just a couple of minutes. We just ended the session, so let's just give a couple of minutes to the audience.
Perfect. Sure.
All right, so can we get started?
Yeah, sure.
Sure. I'll go ahead.
Yeah, so participants, okay, so yeah, Jyoti, over to you. But before that, thank you so much, Shiv and Jyoti, for this quick fireside chat session. I know, sometimes I believe in this digital world, this short, crisp sessions are more useful, and people really look up to them more than those longer talks. And I think we have a very interesting topic at hand here. So thank you for chipping in, both of you. Audience, as you all know, Shiv is the president and head of institutional securities at Edelweiss Wealth Management, and Jyoti is the chief business officer at IC Universal Legal. So Jyoti, over to you. We have around 20 minutes for this session. Looking forward.
Thank you so much, Aditya, and thank you so much, Shiv. Actually, questions have already started to come in my direct message on LinkedIn. So it's rarely to see that before the session begins, the question starts coming in. But a very warm welcome to all of you who are joining us live for this fireside chat on day of finale of 8th Indian Alternative Investment Summit 2021. As you all know, it's on a pertinent topic, changing global macro landscape and its impact on Indian AIFs. As Aditya mentioned, I'm Jyoti Rai, your host for this session. For next 20 minutes, I will be in conversation with our guest, Shiv Sehgal. As you all know, he is the president and head institutional securities at Edelweiss Wealth Management. With over 2 decades of experience in investment and financial services, Shiv, in his current role, provides leadership to one of India's largest equity franchises and is responsible for capital market businesses, which includes institutional equities and asset services. Prior to Edelweiss, Shiv led the Goldman Sachs institutional sales trading equity capital market business in India and was responsible for firm's franchise relationships. Shiv was also appointed to the Goldman Sachs India board to oversee day-to-day operations and provide executive leadership on various committees. He is a CFA from CFA Institute, US. There is more to his embellishments, but I can't wait to invite him and thank him for having this conversation on this platform. Hi, Shiv, how are you?
Thanks, Jyoti. Thanks for those humble words. Let's get cracking. I think, as you said, I think the audience would love to go through what we have to discuss, but thanks for that.
No, certainly. So I'm shooting my first one to you, Shiv. The second wave, as we all know, has been very demoralizing for the country, for all of us, and we stand in the midst of another severe wave. How do you think the market is reacting this time versus the first wave that we saw last year, and why?
So I guess, if you look at the large fiscal stimulus underwritten by central banks, and the faster rollout of vaccinations have enabled economic activity to recover very strongly across the developed markets, especially being led by the US. However, the very recent impact of the second wave in emerging markets and, particularly in India, it is more apparent, where just as economic activity was recovering, if you roll back to what was happening in January, February, the second wave has seriously undermined both the health infrastructure and the ongoing recovery. While one remains hopeful that the prospects of the quick rollout in terms of vaccinations and the localized nature of lockdowns, which we are seeing this time around, will relatively keep economic activity levels on track as compared to the previous year, which was basically there was no rule book written, when we got hit last March. I guess the human cost as well as the permanent scars on potential growth are very difficult to estimate, from an economic standpoint, from a market standpoint. But if you look at the markets, the reality is that headline indices have only modestly corrected, and I'll talk a little bit about why. But the sectors most hit by the lockdown, such as services and banks, have actually seen sharper cuts, despite having very robust earnings this season around. Also, I would like to put things in context. Investor sentiment was probably at the best in terms of euphoric levels at around January, February. The calendar year started with almost everything in place for Indian equities to have a very, substantial bull run. COVID cases were declining. Emerging markets in general were doing well. Global investors were pouring in money. We had seen about $23 billion come in the December quarter. And let's add to the fact that the budget this time was very, very robust, very dynamic. Most market participants felt that the government had done the right things, and market sentiment at that point was very good. What we have seen over the past few weeks is a natural and much needed moderation of that sentiment that probably was at the peak in January, February. I guess the negative catalyst for the correction came in the form of rising global yields first, and this ongoing number of cases rise has actually kind of dented sentiment a fair bit. In the near term, I guess the progress on the second wave, the associated economic restrictions, and I guess the pace of the vaccination in India remains the key monitorable in terms of market participants and how we do that on the domestic front. Also very important to note that this time around, the market has a precursor to follow in terms of what transpired in March of last year. We saw a very, very robust demand bounce back, and the economy adjusted fairly quickly. And market participants are actually looking forward to that, extrapolating that experience this time around as well. And that is why we are not seeing the pullback that a lot of market participants expected. I'll add to the fact that despite the extent of institutionalized selling, both from domestic and foreign, the local demand has absorbed that really well. There is a narrative shift on the underlying current theme. And, actually NSE came up with some stats last week alone. And the retail participation in India has actually moved from 33% market share in cash market from 2016 to almost 45% in 2021. Now, this is not just an Indian statistic in terms of the trend. We have seen a very similar trend in developed markets as well, especially in the US. And I guess this difference has played out a significant role in curtailing the deep correction. If both domestic and foreign institutions were selling, we could have seen a much sharper pullback. So as I said, I guess, everyone is watching how the vaccination and the platooning of the cases happens, but we are still in a very precarious situation in those terms.
Thank you, Shiv. That is a very, very well-defined, laid out sense of what's going around. While the majority of world has seen COVID as a major risk, but speaking of assets, some of the global risk assets has seen this crisis as a boom. Why so? And do you see these trends more enduring, or they are temporary, so to say?
That's a great question. I guess the last 12 months, I think in terms of risk appetite, market sentiments has it's taken everyone by surprise, right? Let's not forget that we have in capital markets the first time all the central banks in unison printing money, right? I don't think we can go back to history textbooks of economics to see the amount of liquidity pouring into markets has been unprecedented, right? And as a result, that ignited animal spirits. And we have seen, what is happening in terms of not just equity markets, but what's happening in the digital space as well with Bitcoin and cryptocurrencies. And, we can talk a little bit about that later. But this unprecedented jump in global money supply is been very essential for global reflation and risk assets. This, in my view, is a core structural change as the new administration in the US clearly wants a larger government role and is focused on reducing inequality as well. I think, they're on a path which we will only see the Fed balance sheet rise and rise, at least in the near term. Powell has said that he's not even thinking about raising rates. Yes, there are pockets where I think, things are getting overheated, and they have been overheated for a while. But unless unemployment and world growth, come back to a normalcy and look stable, I don't think the central banks will pull the lever just in terms of taper tantrum or anything, even indicating in those terms. I think that's probably a story for late 2021, early 2022.
Right. So thanks, Shiv, for that. We spoke about, a humongous amount of investments coming into Indian markets. You just mentioned about the $1 billion, the huge liquidity that is yet to come into Indian markets. But overall, this question, Shiv, is to do with Indian economy recovery, which most of the people are asking today. That how do you see Indian economy recovery playing out in the current global setup?
So I guess, India will be the biggest beneficiary and will definitely see spillovers of the global reflation that we have seen in the last couple of months, right? I think the impact on Indian economy is slightly underappreciated. I think if you go back to the economic boom that happened in the early 2000s, those were the similar factors that led to, the GDP and the Indian economy doing very well. And I think the spillover that I'm talking about, we could factor that into three things. I think the three channels that I watch out for are capital flows, trade, and prices. firstly, improving global monetary tide has lifted almost, everywhere world trade, right? Which in turn will also drive Indian exports and manufacturing capability and utilization rates higher. We are already seeing that in this earnings cycle, and companies alluding to that fact as well. Secondly, this along with the improved prices will lift nominal cash flows and sentiments, thus leading to a better outlook on the capex front, which has basically not happened in India in the last 4 or 5 years. And finally, strong flows should result in the banking system having abundant liquidity. With RBI also introducing measures, they have every time they feel that there is. I think what has impressed me also is that they have been a lot more proactive rather than reactive in the last 9-12 months. And this macro environment, along with the clear pathway that the Indian government and the RBI has shown, I think augurs well for the Indian business cycle, especially the banking sector in the longer term. In the short term, yes, with the second wave ongoing, there will be question marks, into how it plays out in the short term. But I'm a firm believer of the Indian story. I think this decade is for India. I think in a couple of months' time, COVID-19 will be behind us. As the vaccination rollout happens, India has lagged behind in that. Yes, we could have done a far better job in the last 9-12 months regarding that. But if you look at, one stat that nobody's talking about, that despite the year that we had, if you look at the IPO market, which is primary insurances, the market participants showed tremendous faith in that in India. I think we had about 14 or 15 decent IPOs in India, and the total amount raised was almost 27,000 lakh crores in India, right? With an average listing gain of close to 40-45% in these IPOs. I think this shows that market appetite has been extremely strong. Also, the fact that global IPOs have also done exceptionally well. But we have also seeing hybrid InvITs getting a lot more traction. Actually, Edelweiss just closed along with a few other bankers the Power Grid InvIT, which saw robust demand. And we are also seeing a lot of unicorns coming into the Indian markets to list. I think Zomato filed this week, Nykaa will file soon. All of this signals a journey towards the majority of the primary markets in India as well. So I believe, a lot of market participants have talked about, Indian economy going to 5 trillion, and that's a number that's being talked about by the government as well. Yes, COVID-19 has kind of delayed the pathway to that, but the structural growth story is very much intact, right? We have all the levers in place. We just need to wait out the pandemic and hope things normalize soon. But yeah, I remain optimistic, for this decade.
Yes. Knowing you, of course, very optimistic, and you have always been a hard hitter when it comes to India. You have been keeping the flag high of Indian markets, and I've always seen you bullish and realistically bullish. Now that we are speaking about growth of asset classes, new opportunities being hit in the market like IPOs, and the fundraising has been so robust, how do you think the next decade will be from the past in terms of the asset classes?
Well, in the previous decade, there was once big safety trade with bonds doing very well, right? And the US markets post the global financial crisis on a one-way trend, followed by equities and then commodities, which have only kind of taken off in the last 1 year. I think that flight to safety trade is slightly over. There will be larger concentration in assets within equities. It's the defensive and then US equities, which did very well. And EM assets have struggled with hardly any US dollar returns in the last 10 years. And I believe that if an asset class has been on a downtrend or has consolidated in terms of time correction and not just price correction for 10 years, it'll probably do a lot better in the next 10 years. So I think, in my view, EM assets are better poised than DM for the next, in this decade. And within equities, I think global cyclically are better poised than defensives. And I'm a firm believer that this decade will also see the trend that the millennials have caught on, right, in terms of digital assets and blockchains. Yes, there is too much going on there, but some of them are actually well defining and actually solving a lot of the issues that have been in the old system, and those ones will come out as the forefront. And it definitely makes it prudent to have some sort of allocation there as well.
Fantastic. So sure, it's alternatives extravaganza, so to say, that is unfolding for the next decade, if I can interpret your signal shift. Another pertinent question that is making a lot of rounds and people want to ask from you is, how do you see Indian equities performing over the next couple of years? With the index at such a stratospheric earnings multiple, do you think corporate earnings will have a lot of catching up to do?
Well, if you look at current levels of Nifty, in Nifty is trading on almost 21 times next year forward earnings. Earnings so far this season have been broadly in line with expectations or marginally subdued, many do in the IT and auto sector. But they have, expectations were built in very robustly. I think the initial commentary from large private sector banks has also been very encouraging in terms of NPAs and growth trends, and I would expect this to continue. As I said, the global reflation is seeing the metal sector post its highest profitability in almost two decades. I would expect this to continue over the next 2 quarters as well. I think given what is transpiring in terms of COVID and minor lockdowns state-wise, I think the automobiles and FMCG sectors will get impacted. Also, there is raw material pressure there as well. But undoubtedly, if you look at the metric in terms of where we are in terms of yields, right, with global yields and US 10-year yields returning almost negative, it becomes imperative to look at where we are in terms of relative valuations, not just absolute. And what excites me most is the fact that we have seen a downtrend in terms of corporate profitability to GDP for almost 2 decades. And most corporations have gone through a massive cost-cutting exercise over the last 12 months. I think everyone was there looking with microcosm as to how they can overcome this pandemic, and that will lead to a massive revival in earnings momentum. India's earnings cycle is finally improving with higher commodity prices, better banking profits, and corporate cost focus. Augurs very well. It was very much needed as well. Even though normal GDP has contracted, Nifty earnings have likely grown 20% in the last 12 months. I think this, in the overall context of where things stand with global rates and liquidity and improving earnings cycle, will see a lot of capital flow into India once we see normalcy back in terms of the case count. So I do believe that should we see a pullback, nobody can time markets, but I would use any pullback to get back into quality companies and build a portfolio.
Lovely. So thank you, Shiv, for that. We have almost come to the end of this fireside, but there's one more question, in fact, I would like to take up, because this is, again, very important, especially on the platform that we are speaking.
Yep.
Is the key trends that you see in the alternative management and wealth management space? If you can just give us a few bullet points, that'd be great.
Sure. I think the biggest trend that will impact India, right, and it's probably started 4 or 5 years back, is the financialization of savings, right, of the Indian diaspora. And as a result, you will see a lot more innovation and demand for alternative assets within the financial services. And even in traditional asset classes, which have been mutual funds. If you look at the latest McKinsey report, and we have also in Edelweiss done a lot of work, there will be a lot of digitalization and technical innovation that will, funds will have to adopt in terms of technology. The share of investments through the digital channel has nearly doubled from, I believe it was 5% in FY19 to almost in double digits today, right? In fact, every advisory in wealth management is now seeking online, right? According to another survey, nearly 60% of the population that survey expected and wanted online advisory, while 20% preferred omni channels. So I guess, one, there will be a massive demand. And second, in terms of, even if you look at, despite very strong growth in the last 5 years in AUM, in the mutual fund industry, our retail AUM to GDP is still, the statistic is just as low as 6%, versus almost 36% in emerging markets in Southeast Asia and almost 70% in the US. So we have a long way to go in that regard, right, to catch up to. And I think a big change will also come in terms of personalized investment advice that will become more, based on people's risk appetite and retirement. I think this pandemic has brought about a revolutionary change in wealth and asset management industry, which needs long-term assurance from clients. And I think, clients who will adopt product advisors, service solution providers who will adopt to the ecosystem in providing a paperless, and seamless in terms of KYC, onboarding. I think those are the bigger changes that we will see, right? I think that's what the platform demands in the new world. And that's probably going to be the biggest structural shift in the financialization of assets and savings in India, right? Of course, in the platform that we are looking at in Edelweiss Asset Services, we are investing heavily in technology because we can see that kind of demand from our clients who are providing the end clients, right? From a lot of AIFs, from a lot of PMSs. So I think as this asset class grows in popularity, you will see a lot of innovation coming into that space as well, right? We are probably 5-6 years away from blockchain in terms of settlement, but blockchain settlement is already starting to happen in the US. And that's probably the next shift that will happen in India in the next 5-6 years.
Absolutely. My next question to you, Shiv, was exactly on the same lines. You spoke about innovation and adopting of technology, and alternative is undeniably a very strong asset class already in making. So that brings me to my last question before we open for the Q&A, which Aditya would have. I've been following you on various interesting thoughts you've had on the gold and crypto, both. What is your latest view on these two?
Sure. So, gold has been a bit of an performer lately. It was under pressure mainly because of which isn't surprising. We had a growing expectation of a cyclical recovery. We saw a massive spike from November onwards in US yields. And gold is very sensitive to that, right? I'm a long-term believer in gold as a protector of your purchasing power. And I think over the long term, I remain bullish. But the reality is that what last year has shown is that gold has serious competition from the crypto world, right? And also, let's not forget, in finance, momentum is probably the biggest drawer of more money flowing into that particular asset class or product. And Bitcoin, given the performance that it has had and the uptake from millenniums, I think the biggest change for me over the last couple of months has been the uptake in the digital world from institutional clients, especially in the US. With George Soros and Paul Tudor Jones, and with Michael Slayer coming up and MicroStrategy and putting his treasury fund into Bitcoin, Elon Musk at the forefront in Tesla, a lot of things and a lot of large institutions are putting money into this space, which cannot be ignored, right? There are a lot of naysayers. This is all a bubble and it can crash anytime. But the reality is that a lot of smart people are moving into that world. There is so much to learn in that space. There is token, there is stable coin, there is altcoin, there is NFT, which is non-fungible tokens. So it's just not about Bitcoin and Ethereum, right? There is so much happening in that space. I'm educating on a daily basis as to what excites the millenniums and why are these prices moving. So I think for this decade, or at least in the short term, that can continue. And the reality is, the blockchain is actually solving real life problems. And the uptake of that will change. And as that becomes institutionalized, I think, people will go from naysayers to believers in this. But let's see, it's an interesting space to watch out for. I'm still learning myself.
Lovely. So thank you so much, Shiv. It was wonderful chatting with you. Aditya, if we have some questions from the participants, if you can share it with Shiv, please.
I'll quickly check, Jyoti, although we're way out of time.
Yeah, out of time.
Just a sec. So audience, if you have any questions, quickly use the Ask a Question tab.
While we are waiting, Jyoti and Aditya, thanks for this. And I just hope everyone's, whoever is dialed in, listening to us, is safe and, are still doing all your precautions. It's not time to put our guard down. Yeah, that's the last thing I would say that. I think first wave around, I saw a lot of people, thinking this is going to get over soon. It has taken us, all of us, by surprise, but we need to do what we can, not only for ourselves, but our loved ones and our colleagues.
Correct. No, very well said, Shiv. Absolutely. I think things are getting crazier and we need to keep our guards up. So I don't see any question. I believe our next panel is already here. So we'll wind up. I think if there are any questions, we can always take up in the evening during the top under 40 ceremony. I think we can always
absolutely
kidnap Shiv for a few minutes to ask those questions. So thank you so much, Shiv and Jyoti.
Thank you.
It's always a pleasure having you with us on the panel. And have a good day. So
Thank you. Thanks.
We'll move on to the next panel within the next 1 or 2 minutes so that you have some time to catch your breath. Welcome panelists. Welcome Ashish, Mehul, Nalin, Pratik, Rajesh, and Swapnil.
Hi, thanks, Aditya.
Yeah. Let's just
hi guys.
Give a couple of minutes before we start the next session, that the audience can regroup and get back. Yeah,
sure.
Super. Aditya, you'll let us know when we start, right?
Yeah, I will just, so we'll start in exactly a couple of minutes.
Okay, great. So, hi everyone. I just thought I'll quickly list out who's doing what question, not to say that you can't do anything else.
Swapnil, I mean, in fact, all the speakers. So we are doing this on Zoom, okay, right. But it is live streaming, and you know, all the participants have joined us through a virtual event platform.
Got it.
So it's a live session, and
understood.
We can get started in another couple of minutes. I just thought we'll give a break to the audience.
Got it.
Session just ended, yeah. So yeah.
Understood. We'll wait.
A quick thing to the audience. I mean, audience, if you have any questions, even during the sessions, you can keep posting it in the Ask a Question tab. So we can take all those questions towards the end of the session. Swapnil, we have around 45 minutes. I will request if we can, restrict to say 35 odd minutes and keep some time for the audience Q&A.
Got it. Yeah, makes sense. 35. That's.
I mean.
That's fine. I'm just confirming the end.
Minus, yeah. I know it's a heavy-duty panel, and the topic you have chosen itself, will need more time than that. But let me just see if we have any other session. Yeah, there's another session at.
Swapnil, I actually had another meeting at 1:15. I was told, actually, unfortunately, this was put on my calendar till 1 o'clock earlier. But it says to 1:15, but maybe during the Q&A session, if I drop off, if that's okay.
Sure. Yeah, I think 1:15 we'll close the main panel, sure. Not panel, but main conversation, and then we'll start Q&A at 1:15.
Okay, yeah. Perfect. Thanks.
Okay, cool. So let's get started. Audience, please join me in welcoming our panelists for the next session. The topic for the session is behavioral alpha in AIFs, and this will be moderated by Mr. Swapnil Pawar, who is the founder of ASCII. Among panelists, we have Nalin Muniz, who is the CIO alternate equity at Edelweiss Global Asset Management. Welcome, Nalin.
Thanks. Great to be here.
Rajesh Bhatia, MD and CIO, ITI Long Short Equity Fund. Welcome,
Hi.
Rajesh.
Thank you.
Our third panelist is Pratik Oswal, Head of Passive Funds at Motilal Oswal Asset Management. Welcome, Pratik, to the session. Our fourth panelist is Mr. Ashish Somaya, Chief Executive Officer, White Oak Capital. Welcome, Ashish. And our fifth panelist is Mr. Mehul Jani, Fund Manager, Listed Equities at IIFL Asset Management. So, over to you, Swapnil. Let's get started.
Thanks, Aditya, and welcome, panelists. Hi, everyone on the audience as well. This topic, actually, behavioral alpha, is of particular interest to a lot of us who are doing research in investment management. And when Aditya mentioned this, I was quite surprised, pleasantly so, that we are thinking along these lines now. For the last couple of years, I've been studying this specific area. And just to give a quick glance at what that really means, many of you would have come across the fabulous book called Thinking Fast and Slow by Daniel Kahneman and Amos Tversky, Nobel Prize winners, who essentially introduced the whole field of behavioral economics, and as a sub-part of it, behavioral finance. And my most favorite example, actually, of behavioral biases amongst investors is the so-called certainty preference, where we say that would you much rather take 50% chance of getting 80 rupees or 100% chance of getting 50 rupees? And a lot of people will still go for the certainty, because although the expected value of the former alternative is higher, just that 20% chance that you get nothing makes a lot of people think that better off taking known thing, right? And many such other behavioral biases, which consistently affect investment performance because people end up either doing the wrong thing at the wrong time or just skipping doing a good thing at a good time, and so on and so forth. So in today's panel, we'll talk about how what is behavioral alpha and how can that be implemented by investment managers, investment advisors, and regular investors themselves as well. So let me kickstart with the definition question itself. So Nalin, since you've been in this alternate investment domain, I think I probably best pose this to you. How do you define behavioral alpha? What does it mean to you?
Swapnil, thank you. Great to be here. Hope everybody is doing safe and staying healthy. For me, the definition is very simple. It's just the difference between the fund return and the investor return. And that often comes because of different times of entry, exit, etc. So very simple, fund return minus investor return.
Got it. Oh, very helpful actually, and very precise as well. Pratik, would you want to add to that in terms of definition itself?
Firstly, thanks, Swapnil, and thank you for having me. I actually see it through a slightly different lens. So I see sort of, first let's talk about the investor. You have the investor who has his cognitive biases, which they have to control. Then you have the fund manager who has their own sort of cognitive biases that they need to control. Then you also have the advisor, who has to obviously, make sure that his investors, is sort of, on the right path of getting their goals and getting their dreams and futures and make sure the investments are on path. In fact, what's strange is, most people see behavioral alpha as only something that can happen through stock picking or something a little bit more active, but actually it can happen through various means. In fact, just to give an example, Vanguard actually, which is a 100% passive house, one of the most popular white papers actually is the one where they talk about behavioral alpha or the advisor's alpha. And in fact, there's this company called Index Fund Advisors in San Francisco, which are hardcore fans of Vanguard. They have 100% passive portfolios, and each of their funds have actually outperformed the index. So even so, it can come through different means and ways. So I do feel that it's very important. Coming to an AIF's sort of point of view, I do have limited experience in the AIF category, but the structure itself can really be useful, to manage behavioral alpha in a much better way. You have obviously, you do have, stuff like you can wind up the fund early, you can extend the fund a little bit later, you can have different pricing policies, and also obviously you can use a lot more flexibility in tools for you to manage behavior. You can use options for risk management. So I do feel that, a combination of the structure, combination of the tools that you can use, apart from the investor, cognitive biases can really add on to sort of behavioral alpha that I was talking about.
A very interesting example that you took there, the index fund advisors. A couple of my friends had sent me their way saying, talk to them before you propose anything to us in terms of alpha generation. And they obviously believe that there is no alpha in the
it's actually run by a very cool guy called Mark Hebner. So,
I see.
He's a good guy to follow.
I see. Interesting. Thanks for that. Ashish, you'd coming to the examples, you'd mentioned yesterday when we spoke that there are quite a few different ways in which a behavioral alpha expresses itself or comes across. One example Pratik gave as well was the advisor-led alpha, if you will, behavioral alpha. How do you see examples of behavioral alpha in investment context?
Actually, frankly speaking, the whole Daniel Kahneman book which you referred to, I must confess I haven't read it. Okay, I know it's I know it's recommended reading. I haven't read it, to be honest. But yeah, I can supplement from the fact that and I have not been a portfolio manager, which means that for 21 years I've only been meeting investors and advisors. So there are a few things, which I don't know exactly what bias or where it actually falls in terms of classification. But there are a couple of things which I have come across quite unfailingly at very regular intervals. which is almost this childlike behavior, which is to seek liquidity exactly when it should not be sought for. So, like, I don't know the right word in English, but in Hindi, you would call them diggaj. Really big investors, who are entrepreneurs, who own listed companies. Okay. And I've got calls on 23rd March 2020 saying that we feel the need to create liquidity now.
Right.
And my conversation was, don't do it today just because I'm telling you, let's do it next week. Okay. Because, it's like absolute middle of panic, like 12 p.m. on 23rd March 2020. Why is it that you would need to seek liquidity? So the answer is, I would just feel more comfortable. And, I was like, you might feel comfortable temporarily, but trust me, you will regret it. Okay. So this, and I think, incidentally, I was working with Pratik last year, exactly when this happened. And, we manage open-ended funds and we managed, AIFs and stuff. And one of the things is that, we have all these AIFs which are closed. I mean, generally we had closed-ended AIFs to make the structure determinate. Right. And even the AIF clients called us, but they could only express their anguish. They could do nothing about it. They couldn't seek the liquidity. They couldn't exercise the liquidity. But people who were in open-ended products, they made all kinds of wrong decisions, really, if you ask me. That is one. The second thing which I have seen is that, everybody quotes, for example, if you are on your Facebook and email and WhatsApp, everybody says that, somebody would have bought $10,000 worth of Wipro in 1980. There's a lot of folklore which flies around. I think sometimes, I've always quoted that example as a sarcasm, really, because everybody very promptly forwards it to everybody else, but nobody seems to implement anything. Right. I mean, and it's a completely, frankly, for lack of any other word, it's a rubbish example, because in 1980, Wipro was making vegetable oil.
Yeah.
And, everybody quotes these examples, and they are 40-year-old examples, and, people don't have that type of time horizon also. So I think there's one bias, which is that, people follow all kinds of data, which is irrelevant data for decision making, and which they are not even going to actually practice. So it's good to quote things, but very difficult to really follow all of those things. And the last thing which I have seen, which is again, I don't know how to express, maybe Nalin or you guys, you are portfolio managers, so you will be able to deal with this, explain this much better. But, when I go for client meetings, when people are making money, they are willing to buy all pieces of data and they are willing to buy all your hypotheses. But the same Nalin, the same Swapnil, the same client, the same data, if the market is 30% down, they'll question all your hypotheses and they'll question all your data. So I've seen when people are making money, they act like they are the fund manager. And when they are losing money, they act like they are the auditor. So I don't know where does this exactly fall in terms of biases, but I think either people, they see the wrong data, or sometimes people act like they're arithmetically challenged. So I think that being objective, keeping mental balance, I think these are the really crucial things, according to me. And yeah, I agree with what Pratik mentioned, which is that, sometimes AIFs, how you structure the product can really matter a lot in terms of whether it will bring out the worst of emotional reactions or will you be able to temper it actually.
Understood. Well, it's very useful actually. And to your point, Kahneman later on wrote another book, which could also be interesting reading. It's called Noise, which talks about how decision-making gets distorted because of sheer amount of excess data and information out there, which is just not pertinent to the decision.
I found Thaler's book more interesting, which is on
that's the same genre of behavioral.
Bit lighter reading.
Yeah, it's true. True. Nalin, any examples of having used this in a sort of opportunistic context, or sort of using it to make money at your end?
In terms of what specifically, Swapnil?
I meant the fact that that. So one way, we'll talk about that with Mehul subsequently, where you tell investors that this is a good way to avoid these biases, right? But then there is a large mass of investors out there who might be driven by these biases, who we can't reach as advisors or managers and so on. Now, one can do the other thing, which is to say, for the investors who are my investors, how can I get them more money by virtue of making sure that the biases that others are expressing create some patterns of behavior, which I can, for want of a better word, use to my investors' benefits. Are there any obvious, simple examples of that?
So I'll just give you one very, very practical example, Swapnil.
Sure.
The AIF industry is obviously very new. It's only about 8-9 years old. And there are so many different funds, strategies, ideas that are mushrooming all over the place, not just in the listed space, but also in the unlisted space. One thing that has really helped us is defining a box that a fund or a strategy fits into. Because these boxes are very well defined on the mutual fund side. You know what is a large cap fund, you know what is a mid cap fund, you know what is a balanced fund, etc. But you don't have these boxes in the AIF side. So we've defined these boxes. And now when I talk to clients, I'm very clear upfront about when the fund will do well, when the fund will not do well, and who it is for and who it is not for. And I think this clarity has stopped 90% of problems that we have encountered with people. So, there's no math to this, but it's just common sense. Define a box, talk about when the fund will perform, when it won't perform, and who the customer segment is.
It's a very interesting thing you mentioned, because often enough there is a fluid line between the investment advisors and the fund managers. And my preferred mode of organizing the world is fund managers do what they're good at and are very precise about what that is. And advisors do what they're good at, which is to talk to clients and fit these into what clients need and what not. And so the more precise a fund manager is, the better it is for the advisors and the end clients to then say, okay, you're saying X, you will do X. And I want X or I don't want X, versus a black box where everything goes. So very useful thought there. Thanks, Naren. So Mehul, one question for you. If you're looking at reducing underperformance or improving outperformance using the fact that cognitive biases of investors, whether they are part of your fund or otherwise, using that to improve the long-only performance, if you will, right? The standard equity strategies performance. How would you think about that as from the investment management side, long-only investment management side?
Yeah, so thanks, Swapnil, for that question. And just carrying on from what Nalin was explaining, it's very important to be very, just very clear to the investors that you're bringing into the fund as to what your inherent style is, right? So what typically happens is every manager has a typical style, right? So there will be growth biased fund managers, there will be very value seeking managers. You just have to be very clear as to what your style is, what are the kind of companies you look for, and being very transparent in that understanding with the investors that you're bringing in. Right. What tends to happen is these styles themselves go through long periods of outperformance and underperformance, right? So over the last decade or so, and there's enough written about it, about how high growth, high ROE sort of businesses have done really well in the market, and let's say the value side of the market has not done very well. But that's not always been the case, right? If you look back into history, typically value has done pretty well. So there can be long periods of underperformance just based on the style of the manager. And therefore, it is important to explain that to the investors when they're coming in. What we are doing, and unfortunately, most investors don't seem to understand this, especially, let's say, the smaller investors, they're still coming to terms with some of these factor biases, is they'll come in after a factor or a style has performed really well, and a large part of the UM comes just after that. And usually the cycle just turns after that, right? And they'll redeem also at the worst possible time after the style has underperformed for 3 or 4 years. So what we're trying to do is not have extreme biases in our portfolio. What we are trying to be is be more consistent with our alpha. So we don't want to be, let's say, 20% alpha in 1 year and down to 10% the next year. I think more consistent delivery of performance will lead to better investor behavior, because then they'll not come rushing in at the worst possible time and redeeming at again the worst possible time. So we're trying to create a more balanced portfolio construction approach, and then all of this comes down to portfolio construction. You can buy the right companies, but just having the right mix of companies seems to matter a lot more in the long run also. So that's just in terms of portfolio construction, how we're approaching it. What is also important is in the investment team itself, right? So the analyst team and the fund management team that's present, you need to be very, again, not have herd mentality, not have one style, one thought process. You need to bring out different aspects of the team, different backgrounds, hire people from different backgrounds, just to get different thought processes going. And it helps a lot. So what we've done, for example, is we have a Wednesday team meeting where the entire team, including all sector analysts, the entire portfolio management team, sits in one room. We spend, we've divided the day into 3 sections. So we have an analysis section where we discuss companies, new stock ideas. And again, all sector analysts also sitting there. So even though we're discussing a pharma company, the financials analyst is also sitting there, giving his thoughts. It doesn't matter that he doesn't have domain knowledge there, but just giving his perspective on what he thinks about the stock pitch. That helps a lot, just bring out some lateral thinking. What we also do is do a lot of introspection. So we look back and see, what worked, what didn't work, what could we have done better in the past. And obviously there's a lot of learning. So we have a book club, for example, where actually I had presented on the Kahneman book. So there's a lot of learning process. So I think, all of this is just to reduce the biases that we have and deliver more consistent returns through time. And I think that's all we can do as, as a portfolio management team to help the investors.
Got it. Understood. It was very pertinent as well, because I've always felt like investors oscillate between these two risk on, risk off modes. When it's risk on, then anything goes and they just chase yields like there is no tomorrow. And risk off when they might steer clear of even quasi-sovereign debt, saying I just want government security and nothing else. So and that's the way of the world so far. And the closer investors become the balanced approach, I guess the better it is for them also. Now, this specific topic of behavioral alpha in AIFs, right, that prompted me to think, is an AIF structure a necessity for behavioral alpha? And so in that context, Rajesh, my next question is to you, that does capturing behavioral alpha require shorting or leverage or leverage, which then obviously is much more feasible inside the AIF structure than a mutual fund or a PMS structure? What are your thoughts on that?
I hope you can hear me.
Yeah, we can. Please.
Okay, excellent. So, before I answer that specific question, I think this psychology of human misjudgment is all pervasive. From being an emotional wreck to evolution to a very rational human being. That's the journey that mankind is taking. But it manifests itself more starkly in the capital markets, right? So that's why we probably see it. One thing that I can tell you is the antidote to that, and that's what we try to build in our culture as an investment firm, is really to emphasize 2 things. One is independence of thought, right? Come to your own conclusions is what I encourage, our people to kind of use that as an antidote to this emotional wreck that manifests itself in capital markets. And the second is I always encourage, our team to think in terms of second derivative. As Ashish pointed out, let's say if, the markets are down very badly in March, the question to ask is, of course, there are all these problems with COVID, but is it there in the price? So thinking in terms of second derivative is really the antidote, apart from independence of thought, that you encourage in the culture. So the way I think the question that you have posed is, are AIFs designed better to generate alpha relative to, let us say, PMS and mutual funds? Of course. Don't ask Babar if you need a haircut. I run an AIF. So, I think there are 2 things that really strike out for me when as an AIF fund manager, a long-short equity fund manager. One is this, ability to navigate equity markets while reducing risk when markets kind of look, as if they can fall disproportionately and increasing risk. Now, imagine if in February or March of last year, when the markets fell 35 or 40%, you were able to protect capital, in fact, make some money. That's a very, very large value add that you can make, as a fund. That's a huge alpha that you've already created. So this one ability to protect downside is an extremely important value add that a long short fund can bring to the table, right? And, as Warren Buffett says, rule number 1, don't lose money. Rule number 2, never forget rule number 1. So I think markets and investors tend to underemphasize this ability to protect capital and how much it contributes to making sure that you make an attractive return over the long term. Protecting downside is definitely one of them. The second is, the ability to short, as you pointed out. Now, if I am a fundamental fund manager, the ability to look for ideas on the short book actually enhances my canvas, right? And look at it this way. There is very, very, as Nalin pointed out, there are very, very few AIFs in the long short format in India, which means that there is virtually absence of competition in the domestic institutional market as far as shorts is concerned. Now, some people would argue this is one of the most disruptive times for businesses ever of humankind, which means business models are getting disrupted, right? Cost structures are getting disrupted. Delivery models are getting disrupted. It's a great time for you as an investor to identify companies in decline. Where is the newspaper business? Where is the radio business today? Look at how e-commerce is challenging retailers. Payment platforms are coming up which may influence banks. Look at electric vehicles. So this is such a disruptive environment that having the ability to short is an enhanced ability to generate alpha. So I think both those 2 points, the ability to navigate markets and protect capital as a process, by the way, not as, we don't navigate markets by our judgment, but also through a part of process which makes it consistent. And the second one is the ability to short. I think certainly both add up to generating alpha as far as the AIF is concerned.
Agreed there, because I guess I've been a barber too in a previous avatar, so I know that shorting does go a long way in generating alpha. Whereas a fundamental manager who doesn't like a stock, constrained by long only, will be forced to just say, I don't like it, I'll leave it out. A long short manager can actually say, I will short the stock, which I don't like. Yes. So it's very, very pertinent. Pratik, you spent a lot of time in the passive investing space, and I'm sure you've done a lot of research in the background, and the Vanguard example you gave was in a similar vein. And we see the global trend now that in September 2019, the actively managed AUM actually, the passively managed AUM in US crossed the actively managed AUM, indexing plus smart beta and so on. As this trend reaches India, do you think that the advent of smart beta, indexing, and other rule-based investing will change the texture of behavioral alpha or alpha in general, but more specifically behavioral alpha in the Indian context?
Yeah, sure. Coming to the data about the US markets in the last 10 years, when you said that this data actually only talks about the mutual fund industry. So in the mutual fund industry itself, you have seen that active passively managed funds have outperformed the actively managed funds. But if you look at a lot of the active money that actually left the mutual fund industry and gone towards alternatives. So if you see the curve of alternatives in the US, it's actually exploded over the last 10-50 years. So a lot of investors are now looking at using alternatives as a platform, to get access to more flexible strategies. Whereas the mutual fund construct right now is a little bit difficult or getting difficult for a lot of investors or managers, especially in efficient markets like the US, to be the benchmark. So that's typically what has happened. But coming to smart beta strategies, I think there's a 50-50 sort of an opinion on smart beta. I think a lot of investors, especially the sophisticated investors, if you look at performance over say 15-20 years, have seen that smart beta is actually not as smart as what people think. I think the initial, I would say, a perspective of smart beta is that it'll always outperform. But what we realize is that there are sort of, especially if you look at factor strategies, which are becoming extremely popular. There are, as Mehul pointed out, there are sort of time periods when certain factors outperform others and underperform others. So I think that it requires an element of market timing, which is why retail investors should probably not really meddle too much with factor indices and stick with something simple. But I do feel that rules-based investing is something where, especially in the behavioral alpha, in context to our conversation today, it not minimizes but actually eliminates a lot of these biases, at least from the fund management side. So I think a big issue when it comes to fund management for what I've seen, is actually style drift. Style drift is, what was your strategy and philosophy, and what has become of it due to changing market conditions. And it's perfectly fine if it's if you're doing it intentionally. So just to give an example, Warren Buffett used to be only a value investor, but then Charlie Munger came in and introduced him to Coke and all these growth stocks. So now he's sort of a combination. Now he's going to tech stocks as well. So I think it's perfectly fine to change your strategy, but it has to be intentional. But a big problem, as I said, when it comes to the sort of traditional ways, is this style drift, which is unintentional, which causes problems over the long term. So I think that's where really rules-based strategy really comes in, and investors who are able to understand it, or who are able to understand or see it from a 3 to 5 year perspective, can really benefit from them in a big way.
Got it. Understood. Super. So Ashish, one question for you on the context of how real life investors, what behavioral changes, simple ones, right? Because the list of actual cognitive biases is so long that it'll take us like next 20 years to try and correct each one of them, including ourselves, right? But which would be some 2-3 big examples you think this will get like the 70-80% of the benefit, hopefully, of more disciplined investing for better behavioral alpha? Having seen so many investors now over so many years, what are those 2-3 things that you can leave them with? Like, do these three things.
Yeah, see, I just wish that investors made some notes of their own experiences and their own behaviors. A couple of minutes back, we were talking about behaving on extremes. In fact, there was a point in time in a meeting, I actually told one of the investors that, sometimes when I meet you, you want to invest in State Bank deposit, and sometimes when I meet you, you want to straight away buy Unitech. I mean, there is a world in between, right? So
yeah,
I think if people are able to make notes of how they reacted at different occasions through different parts of their journey and revisit that. So, look, because what can we say about ourselves as professionals? The fact is that investors' belief in us itself goes through cycles, right? So I think we can't be really teaching or preaching, but behavioral biases, somebody else can't really drill it into you to behave differently. Even Rajesh mentioned that this is about evolution. It's like a big thing. It's much deeper. So I feel that if people made notes about how they reacted to different situations at different points in time and revisited those, I think clearly it would be a big achievement for them at a individual level itself. I think that is one thing which would be amazing. Going further, I think that we all have a big role to play, in terms of, if you see the mutual fund industry, or like Rajesh described about long short, I think how we construct products, I think that is the big thing. Even Mehul mentioned, and I have personally seen it also, that when you have a particular style, the style can go in and out of favor, needless to say, and your outperformances and underperformance can get exaggerated. So how do you ensure that you are in a slightly narrower band? I think this is something like, according to me, for example, if there was a product in India which gave 9% return with lowest possible volatility, I think eventually that would be a hands down winner. That's my personal thought process. That's how I think. I mean, because what happens is when you go and show literature, everybody gets enticed with 20%. And the other problem is CAGR किसी को समझ में नहीं आता, because you tell somebody 20% CAGR, he thinks it is 20, 20, 20, 20, 20. People don't understand that 20% CAGR is plus 60 and minus 20 and then plus 2 and then 0 and some such crazy bunch of numbers. CAGR समझ में नहीं आता है. So then what's the choice? The choice is that if people can, really work hard, and I think some of these long short funds, or what the mutual fund industry tries with multi-asset funds, anything which narrows the range of outcomes, I think that's helpful, I guess.
Got it. No, it's very useful because a lot of innovation has been happening on this front about combining multiple relatively uncorrelated streams of cash flows or assets and so on. So that's my question to both Mehul and Nalin. As money managers or as fund managers, do you prefer a fund of funds approach where each fund is a separate unit which has a strategy and a separate fund manager and so on, and then there's a fund of fund which then tries to take it to a investor or an advisor to take to investors in turn, or a multi-strategy single fund, which then has maybe a single team which does different individual strategies? I understand it's not a either or, but what's your preferences? Mehul, if we can start with you and then go to Nalin.
Yeah, I guess again, probably a biased answer from my end, but I would say, if you had to invest in a long only equity product, you probably want to choose one manager who's managing, based on, as long as you're comfortable with his style and process, you want to choose him to invest with. I think a fund of funds probably works better in terms of asset allocation across different asset classes. So between fixed income, equities, currencies, whatever else there is. But I think in equities only, maybe in passive products, you can, create these, multi-factor type strategies, etc. But as a pure active equity fund manager, I would say, we are trying to do the diversification already, right? I mean, like I mentioned earlier, we're trying to balance our approach between, let's say, growth, secular growth sort of businesses, some value orientation, some defensive. So we are already constructing a diversified portfolio and trying to reduce some of these factor risks and style biases that are there to increase our, returns through just bottom-up stock selection. So I think we're already doing that. I mean, that's what I would say as a fund house.
Got it.
I guess.
Sorry. Thanks.
Swapnil, my thinking is very clear on this. In the mutual fund space, please understand that today, even on equities, there is a 10% long-term capital gains tax. Okay. So rebalancing is not free for investors. And hence, the role of balanced advantage funds, multi-asset funds is very, very important in the mutual fund context. Right. And Naren and ICICI have demonstrated that with the balanced advantage category. Mm-hmm. And there is an opportunity to do very thoughtful stuff, which Prateek has started on the multi-asset front.
True.
In contrast, when you come to the alternative space, AIF and PMS, you're investing for a specific alpha, for a specialist, for the best-in-class manager. You don't want to diversify. You don't want multi-strat kind of things there. So pick horses for courses. And I think the thinking is very, very clear on this front.
Got it. It's in similar lines to what you mentioned earlier, which is avoiding boxing it, right? If you're boxing it, then it's single strategy as much as possible. Is that right? Sweet. Super. So thanks everyone for the insightful answers. I'll open this to a Q&A as Aditya mentioned. And I think Mehul, you had a meeting to switch to. So
yeah, thanks a lot, Swapnil.
Thanks, Mehul. Please carry. Aditya, we are ready for Q&A if there are any questions.
Sure, Swapnil, just a sec. So audience, if you have any questions, please quickly use the Ask a Question tab on your screens. Let's just wait for a minute or two. Let's see.
Sure. So just to summarize for the audience benefit, we talked about the definition of the term at the beginning. We looked at some examples of behavioral alpha. We looked at how behavioral alpha applies in a long-only context, in a potentially long-short context. In what sense will it get affected by the rise of smart beta or indexing and so on. And we also went through a little bit of investor side understanding of how investor behavior itself can create biases which have, I guess, the negative of alpha, which is loss due to cognitive biases. And we spoke about how they can improve their own investing styles, talked about fund managers being multi versus single strategy focused. And yeah, I guess that's the long and short of today's overall session. Aditya, you will tell us if there are questions.
I'm just waiting. So we don't have any as of now. So I believe you guys have already given them a lot to chew on. So maybe we can just wind up the session.
Certainly.
Of course, all the speakers are available on LinkedIn, and I'm assuming Twitter as well. So any audience, any of you want to reach out to them, feel free. They'll be more than happy to take your queries there, or help you with any kind of insights that you're looking for. So I'll just make a last try to see if there are any questions. No. So I think let's wind up.
Great. Thanks, Malin. Thanks, Ashish. Thanks, Prateek. Thanks, Rajesh. And thanks, Aditya and team for getting us on this panel.
Thank you.
Pleasure. Thank you, everyone.
Thank you, everybody. Thank you.
Have a good day. Bye.
Bye, guys.
Hi, Sid.
Hi, are you able to?
Yeah, I will just post disabled participation of screen share.
Are you able to? No, no.
Hey, hi, Siddharth, Vivek, this is Aditya.
Hi, Aditya.
Hello.
Sorry, Aditya. I think we've had some bit of a. My whole area has got a power outage, so my Wi-Fi, everything's off. We're trying to see whether Vivek can share because I'm using my cell data.
Sure.
I don't know how reliable that would be, but we're just trying it out.
No worries. So I've made both of you the co-hosts.
Okay, perfect. So then he should be able to share at least the screen, the slides he can run.
He can run. Yeah, yeah. It's visible. Yes.
Okay. And Vivek, full screen karke dekho.
So we start at 2. Yeah, 2, 2, 5.
Yeah, we started 2, so we were just doing the testing.
So we just wanted to test it.
Sure,
so
sure.
Sid, can you see the screen?
I can.
Okay.
And then,
you see it moving?
Yeah, can you give me the, is there a way to give control or no?
I don't think so. I can give control.
Achha, that's only on the MS Team. Okay. So then maybe I'll
So there's a remote control. You can try that option.
okay. Can you, okay, request remote control. Okay, I'll do that.
Yeah, so I have approved it.
Okay, so then I should be.
I am on.
Okay. Yeah, I think this should work.
So I'm going on mute then.
Give me 1 second. I'm not able to change. Okay. Do a page up, no? Okay, I think this works. Should we log back after a bit, Vivek? Yeah, Vivek.
I'm fine with it.
Yeah, that's okay. Okay. Yeah, sorry, I'm on both the. I think you are on both. Okay, fine. No problem.
So I can see you now.
Okay.
I think piche ka door. Okay, yeah, you blurred the image.
Because I mean, I'm like, it's really hot and I have to open the.
So you can remove the jacket, no?
I've sweated so much.
Okay.
It helps me cover it up. That is on YouTube abhi live. Okay. Okay, we'll log in now. I think 2 o'clock. Should we stay on or what?
Yeah, so it's almost like 5 minutes left, so we should just stay on.
Okay. Okay.
Okay, sir.
Hi, Siddharth. We'll just wait for a minute or two for the audience to join in, and we'll get started accordingly.
Sorry, no problem. I think that's fine, Aditya. Maybe if we give a couple of minutes more, my data's come online now, so maybe I should be able to run it.
All right, so can we get started?
Yeah, I think that should be fine.
Okay, super. So thank you, Siddharth, joining in. Thank you, Vivek, for all the supporting role you're going to play today. So audience, we are moving into the post-lunch session, and I think this is a very, very interesting session that we have lined up for you on all the recent developments that are happening as far as GIFT City is concerned, and in relation to the AIFs. And we have with us Mr. Siddharth Shah, who's the founder, who's a partner of Khaitan and Company, one of the leading law firms in India. Siddharth comes with more than 25 years of work experience in corporate and funds law work, and has done advise a large number of onshore and offshore clients on matters relating to fund formation across asset classes, structuring of bespoke investment management platforms, REITs and InvITs, securities law, regulatory matters, foreign investment law, and other related matters. In addition, as a corporate lawyer, he also assists clients on matters relating to private equity, venture capital investments, real estate, mergers and acquisitions, and joint ventures, as well as corporate restructuring. So Siddharth, thank you so much for joining in. We have a half-an-hour session. I believe you me, I mean, since we've been having this event for last 2 days, I mean, this is the third day.
I know.
And in so many sessions, there have been so many questions around GIFT. So I believe this is a very, very, much awaited session, and looking forward to all your insights. So over to you. To quickly, before you start, this event is divided into two parts, as in the speakers have joined on the Zoom, and the audience is watching us live on a virtual event platform.
Okay. Okay.
So audience who've just joined in for this session, I mean, and do not know the process, so you can. So there is a ask a question button on your screen. Once Siddharth is done talking, if you have any questions for him, please feel free to put your questions there, and I'll be happy to take those questions on your behalf. So Siddharth, over to you.
Okay, thank you, Aditya, and thank you, AIWMI, for inviting me for doing this session. I think we've been closely associated with Aditya and team, and I think they've been doing a fantastic job as an association, trying to bring the forum to really deliberate on policy issues and also kind of disseminate knowledge. And I think we are definitely very, very happy to be associated. And I think I've also been privileged to be speaking at some of these events. Maybe in normal times, we would have all been physically be present, but I guess new challenges always teach us new solutions. And I think maybe the virtual world, which seems to be a reality now, I think we have all got to adapt to it. And here we are for a 3-day, as Aditya said, virtual event. And I'm sure the takeaway for all of you from here probably would be as much, if not more, valuable to your businesses. So just, I think, coming back to the topic, and I thought for the audience here and for the industry at large, and at least as someone who has seen the development of GIFT and the funds regime within GIFT over the last several years, I mean, right since its inception, and then we've been fortunate enough to be a part of the policy evolution of the AIF regime in GIFT. It has been an amazingly satisfying experience, if you may put it. I think GIFT, which was always something which was heard of, but someone was never sure whether they would want to be there. I think today, 2020, while for the world may be a year which most of us can write off on many counts, I think the last 12 to 24 months, to be more specific, has been the period where the authorities have been in an overdrive, policymakers have been in an overdrive to really make GIFT really as vibrant and as beneficial for the participants that it can be. And I think that's really where we see that it's at the cusp of a serious takeoff, especially from a private equity industry perspective. So, I mean, I'm sure all of you must be seeing these headlines, and I thought it just gives you some perspective of how GIFT has really been and catching and hogging to a certain extent on the headlines today. And it's really come up as a very serious contender today to any other international financial services center. And a dream which probably looked very distant. Today, you can actually see more and more number of players across the asset classes. So AIF is definitely one very important asset class that GIFT looks at. But I mean, whether you talk about aircraft leasing, whether you talk about global insurance underwriting, banking, bullion, I mean, you name it. And I think GIFT has really gone all out to really create framework which facilitates and positions itself as a globally competitive international finance center. So I think it's a great fulfillment, if you may put it, to see GIFT really kind of coming of age. And that's also pretty true for the AIF industry. I mean, just a very quick snapshot of what we have seen in a recent kind of changes. I mean, obviously, GIFT has now announced operating guidelines for investment advisors and portfolio managers. I mean, while the AIF regulations, which we'll cover in more detail as we go along, but there was a big demand from the industry because it's one of the big segment that GIFT intends to target is portfolio managers and investment advisors. And in absence of a framework for them to set up base, it would have probably, its growth would have been stunted. So GIFT has already addressed that and come out with the guidelines. They've also introduced products for rupee derivatives, currency futures, option contracts, bullion spot delivery contract. And again, I think while it is yet to take off, but having done a lot of groundwork with the authorities there, what we hear from the experts and people who have been advocating this, India could become one of the largest we are already one of the largest consumer of bullion in the world, but we never have an active, we were not the largest trading platform for the world. And I think GIFT can change all of that when the bullion exchange goes live and the spot contracts on bullion becomes tradable. Obviously, you've seen GIFT has already come out with its own set of guidelines, both for REITs and InvITs. So a lot of it borrowed today from the existing, but very interesting framework changes, which makes GIFT far more global than what you would typically see in respect of the domestic REITs InvITs. So these InvITs and REITs can also invest in assets abroad, and it can really provide a very interesting platform for those who want to kind of play across boundaries on these asset class. So GIFT has already put in place the framework, and I'm sure this is something which will take off in a big way as Indian managers become more global in their outlook around these asset classes. Aircraft leasing and global in-house centers, again, a brilliant initiative to kind of bring a large industry, multi-billion-dollar running into even more trillions of dollars of aircraft leasing, which were typically centered in tax havens globally. I think the idea was with a very conducive framework that exists in GIFT, why not kind of encourage people to set up these businesses over here? And similarly, global in-house centers, I think the back office operations for global houses in terms of whether it's the finance functions or any other strategic functions, I think it will be something which has been notified as a part of the services eligible to be set up in GIFT. So we will see it as a global headquarter scheme in some form really coming up on this. Also, the regulatory relaxations, I mean, AIF regime was introduced in GIFT first time in 2015, but they've been constantly kind of Yes, I'm extremely sorry for the interruption. I think we've been having some serious data outage and power outage in the. So please bear with me, and I think sincere apologies. Vivek, I hope I'm audible. Vivek, can you confirm if I'm audible to you?
Siddharth, you're audible. Go ahead.
Yes, Siddharth, you're audible. Yes.
Okay. Fine. So, yeah, I think just to complete, I think let's move to the session, which basically focuses. We have tried to divide this presentation in 4 parts, and maybe I'll quickly run through each of this. Part A will be on the structuring considerations for an IFSC AIF. So why don't we move to part A? Vivek, next slide, please. Yeah. So I think, as I mentioned earlier, I think the current framework of a GIFT AIF was really derived from SEBI AIF regulatory framework of 2012, and it was suitably modified by us to kind of create guidelines for AIFs which are organized in GIFT City. And this was the first exercise which was done in 2015. And since then, of course, IFSC authority has now taken charge and is completely operational. And now, as probably most of you know, IFSC authority is a unified regulator and has all the powers across all these sections relevant for the financial services business, and hence is now a single point authority which can approve any entity setting up operations in IFSC. And as a part of that, they've also come up with their own set of guidelines, as I mentioned, for REITs and InvITs, and now also for AIFs. It will be governed by IFSC guidelines for AIF. Currently, it still borrows a lot of these from the SEBI AIF, but over a period of time, they may come up with their own code for alternative investment funds, which could look very different from our onshore AIFs and maybe more aligned to how you would see in global international finance centers, whether it's Singapore, Mauritius, or elsewhere. So I think that's still an evolution which is going to happen. Similarly, also on the choice of vehicles for AIF, again, IFSC also offers you the same choices between a trust, LLP, or a company. And I think you can choose either of these for the setting up of an AIF. While traditionally and onshore, we have seen strong preference for trust for a variety of reasons in terms of flexibility, etc. But I think you will see that with the changes that they've made in the corporate law or even in the partnership LLP regime, you may see increased number of players within GIFT also evaluate LLPs and possibly corporates as well, because those are more acceptable forms globally for LPs, and GIFT is an international finance center. So while yes, trust will continue in the meantime for the domestic guys, I think you might see more and more LLPs and even companies being used for AIF purpose. Also currently, as I said, there is the categorization of AIF is still there, Cat 1, 2, or 3, similar to what we have under the SEBI AIF regulations. However, there are obviously lesser, or there are exemptions which have been made on the investment conditions for each of them. And also, as I said, as it evolves, you may see these categorizations, in fact, go away. For example, today we don't have such requirement to categorize oneself into 1, 2, or 3 in a jurisdiction like Mauritius or Singapore. And then similarly, as the regime evolves, you will see a unified regime as well come into play. Next slide, please. So if you talk about the framework, I think very, very similar today to AIF, except a lot of the financial thresholds have been converted into dollar terms, because obviously it's an international finance center. So minimum corpus for a Cat 1 is 3 million, for all 3 rather, so which is the 20 crore. which is the current requirement, has been translated to 3 million. And then for angel fund, it is 750,000. Same requirement of continuing interest from the sponsors in dollar terms. So 750,000 or 1.5 million in case of category 3. Borrowing, I think this is a change or deviation to what you see in our onshore regime. Currently, Cat 1, 2 AIFs are not allowed to leverage, whereas in December 2020, the IFSC authority removed those restrictions. And accordingly, both Cat 1 and Cat 2 are also allowed to leverage in IFSC. However, as long as they are making appropriate disclosures and risk management framework is implemented by them. So this is again a change or deviation to make the regime more comparable to any other global international finance center. What are permitted to be invested in? Securities which are listed in IFSC, securities issued by companies incorporated in IFSC. So the first one could cover foreign securities which are listed on IFSC exchanges. The second one really are companies or entities which are incorporated in IFSC, can also be participated in by the AIFs. Third is securities issued by companies incorporated in India or foreign companies, and that would also overlap with the offshore, the first one as well. But even Indian companies can be invested into units of other AIFs set up in IFSC and India. So you can use your AIF in GIFT to become a feeder to either underlying AIF in GIFT or to AIF onshore. Other permissible investments as permitted under the AIF regulations, so like partnership interests in LLPs, SPVs, REITs, InvITs, all of those are permissible under the AIF, GIFT AIFs as well. Other interesting change, co-investment and segregated portfolios. As we all know today, on the onshore AIFs, while in the past you may have seen structures which allowed creation of co-investment class of units, but SEBI has taken a position that going forward that would not be permitted in case of onshore AIFs. However, GIFT AIFs will have the flexibility to create segregated portfolios for co-investment in co-investors. So you can have a blind pool and you can also have co-investment class of units issued to those investors who are specifically participating into certain identified investments. And to that extent, obviously, as we go along, I think the limits will also be removed in terms of the single investment limits, etc. And of course, appointment of custodian, the same qualification applies as well. Next slide, please. Okay, so I mean, minimum investment by the investor, by employees, and by other investors. I mean, the same 1 crore threshold translated to roughly $150,000 for global investors. And for employees, it's $40,000. The process really requires you to invest in, I mean, Form A, which is you have to apply. For you, the authority one applies will only be IFSC authority, so you don't need to separately apply to SEBI for its approval, and the registration fees are as stated over here. Also, I think eligible investors in IFSC AIF today includes non-residents, persons who are not resident in India, who's an NRI, financial institutions who are resident in India but are eligible to invest overseas. So anyone, and this would be treated as an investment overseas by an Indian resident today. And hence, whoever is eligible to make those investments will all be eligible. Besides the LRS, which I just mentioned, has been also enabled to that extent. So the framework is very flexible, very comparable today, with important deviation to allow more flexibility. And hence, anyone evaluating today a fund focused on India would definitely and should definitely evaluate GIFT as a very viable alternative to whether it's Mauritius, Singapore, or any other offshore jurisdiction. Next slide, please. So this is how a typical kind of AIF setup would look like in GIFT. I mean, you can have the flexibility for the AIF in GIFT to directly invest in portfolio companies or to act as a feeder to a domestic AIF, as you do in case of a unified structure with a Mauritius feeder. You can kind of very easily replace that with a GIFT AIF. And then among some of the benefits which, so this is where you will need an AIF manager in GIFT City. And that also has been allowed to be done either in the form of a subsidiary of an existing AIF manager, or even a branch of an AIF manager onshore can be set up in GIFT. And then obviously there are, we'll cover the exchange control considerations. So this is how a typical GIFT structure would look like. Next slide, please. So I think, as I said, it is a deemed foreign territory. So obviously a lot of exchange control restrictions which otherwise apply to AIFs don't apply when it is a GIFT AIF. It's really designed to, also an important one to note that today onshore AIFs have a limitation on how much they can invest overseas. And more opportunities, especially startups which are being set up as global holding companies, you do see a limitation around that when it's capped at 25% of the corpus, and you need approvals of SEBI for that. The moment it is a GIFT AIF, there are no caps. There is a freedom to really invest overseas more freely. And I think that's really another reason or purpose why one would want to evaluate GIFT AIFs, which with this flexibility in mind. Can you move to the next? So I think if you go look at the benefits, which I've tried to quickly summarize, very convenient location for domestic GPs. I mean, it's always going to be a challenge for you to create substance base in Mauritius, Singapore, going to be far more expensive. And hence you can more easily create substance in GIFT. Tax treatment is very, very comparable to any of these jurisdictions. So in that sense, and at times even more favorable, especially for certain streams of income like interest, etc. The withholding today is down to 5%, which is probably the lowest compared to any other treaty jurisdiction. So in that sense, very, very competitive. Also, it gets the same tax pass-through. So for LPs who are availing any treaty benefits or exemption, can easily participate into GIFT AIFs and enjoy a pass-through benefit for their underlying investment, both through the feeder structure or direct investment structure, which may not be possible for a Mauritius or a Singapore or any other offshore feeder structure. Also, India being an FATF and GIFT being a part of Indian sovereign territory, it is FATF compliant. So all the benefits of a category 1 FPI, for example, all of those will be available for GIFT-based entities, as well as lesser scrutiny as global anti-money laundering and other regulations are evolving fast around that. Cost of operations, definitely an advantage. They are treated, and an entity is incorporated, set up in GIFT will be treated as tax residents. So if you are using any global treaties, you should be eligible to claim those treaties as well. And also, I think there is a proposal to make the 9A, which is the safe harbor rules for managers based out of GIFT, to make the regime far more flexible and encourage people to manage global funds out of GIFT. So that framework is also under works, but I think they have also given permissions for such manager entities. So you can easily manage global funds out of GIFT. And also, as I said, you can invest overseas. So this becomes a very, very useful flexibility. Moving to the second part of the session, can we, next slide, please. So here about the manager. So as I said, the manager set up in GIFT can be either by way of a subsidiary or by way of a branch of an existing AIF manager. Please note that the branch option is only available for an existing AIF manager and not otherwise. Otherwise, you will need to essentially go and set up as a GP, you will have to set up a subsidiary. And what that means is that you may need a approval of RBI. So if it is a branch, then generally it should be covered under automatic route. You can go through your authorized dealers, and that should actually allow you to create a branch without need for an RBI approval. But on the other hand, if you are doing it as a subsidiary, it will be treated as an overseas direct investment. So to that extent, that would be required. And of course, liability-wise, branch is not a separate entity. Subsidiary would be a separate entity. And then, of course, there are some of the other restrictions that come up, but you today have a choice of both branch or a subsidiary. Next slide, please. So tax consideration, very important, I think, for manager. The incentive that exists is that you have 100% tax exemption for a 10 consecutive period. So, I mean, you out of 15 years. So you can choose your tax holiday. So that really makes it a very attractive proposition for the manager. There will be a minimum alternate tax, which is at 9%, but that's again creditable against your tax liability as and when that accrues, so that you do get a benefit of a set-off, but still a very attractive regime compared to most other offshore centers as well. For example, Singapore has a business tax of 17% for a manager, unless you go for some exemption schemes. Also, I think there is exemption from GST, so which is the other big saving in that sense. And then, of course, any distribution made by the manager. So while the manager will enjoy the tax holiday, but when they make a distribution to the parent, whether it is a parent holding company or a branch making distribution, all of the exemption would continue to be available for the entities there. Next slide, please. Substance requirement obviously is a question which always remains on the top of the mind. Yes, you will be expected to create substance on the ground. What is sufficient substance? I think today, in absence of any other guidelines, one would use the same GAR conditions which one would need to comply with for a Mauritius setup or a Singapore setup. So you need to have employees, you need to demonstrate that there is an office, decisions are being taken out of GIFT, key decisions. So it is not going to be a shell company regime, and hence you will need to invest in creating necessary substance over there. So that's something which you should, but I think GIFT authorities are practical about it, and then one needs to engage actively with them. Next slide, please. I think carried interest, again, I don't want to delve into it, but you can have the flexibility of structuring it as a performance fee and enjoy a tax holiday. You should evaluate the pros and cons, but that's a flexibility which would be available for the managers based out of GIFT. Next. I think tax considerations for AIF, as I said, there will be a tax pass-through for the AIF set up in GIFT, like in case of onshore AIF as well. Category 3 AIF, however, again, the same regime has no assured pass-through. And then the same thing will be provided exists in the category 3 AIF as well. Also, income from offshore investments, if you are investing overseas, that income is tax exempt, which again means that it becomes a very interesting regime for people looking at investing globally. Also, income from onshore investments. So if you are investing in India, I think you will, there is no, IFSC does not enjoy a specific treaty because it's really an Indian territory. So the normal tax rate would apply in case of the capital gains, for example, as a non-resident is at 10%. I mean, the same rate would apply and same thing will apply for interest or dividend. But any distribution from gift to others, there are obviously a much lower withholding taxes which would be applicable. So to that extent, I think you definitely have a regime which is going to be very tax efficient or at least tax neutral for global investors in many ways. And I think that's really where gift really makes it a very, very viable option. Next slide, please. Transfer of AIF, again, as I said, no specific exemption would be taxable like any other this thing. AMT is applicable where this AIF is set up as a trust or LLP. However, the income stream, if it is eligible for any exemption, would be applicable there as well. And the very important one is really the concern till about last year was that anyone investing in gift was required to obtain a PAN number, file a tax return in India. The exemption was given for Cat 1 and Cat 2 AIF from these requirements, which becomes a big facilitator. But just about yesterday, day before, they've also exempted, even for Category 3 AIFs, a requirement of having to obtain a PAN or filing of tax returns. So I think that is a very, very significant change that one needs to. So I think it's a very, very conducive tax framework to summarize for AIFs. Next slide, please. I'm mindful of the time and I'll try and quickly. This is just an indicative step, which I think we can leave with the audience, but basically you have to apply for the name, or whether you are setting up as a branch or a subsidiary. So that you apply for setting up of an entity. You need to identify an office space. It is a designated area and you need to have an office space within that zone. So you and gift authorities are more than helpful to find you an appropriate place at an cost-effective basis. You have to obtain an NOC from the regulator for setting up. So if I am a onshore AIF manager or a portfolio manager, I may need a SEBI NOC, like in case of any other overseas investment. So those requirements will need to be complied with. You will need to apply to an authorized dealer for a branch setup of a manager, etc. You can appoint a trustee for an AIF and a trust deed which can be registered over there. And or an LLP if the AIF is setting up, and then you'll have to incorporate that LLP with registration in GIFT. You have to apply to the Development Commissioner of the SEZ. It is an SEZ area, so you have to follow those protocols of applying to an SEZ authority, which will give you the approval for setting up a unit in an SEZ, and subject to that, IFSC authority will also grant you an approval as an AIF manager and as a sponsor. So it's a process which is well streamlined, and I think constant improvement to shorten the process and timeline is something which gift authorities are very actively working on along with IFSC. Timelines, I think, next slide, please. Typically, I mean, one should, it like any other global setup as well, I mean, but with a relatively new regime, factor in anywhere around 3 to 4 months, or at times can stretch to 5 because of RBI approvals to that extent. But because IFSC is a unified regulator, you are not running around to deal with multiple regulators except for your RBI or SEBI NOC for investing there. It has been extremely prompt, and they are very, very business savvy. And those who have dealt with some of the other regulators, which actually have business development cells to facilitate applications, IFSC works in a very similar basis. So we have been very, very impressed with the way they have tried to address issues faced by applicants to that extent. And I think as we go along, we're going to see more and more number of AIFs being set up, and the process will get further streamlined, and I can only expect this timelines to get further crunched as we go along, as the authorities also get more and more familiar with this. So I think with that, I'm pretty much at the end of my session. Thank you very much. Apologies for the break that came out in between the sessions. So sorry about that, but I do hope you'll take away some useful inputs for your business plan as you go along and evaluate GIFT. Back to you, Aditya.
Yeah, thanks, Siddharth. That was a pretty useful session. So audience, if you have any questions, quickly put. We have another 4-5 minutes to go, so we can take another few questions for sure. There's already a question for you, Siddharth. I'll read it out.
Yeah.
Is there, if there is no intention to raise money offshore for an AMC, does it make sense to register under GIFT City and launch AIF under GIFT City?
So if the idea is not to raise any money at all globally, then the only situation where you may want to still set up a GIFT AIF could be if you want to use the LRS money from residents to invest abroad. Then an AIF would still be a very viable alternative. If not, then I don't see a purpose of if there is no pooling of money being set up. As an AMC, you may want to set up a base to manage global funds. So you may not need an AIF, but you can still set up your operations either as a portfolio manager or as an investment advisor and freely manage global funds out of GIFT, which do. Sorry, I am really sorry. I don't know whether, Aditya, were you able to hear my response?
No, the voice, it broke. So if you can just repeat.
Yeah, no, so I think if you are not pooling investors, the only purpose where you can think of an GIFT AIF would be one, for you to invest, raise money from Indian residents, LRS money to invest abroad. Second, as an AMC, you may still want to set up a base, not as a GIFT, but as a manager or an advisor to manage global monies or institutional money out of GIFT. And that could be the other purpose for an AMC to set up a base out there.
Okay. The next question is RBI approval required for an AIF to set up in GIFT?
So again, as I said, RBI approval is not necessary to the extent, and it is driven more by the ODI regulations and your eligibility to go under automatic route. So to a certain extent, as I said, if it is a branch, then there is an automatic route available to remit money through authorized dealer into a branch. And then a branch as a manager of an AIF may contribute into the fund. I think to that extent, the view has been that you may not need a separate approval. Setting up a subsidiary, then you will be guided by the ODI regulations of RBI. And if for the sponsor contribution portion, at least today, the view is that you may end up requiring an RBI approval. Very soon, we are hoping that with the IFSC authority engaging quite actively with the policymakers and RBI, you might see a regime where this approval may be done away with, and only IFSC authority becomes a unified approval even for that purpose. But today, you may need an RBI approval for sponsor contribution.
Sure. Moving on to the next question. Considering the concessions granted in GIFT City, how much market for AIF do you foresee for GIFT City?
I mean, I think difficult to put a number, but I'll just give you a perspective that while for 2015 to 2020, there have been no applications in spite of the regime being in place. We think today, if you look at 2020 and 2021, I would say at least I know of over a dozen plus AIF managers setting up base there. And this is just us in the first 4 months of be able to put a number immediately, but I think it will be a significant growth that I expect over the next year or next few years. I think there is enough potential for that.
Sure. Next question is, what rules have been laid in GIFT for rupee denominated transactions?
So I think, so there are, so you are allowed. It's like any other foreign territory for all practical purpose. And obviously the idea is to really, it has to be foreign exchange, and foreign exchange definition under FEMA could also include convertible rupee is treated as a foreign exchange for all purposes. So the same principles would apply. They've also allowed trading of rupee derivatives, rupee dollar derivative pair. I think that is the other. So these, I mean, I think they are allowing LRS, for example, to be remitted into. So you can remit your rupees from here into a account or a manager in Gift City to convert that into dollars and then invest abroad. So I think it's definitely something where RBI is looking at increasing the flow of capital, including allowing domestic participants as well. But having said that, obviously the concern would always be the round tripping, and it may not be a jurisdiction which would be which RBI or the policymakers would want to promote as an alternative to an onshore for dealing and trading in onshore security. So that's one thing you got to bear in mind, that while anything and everything which you can do with a rupee to invest abroad, all of that would be permitted, but it will not be seen as a jurisdiction to invest back into India.
Sure. Next question is why AIFs have not seen body corporate been registered?
No, so I think, as I mentioned in my session, I think we are seeing more and more LLPs in Gift City AIFs, and it's also driven by the fact that LLPs are generally becoming a vehicle of choice for some onshore as well, but also eliminates the need for a third-party professional trustees and all of it. So operationally, limited partnerships are a common form globally. So we will see that, and then LLP is a body corporate for all purposes. Company is something which is also used, for example, in Mauritius, and it's also permissible. But because of its more rigid framework of a corporate, is not a preferred structure in most jurisdictions, including Mauritius as well, while companies are used. But the regime is globally is LPs. So you will see body corporates being used now. And in fact, as I said, corporate law has also been changed, or exemptions which have been created under corporate law for gift entities. And that would also make even body corporates or corporates to be a viable vehicle for gift setup. But as of now, I think I would say trust and LLPs will be the preferred vehicles.
Sure. So I think that's about it. I don't see any other questions right now. We are anyways out of time. So thank you so much, Siddharth, and for your time.
No, absolutely a pleasure.
Yeah, and if audience, if you have any more questions, you want to ask Siddharth or Ketan team, I mean, they are easily accessible on LinkedIn and any other such platforms. So that's about it. Thank you. So we will be now taking a break before we move into the next session. And
thank you.
Thank you so much. Stay safe. The next session starts at around 4. So we see you all back there. Thank you.
Okay, wonderful. Thank you.
Hi, Thomas. Good evening.
Hi, good evening. Hello.
Yeah. Hi. Are you ready? Do you have a presentation that you'd like to run?
Yes, I do. Yeah.
Yeah, just.
Do we have everybody online already, or?
Yeah. So we are streaming. I mean, the speakers are using Zoom, and
Okay.
all the guests have joined us through a live streaming platform.
Perfect.
Yeah. So just.
It's a shame. I was actually looking forward. I was hoping that there's some interaction, but I maybe if there is anything coming up through the Q&A that you will relate the questions then accordingly if there is still some time afterwards.
Sure. So I've just made you the co-host. Let's start in the next couple of minutes. Till then you can settle down. If you want to put up the PPT, I can have a quick look if it's working.
Just going to change this to full screen. Does that work? Can you see that?
Yeah. And how do you pronounce your surname?
Michael. It's Austrian, so it's a little bit of this German thing in there. So correct. For English, Michael is fine. Yeah. So when it comes to introduction, if you say Thomas Michael, that's okay.
No, Michael. I can say Michael. That's
Yeah,
something
that works perfect. Actually, that's very good. Yeah.
Great. So we just wait for a minute or two for people to join in, and we can start. Yeah. I'll just give you a heads.
Yeah.
All right. So good evening, everyone, and welcome back for the post-tea session with Mr. Thomas Michael from Crystal.ai. Thomas is the head of trading and advisory portfolio management and the member of investment committee at Crystal.ai. Needless to add, Crystal is doing some very, very interesting work in creating a global wealth tech kind of a platform. And especially for Indian investors, it's more exciting because they're trying to bring some really interesting global investment opportunities for the sophisticated Indian investor. So this talks about, so it presents an opportunity both for the investor as well as for the wealth distribution community, which can, sign up with Crystal to work on bringing some of these products for their clients. So Michael is here today to talk on tail risk hedging and about creating robust portfolios for volatile markets. As much, like all of you, we just eagerly looking forward to his session. Thomas is, of course, filling in for Ashish, who was supposed to be here, couldn't make it today. But Thomas has, I believe it's your second part-time with an AIW.
Right, yeah.
So now you are getting used to it. Unfortunately, we are stuck to the virtual events and not able to get you on ground here in Mumbai. Or hopefully next year. But nevertheless, looking forward to your session. Over to you.
Thank you very much for the introduction. And yes, I'm really pleased to be here again. And I hope that all of you had so far interesting sessions. And I hope that what I'm going to talk about today is equally important for you or interesting for you as well, and lines up with the other topics that have been talked about I'll be talking about tail risk hedging and how it creates a robust portfolio in a volatile market environment. And the precursor to that, and one of the reasons why I also stepped into that, prior to joining Crystal, I have been working in JP Morgan, where I was responsible for the counterparty risk management of the investment bank in the Asia Pacific region. So events like what we have seen just recently with Archegos, these are also in the counterparty risk world, this is deemed to be a tail risk as well. So my daily bread and butter was basically looking at tail risks within our portfolio and looking for that. And we have also maintained that culture within Crystal as well and implemented that into some of our products. And that's why I also wanted to talk a little bit more about the importance of tail risk hedging in a portfolio overall. So without further ado, I mean, let's start out first, what is tail risk, or the definition of tail risk? The textbook definition is that it's an event of extremely low probability, but with a very high impact. So as they refer to it, is for so-called black swan events. Yeah, tail risks have the nasty habit that they also impact diversified portfolios. So usually, and I go to that later, one of the risks or risk mitigation strategies is to diversify your portfolio across different asset classes. But in a true tail risk event, what happens often is that your correlations between equity, fixed income, or other asset classes go strongly positive correlated. So almost like there's no place to escape. Just as a reminder, last year, March 2020, which is still very vivid in many memories, we saw an extreme sharp sell-off in US Treasuries, accompanied with a sharp sell-off in equities, etc. So it's this is another metric of tail risk. It's usually associated with risk-off events, but there's also a tail risk to the upside, depending which direction you incline. By all means, what's the move to the upside, the rally that we have seen in the last couple of months in stocks is, by historical standards, if we look at the standard deviations, it's getting very close to a tail risk that has been resolved to the upside as well. So for any funds with a strong short focus, it has been a very painful time as well. So it always depends from which angle you're looking at tail risk, of course. And last but not least, and this is something that has been coined especially by Nassim Taleb, who has been very famous, and I'm sure most of you have read his books and have heard his name at least, that tail risks are much more prominent than what the normal distribution would make us believe, as it is defined by modern portfolio theory. But most of us in our lifetime, we have seen at least 12 to 13 tail risk events, depending how long you are in the market. But starting with 1987, so here this is the chart of the Dow Jones Industrial since 1985. We had seen, of course, this tail risk event in stocks in 87. We had also this sharp sell of 07, 08, and last year. These are just the equity ones, and this is a log normal chart. On a price chart, it would look even less pronounced. But we also had in between 1994, 95, LTCM and the Russia crisis. 97, the Asian crisis was deemed to be a tail risk event. Of course, the dot-com bubble, which is less pronounced in the Dow Industrial, but in Nasdaq, clearly defined as a tail risk. And also, don't forget taper tantrum in the more recent history and the volatility shock of 2018. Volatility shock was extreme positioning in exchange traded products on the VIX, which is the volatility index future on the S&P 500. And outsized positioning led to unwinds. And this was one of the headlines from February 2018, where in a short period of time, global markets have lost more than 5 trillion in that period of time. So now to the question, why is considering tail risk so important? I think first important step for any investor is you have to define tail risk. It's always in the eye of the beholder, and it depends on what are your investments that defines what does tail risk mean for you. If you have already a diversified portfolio, a tail risk event is usually something where you would be looking for anything that moves correlation in a highly positive territory. If you are a portfolio manager, or if you have a lot of exposure to a specific sector, say, for example, airline industry, a tail risk event could be tragic events like September 11, which led to a sharp sell-off in the airline sector, but also last year with the COVID pandemic. These are the classic tail risks. So it's important, depending on which part of the portfolio you're looking at, that defines your tail risk, and that kind of like draws the focus. So for today, I keep it more general and looking at it more from the perspective as of a overall portfolio with more of an equity focus for the basis of this discussion. The other reason why it is important is that the drawdowns can be substantial, as we have seen from past episodes. 20-25% is more of the norm than the exception when it comes to tail risk events. And especially important is it when investors are operating with leverage. There needs to be a tail risk strategy, because the moment leverage comes into play, there is the risk of forced liquidation of the portfolio positions in a tail risk event. And that would usually come at the worst possible time. So if I go back in this chart, a lot of investors here last year in this move, they were forced and they met margin calls after the first 10-15% of the correction in the market, which means by the time most of the positions were unwound, this happened usually at the low point of the market without the ability to take on additional positions. And that's why the moment leverage is in play, having a tail risk strategy is an important consideration. And last but not least, tail risk is also given a sort of a capital preservation by having a strategy or a portion of the portfolio that pays off of that. And that allows deployment of funds. First of all, it allows to hold on probably to other funds, but also to add on and rebalance the portfolio, deploy additional funds, which allows investors to capitalize on golden opportunities like what we had seen in March 29 or March 2020. Other considerations for tail risk hedging is, of course, should it be a static or dynamic hedge program? So I have, there's two ways about that. I see a lot of programmatic hedges and products that are available in the market. They have a fixed hedge budget of a certain percentage of the NAV or income per annum that is determines the expenses for tail risk hedging, or it can be a dynamic hedge program. From the introduction, you can tell that I'm more inclined towards the dynamic hedging due to my background here, and that makes it sometimes a bit complicated in a sense, because it's almost ending up in a trading decision as well. So it's not something that I would recommend for the daily investor. It is more something in a consideration, a strategy, as we have it, for example, in Crystal AI. We're managing the Crystal Founders Fund, which is product fund, hedge funds that is deploying tail risk strategies. Or I'm also managing for Crystal a leveraged bond strategy, where I have a dynamic approach to the amount of leverage, first of all, that is taken. But at times, I have the ability to take tail risk hedges into the portfolio to mitigate against any unforeseen events. For example, right now in this current market environment, while I'm still positive that the trend is going to continue from what we see right now, but I've added and spent some of the income in put options on high yield bonds and also hedging some of the rates risk in the long end of the curve to mitigate exactly these tail risk considerations. I often compare tail risk hedging when we go for the static one, a static program. It is like a insurance premium in form of options or uncorrelated assets. Think of it as a house insurance. Often what happens with tail risk hedging, the tail risk hedge is not going to pay off for you if a storm breaks a window, but if the whole roof is gone or if the house burns down, that's when the insurance pays out. And that's, I think, the consideration that we have to have for tail risk hedging. And I'm going to show you the, like for example, the payoff profile that we have currently in the Crystal Founders Fund, which is exactly that. So we have basically added tail risk. So in this area of like 10% out of the money strikes, and then staggered to the downside as well. So in a market move, the first from current spot to the first 10%, there will still be a loss in the portfolio, and it's not fully mitigated. But on a steeper sell-off, if it becomes a very sharp move, that's when the tail hedges start to kick in, and that's when they are going to mitigate the losses. And that's exactly what a tail risk or tail hedge should be doing. Okay, it has become more and more difficult to find good tail risk opportunities. I would say one of the issues with this increase of amount of tail risk events that we have seen, the fact that the market participants have also learned from experience, cost for tail risk hedging has definitely gone up. While in the past, usually a premium spend of about 0.5% to 1% could give you a decent amount of payoff profile to capture some of that. These days, the cost of hedging tail risk has gone up substantially. We are often talking in the area of about 1.5% to 2% here. Yeah. So sometimes that requires us also to be a bit more creative into how we can hedge. First and foremost, one of the best hedges for tail risk is volatility. That can be either outright put options, like for example, what we have in the Crystal Founders Funds, or as I mentioned earlier on, in the leveraged bond strategy, where we are buying out of the money put options to hedge that. Another option is to just buy outright volatility. There's a very high correlation of volatility so volatility, just to make sure that everybody is on the same page, is basically a component of pricing an option. It is determining the price of an option. The higher, it's not only a measure of the price volatility, but there's also implied volatility as a price input into the option premium. And usually what we see when a market sells off, volatility has the tendency to spike. There are traded instruments on the exchange in form of volatility ETF or volatility futures, which mirror the price movements of the volatility curve. And that is one of the ways to hedge that. The other one is, of course, correlation. As I mentioned earlier, it's the concept of diversification. So by using different asset classes that diversify against different moves that we might have in the market. That has been a tried and tested method that worked very well for the last 40 to 50 years, I would say. We have gotten into an area now with rates at the zero boundary, where the benefit of diversification across different asset classes is not always enough. And we have to look at other asset classes as well. That's why we have at Crystal made a conscious effort actually since 2019 to add alternative assets into the mix as well, of a well-balanced portfolio. And here I count, for example, cryptocurrency can be an offset against a broad dollar weakness, for example, or sharp moves in the currency market. It can be through investment into arbitrage funds, where returns are generated in volatile market environments, a volatile market environment leads to dislocation in pricing. So an arbitrage fund is able to capitalize on these mispricings. Therefore, their returns usually in volatile periods go higher than in very steady periods. Also alternative assets, and that's something that we have deployed in our in some of the strategies that we manage, like the Crystal Core strategy, for example, where we have added volatility itself as an asset class and crypto in an overall portfolio. So this part I've shown you already, the practical applications. So again, Crystal Founders Fund, it's a hedge fund that's managed by our founder, as the name says, and CEO Ashish Chanda, with support of the entire investment committee and Crystal analyst team, where we are trying to manage this tail risk, because it is important to keep some dry powder. It's important to manage the drawdown in a portfolio to be prepared in adverse times for setbacks. Or in Crystal Core strategy, that's what I also mentioned, where we have been taking exposure into ETNs, crypto ETNs, also volatility ETNs that have been added in March, and commodity. Okay. So yeah, I'm conscious of time. I think we still got a few minutes left. I think maybe one other thing, when it comes to tail risk, the most difficult thing is to identify tail risk. Just in summary, usually it's the things that we don't know, the unknown unknowns that generate tail risk. I think that is something that we have to be mindful of. Therefore, it's always important to monitor how the general market behaves, what kind of indicators would give us an indication into tail risk, or the need for more tail risk. For example, excessive amount of leverage in a market, which will exacerbate moves to the upside as well as to the downside. It's usually a good indication of that there is a good time to dial up a little bit on the tail risk consideration of that. Okay, so I hope that this was informative and interesting. And if you can take, I'm happy to take a few questions for the remaining couple of minutes. Hello, moderator, do we have the chance to, participants have the chance to ask questions? If not, then. Okay, then maybe in the remaining time, if we don't have any questions, like I spent the last couple of minutes to walk you in detail through the Founders Fund, since we have been discussing that and I've been managing it, just to give you a little bit more of an insight. So this is our longest strategy that we have. Was founded in 2015, and we've been able to outperform our benchmark substantially over the last couple of years, in up as well as in down markets. Our long-term return target is an 18 to 20% per annum area, which always requires us to, again, 18 to 20% is a high-risk strategy, hence the focus on tail risk. We have definitely enhanced this tail risk methodology over the last 2 years, I would say. That's why, if we look very far back in that history, there have been some drawdowns, but over the last 2 years, we've been managing with this tail risk strategy our downside risk very well. The asset allocation is based on the risk parity principle, plus the tail risk hedging, plus opportunistic leverage deployment. Again, dynamic application of leverage. I always compare it in a football play, switch between offense and defense. When do you send more strikers forward, or when the wingers go forward? versus you pull more defenders back. That's kind of like the opportunistic leverage deployment that we have here on high conviction trades, where we are looking to benefit from market dislocations. This can be done through single name equities, or it can be on big themes, thematic investments. Like for example, last year we have added commodity, like a broad commodity index and an energy exposure to the strategy, and have been able to capitalize on that quite well in strategy returns. We're using our AI and machine learning models to select the assets as well. And last but not least, this is the current asset allocation as of end of March. So relatively small allocation. It's a global portfolio, but with some international or some diversification as well. You see China 7%, India 3%, but predominantly it is a US focused portfolio. And the current leverage is 1.25. That was as of March. Actually, as we reach now early May, leverage has gone down even a little more. So just last week we have rebalanced again, and we are currently running a little bit more defensive compared to the historic average. Okay. The other part, and that's also one of the things that is very related to tail risk hedging, theta. The concept of theta is based by the use of options. Any option has got an intrinsic value and has got a time value, so-called theta. What happens is the closer you go to the expiry, the quicker your theta decays, your time value decays. Often, even a one-day option still has, when it's out of the money, still has an option value, but one day later, the entire value will be gone. So it's basically 100% time decay that is happening for one-day option. Whereas if you have an option that has still 2 years to run, there's a high probability that this option price fluctuates and it might change over time. So managing theta is an important consideration for tail risk hedging. We have implemented that in the Founders Fund by being proactive in terms of rolling our hedges over and minimize or optimize through that our time decay. Okay, so conscious that we are out of time. I hope that was informative. I hope that was interesting for you, and I would be looking forward to talk to one of the other of you. Please reach out to us through LinkedIn, through your RMs, and looking forward to, hopefully, last year I said the same thing, that I hope that I can join next year in person. This year now again, I hope that in 2022 I can join you personal and that we meet in India on the ground. Thanks very much.
Sure, Thomas, just a sec. I see some questions here. You have a few minutes?
Perfect, yeah.
You have a few minutes to take the questions?
Absolutely, yeah.
Yeah, so audience, please share your questions quickly. So I can see the first question already coming in. What are the signs of tail risk which can be identified in advance? What are scenarios where this is defined for AIF?
The signs of tail risk, I look for complacency. Complacency in the market. Usually tail risk is hiding there where people say that it's the new norm. Yeah, we are just accepting something, no matter how ridiculous it may sound, we are accepting it as normal. It can also lead to big price dislocations. So that's usually a sign of tail risk or tail risk building up. Otherwise, it's a very difficult question. So these are kind of like the more market technical ones. Then, of course, there's always inherent tail risk. Political risk is a huge tail risk. Take, for example, the China-Taiwan tensions. Any escalation of that conflict might lead to a tail risk event in a particular market. If I'm sure a lot of fund managers who are managing, for example, a Taiwan equity fund, they will surely have some sort of tail risk mitigations against this kind of event in there. So that's why I was saying in part of the presentation, it's always important to identify it. Or another example from me back from my past, when I was managing the counterparty risk, one of our biggest tail risk has been changes in the exchange rate. Yeah, in the say, for example, dollar yen exchange rate or dollar Korean won exchange rate. So we have been looking always as to what can make this move, what would cause adverse moves in this currency pairs, which are usually economic events, surprises in economic data that are causing that. So that's that. And the second part of the question was, sorry. How to identify it? Well, I have a few indicators that I personally look at. For example, on the market structure, I'm just trying to see if I can pull this up quickly for you to share. I like to look at the shape of the. I was mentioning volatility itself. So the if volatility is extremely low, that's usually a sign of complacency, a lot of selling that has been going on, and therefore it might indicate us, first of all, it's cheaper to buy daily risk protection. Secondly, it might indicate that there is a higher amount of complacency in the market. Therefore, it could move one way or the other. It could resolve to the upside. Yeah. Just trying to get this here. Okay, I hope that clarifies. Any other?
Yeah, so coming to the next question, could you tell us a bit more about your platform, Crystal AI, especially vis-a-vis other similar platforms who are bringing such opportunities to Indian investors like Stockall and Vested?
Yeah, so I can't really talk about Stockall and the other providers here. I would say with regards to Crystal, we are here to cater for. Our focus is very much on international, as I've shown from the Crystal Founders Fund. International markets is our forte. We have operations in Singapore, in Hong Kong, in India as well, of course, as well. One of the key advantages as well for Crystal is that we have a very diversified offering for that ranges from investors with very low touch need or low needs and pure ETF platform, also catering for accredited investors and very sophisticated investment solutions. Like, for example, the funds that I've mentioned that we are managing in-house through the expertise of the investment committee and through our partners, as well as offering third-party funds on our platform at small denominations that allow Indian investors to get exposure to highly sophisticated overseas investments with a good track record and with a steady return. And as I said, also in some ways risk management in mind. So these are the key advantages. But please visit us at crystal.ai to get a first glance. And my colleagues in India, Himanshu Gupta, Siddhant Raisada, they will be very happy to organize some time with you and walk you through our offering in detail. They are much better salespeople than I am. I hope I explained it well enough, and I will get scolded from Himanshu after this. I'm more a portfolio manager than a salesperson, but that's in a nutshell. I would say these are the key differentiations that we have from generally our competitors.
I'll just take one more question quickly. Audience, if you have any share, we'll try to quickly ask within a given time. So the third question, Thomas, if you could share more insights into what kind of investor behavior you're observing from Indian clients, which kind of assets where they're finding more traction, and what kind of challenges you are facing, especially when it comes to Indian investors?
It's a great question. So first on the behavior, I'm always very positively, not really surprised is the wrong word, but I would say there's a very high level of sophistication within the Indian investor community, at least those clients that I deal with and that we deal with in general, which is great. Yeah. So the recent behavior, of course, it has been impacted a lot with everything that's been going on in India at the moment. But it is a very astute investment behavior that I've seen. I think a lot of diversification has been happening on that front, and a very good approach generally to look at risk as well, to build a portfolio that can withstand many different market scenarios, has been well accepted by our investor base. The flow-wise, I would say we have seen a very strong flows last year, very strong inflows from India as well as also internationally. That is a very good development. With regards to the challenges, I think the biggest challenge that Indian investors face is the LIS restrictions, investing overseas. Of course, there are some limitations here, and also when it comes to taxation. So often what we say is that rebalancing a portfolio is also a very important measure of risk mitigation. But that is one of the biggest challenges, that this taxation implication when it comes to rebalancing a portfolio, when selling one asset and crystallizing a gain that would lead to a tax obligation, that has, from our experience, often caused like pushing out the decision that might have been good. So therefore, I think from our perspective, or from my personal perspective, I think very good utility here is given through fund products or our managed portfolios that we offer on the platform, where the rebalancing takes place within the portfolio rather than in the client portfolio itself. Therefore, there's no buy-sell transaction that would lead to a tax obligation. So that's one of the main challenges that I've seen. But generally, I think that's the development is great, and it's a fantastic journey so far with all our Indian clients.
Glad to hear that, Thomas. So I think we are out of time now to get into the next session shortly. So thank you so much, Thomas, joining in. I hope and trust all well with you guys in Singapore, and things are much under control than they are in India.
Thank you. Yes, my thoughts and prayers go out to all of you and your families and your loved ones. Please stay safe. We will get through this eventually, so stay strong, stay safe, and I wish every one of you all the best. And yes, looking forward to talk to you soon in the future. Thank you.
Thank you so much. Stay safe. Good day.
Thank you.
Hi.
Yeah, can you hear me?
Yes. A little bit.
Yeah, I'm saying, can you hear me? Hello.
Hi, I'm Laura.
Okay, just a second.
Can you see? Oh, yeah, perfect.
Hi. Am I audible?
Yeah, now I can hear you okay, perfectly.
Sure. So, do you have any presentation that you want to run?
Yeah, actually, I wanted to share here if it's possible, just to see if it's work. So I think that you have.
Yeah, I just made you the co-host. You can now share the presentation. We'll start in another 5 to 7 minutes.
Okay, perfect. Yeah, sure. No worries.
Yeah. So I'll just rejoin you in another 5 to 7 minutes once.
Okay, perfect.
So Laura, your session is scheduled at 5, which is 5 o'clock in India time. So that's another 5 minutes from now.
Okay, perfect.
We'll take another few minutes for the audience to settle down. So we should be starting in another 8 to 10 minutes. So I'll just join you back.
Okay, yeah, I will wait. Don't worry.
Quick question, Laura. How do you pronounce your surname?
Bastons.
Sorry, can you repeat? Bastons.
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 Exactly.
Yeah. Okay. Thank you.
Thank you.
All right. So I think we should get started. Lola, are you ready?
Sorry?
Can we get started?
Yeah, sure.
So, welcome back, participants, for this session where we're going to, listen to Ms. Laura Blackton from Vivian Spain, and she's going to be talking about investment opportunities in Spain and why Indian investors should be looking at Spain for their real estate acquisitions. Vivian is one of the leading players, promoting Spanish real estate opportunities to the global investors. They have recently set up an office in India and are now reaching out to Indian investors. Spain has always been a country which has been like a heart of Europe in a lot many ways, especially for Indian investors and travelers. Spain is always a country which is right there up on the on the list, top of the list. So both as a residential destination as well as an investment destination, Spain has a lot to offer. And Vivian is trying to bring this fantastic real estate investment opportunities in Spain to Indian investors in here. So Laura is here, who's going to take us through what all Vivian is working on and how they can be of help to all of us. And I can't help but thank Laura, Aparinder, Jyot, and all their team members to join in for this session. Laura, thank you so much. I hope things are much better around Spain.
Yeah, thanks. They are getting better.
Things are getting better. Great. So we hope that the international travel gets started soon, and the opportunities that you're talking about, Indian investors will be able to see that up close and personal rather than on the presentation here. But for the time being, I think we have to do with this virtual events. Can't help it out. Like other speakers I was talking to, we look forward to host you in India and connect with you in person to understand this opportunities better. So over to you for this session. I just to give you the format. So you have joined in on a Zoom session. The viewers are watching this live through a separate virtual platform. And once you're done with your talk, I'll be happy to take some questions from the viewers if they have any for you. So just keep like a 5-7 minute window towards the end of your talk for some Q&A.
Okay,
yeah.
Perfect.
All right.
Thank you a lot.
Thank you.
So, well, hi to everyone. First of all, I would like to thank you all for attending, and especially to the Association of International Wealth Management of India for celebrating this summit and counting of us. I would like to start introducing a little bit myself. My name is Laura, and I am an economist and jurist graduated in Barcelona at University Pompeu Fabra. I also have a master on law at University of Barcelona. And during my professional career, I have worked as both an economical specialist and a jurist, specializing myself in immigration law and doing different entrepreneurship activities related to the tourism and real estate sector. I am one of the founders of Within, the company that I am representing here today. And one of the things I pride myself from is involving me in the necessities of my clients and getting into a strong relationship with them so they can feel comfortable and guided through all the process. Today, I would like you to introduce the real estate market of Spain and ourselves Within, a knowledge real estate investment agency when it comes to information about different alternatives of real estate investment in Spain. Therefore, I will try to answer two different questions simultaneously. The first one is, in terms of real estate, why should you invest in Spain? And the second one is, why should you invest in Spain with Within? So most of you Probably thanks to the film Zindagi Na Milegi Dobara, I hope I pronounced it correctly. We'll probably know Spain as a country for tourism and party, but Spain is a country presenting many opportunities for investment with economic, social, and legal returns. Let me explain you some of the general characteristics of Spain so you can get an idea of it. Spain is a country with privileged geolocation, as it's a country, is one of the countries of the Schengen area. So it counts on a huge network of infrastructures that allow a quick and excellent accessibility to other European countries. Second of all, it has a great quality of life because it has a temperate climate during the whole year, and it has two main cities, Barcelona and Madrid, where many events are celebrated. So people from all around the world come here. So this is one of the most visited countries in the world, with almost 84 million of tourists per year, and that's quite a lot. Moreover, it is a country that embraces all kinds of tourists, from the ones who come here to stay to the coast and go to beaches, to familiar tourism, the ones who come here for partying, but also the ones who come here for architecture reasons, for business, etc. And fourth of all, Spain has a great market attraction because it offers excellent and safe market conditions, as it presents an easy accessibility to the domestic markets, a very good quality price relation. So in fact, is it one of the cheapest country on Europe, and in terms of real estate investments, remodeling is really affordable. And as a European country too, it presents a really stable economic growth. Therefore, holding a property in Spain means that over time, it is going to make you money. But finally, the icing of the cake is that Spain also presents huge difference between regions. And why is that something positive? Well, although some of you might think that the big cities are the only places to invest, the diversity of the Spanish regions opens opportunities to other parts of the country that can even be more profitable than the main cities. Let me give you one example, that it's Valencia. Valencia is a middle city near to the coast that in the last few years have proven to be the most profitable city in terms of real estate investments, achieving great growth. And actually, as you can see, it has increased 35% in the last 5 years. And here we have Barcelona, that it has also increased, but not as much as Valencia. And the same happens to all the coast parts of Spain. For example, these parts, there are many European people who come here during the seasonal period looking for good climate, the sun, and beaches. So people holding real estate investments properties here can rent those properties when during this seasonal period, and where the prices dramatically rise up. So they can even double or tripling the normal price. I myself have invested in properties in La Costa Brava, for example, and they performed really great. And I'm sure that they will continue with that for a long time. Actually, for the COVID pandemic of this year, profits has not gone down. On the contrary, they have even been better. So what does Webin offer? Webin offer opportunities to all those parts of the country and advise on different types of investment in each of those areas. First of all, we have La Costa Brava, that it offers a paradisiacal environment. And as I have said, as a coastal part of Spain, many European tourists come here during the seasonal period. So the most profitable investments in this area are those related to real estate properties, to buying real estate properties, and to get high rental profits of it. The second one is Barcelona, that is a city open to the world, as it takes many events. The most the most famous one is the Mobile World Congress. So few people from all over the world come to the city, and it's actually becoming the reference city in terms of technological enterprises. So many of them are coming here to establish either a subsidiary or the headquarters of the company. Barcelona is also a very safe city in terms of real estate investments because it has no space to grow. So properties are constantly being reevaluated. It's a really great area to make investment in economical activities or annual rental profits, actually. The third of it is the Balearic Islands, that is the first touristic attraction in terms of beaches and sun, basically. And so the most profitable in real estate investments here are those related to the hospitality sector and seasonal renting too. And the same happens to Marbella as a coastal place in Spain. Rents here are so high. Then we have Valencia, that, as I have said, is an emerging city that is growing at a really fast speed, and its properties are being highly reevaluated year by year. And the key thing about Valencia is that the cost of the properties is not so high as in the main cities. So properties are much more affordable here. So it is a good place for long real estate investments. And finally, we have Madrid, that is the main city of, it's the capital of Spain. And the most profitable real estate investments here are the ones related to economic activities and annual rents too. So as you can see, the aim of Within is presenting lots of opportunities to invest in. So you or your clients can choose the one that best suits your portfolios, your needs, and your objectives. But let me introduce a little bit my team and my company. We are a team of economists, real estate advisors, and investment specialists committed to the values of corporate responsibility, accuracy, transparency, and trust. Our goal is to offer you a trustful service and work with you through all the process so you can feel safe and comfortable with it. We offer a personalized financial and assessment personalized financial and investment assessment, advice on taxes and accounting, and legal assessment. But that is not all. We are experts, so we know that usually properties require remodeling or look so much better after being redesigned with virtual furniture or photos editions. Therefore, we also offer marketing, interior design, and property maintenance services, so you can get the maximum ROI on your investments without being in constant control of the property and rentals. We also offer guide and advice on the Golden Visa. And what's the Golden Visa? The Golden Visa is a work and residence permit for non-European citizens and their families who want to make significant capital investment in Spain. Finally, I would like to introduce you some representative proposals and possibilities associated with them. As I have said, in the coastal parts of Spain, hospitality services are really profitable. So here you have some investments related to hotels. The first two are situated in La Costa Bravo, and the third one is situated in the Balearic Islands. And as you have seen, they all offer great ROIs. These are lots of apartments for rental investments. And finally, these are offices. The first two are situated in Barcelona. The third one is in Madrid. And they also present really great ROIs. So in conclusion, I would say that Spain is a country offering huge opportunities in the real estate market, as you can see, for its privileged location, because it offers really excellent market conditions and stable growth, economic growth, for its climate and perfect quality of life, and for its constantly growing touristic attraction. So now if you have any questions, you can tell me, or you can also visit us or contact us through our LinkedIn or our Instagram. Or if you want, you can visit our webpage or phone us, text us, wherever you need.
Sure. So audience, if you have any questions, please quickly ask through the Ask Question tab. So Laura, till we get some questions from the audience, can you tell us if you have you have some mechanism where you work with wealth advisors and financial product advisors also on these investments?
Sorry, I didn't understand. If I have what?
Do you have any? I mean, do you have a vertical where you work through wealth management companies or financial product distributors in offering this investment opportunities to the clients? So do you have a channel partner kind of a network?
Well, we are in contact with other we are real estate investment agencies. So we are in contact with many real estate agency, not investment agency, but agencies itself, that they have a lot of properties. So we don't have like a list of properties. We just look for the opportunities. We don't have a close list of properties. We try to look the ones that best suit our clients' needs. So we are in contact with many real investment agencies.
Okay. No, I'll let me reframe my question. So if can Indian wealth management companies and financial advisory companies work with you on so do you how are you planning to pitch this investment opportunities to Indian clients? Is it directly?
Okay, yeah, I understand. If they can contact us so we can create a relationship, you mean that?
Yeah, correct. So
yeah, sure.
Are you planning to set up a distributor, some kind of a distribution network in India?
Yeah, sure. So our goal is to actually contacting also to distribution agencies, to this kind of agencies here in India, so we can create a double, let's say a double safe contact. So people from India can contact both people from here and people from India, so they can feel more safe and comfortable.
So Laura, a lot of Indian investors have been buying, especially when it comes to real estate. UK has been the most favored destination for Indian investors. So how do you pitch Spain against something like a UK for for real estate?
Yeah, so I know that UK has been like really attractive to Indian investors. I suppose that it's for the connection they usually have with it. But the thing is that Spain now, like UK is not in the not a Schengen member or not a European member anymore. So actually, what we want to offer to is a legal service to all these people and a golden visa service, so they can get more services here in Spain than in UK. And actually, as I have said, Spain is a really cheap country. So here you can buy cheap properties, and remunerating them are as they are constantly revaluating, you can get great profits just with the revaluation prices.
Sure. And do you also arrange, next question, do you also arrange for finance if some Indian investors are planning to buy it? Do you also arrange for some kind of a home finance or commercial finance for this?
So our company doesn't provide finance, but we can for sure look for banks and people who can finance them and help them to go with it. Sure.
We have a question here. What is an average price of an apartment in Madrid?
So it depends of logically of the kind of apartment. They like if you go to the center of Madrid, they can go from, I don't know, like from, let's say, 300,000 to 1 million. Like it depends of the characteristics of the apartment, of the metros of the apartment. It's like you cannot say a price.
Okay. And are you only dealing into residential, or are you also dealing into commercial real estate?
So we have also commercial things. We also offer properties for then having a commercial there, if you mean so.
Okay. So, audience, we have a few minutes to go. If you have any questions, please shoot. Do you already have any clients in India?
Yes, we plan to come to India like in 2 months or so if things get better.
Okay, no, I asked you, do you already have any clients in India? I mean, have you already started getting some traction in India for this kind of properties?
Yeah, we actually came here 2 months ago, and we have like some agencies here who we connect with, and we are still we are working with them.
And just a second. All right, and you guys are focusing only on the Spanish real estate, right? Not in any other.
Yeah, no, it's for Indian people coming to Spain and investing in Spain.
All right, I don't see more questions, Laura. So maybe we can wind up the session for now, and do a more focused managed investment session, a standalone session sometime for our audience, our members who are interested in this.
Sorry, I'm not listening you well. Can you repeat, please?
Yeah, I'm saying I can't see any more questions from the audience right now, so we can wind up the session for now, and maybe have another standalone session by you guys.
Yeah, great. And if you want to connect with us and you have further questions, you can go like contact us through our webpage or through any of our social media.
Sure. So thank you so much, Laura, for joining in.
Okay, thank you for having me, and I hope you enjoy.
Yeah.
Thanks.
किसका फोन बज रहा है? करना है क्या?
Hi there. Can you hear me?
Hey, hi Sanjay.
Hi.
How are you?
Hi. Are we waiting for the others?
Yeah, I think so. It's at 5:45, so I think I logged in. I usually keep it logged in.
Can we log back in again? Is that okay? Hi. Is that okay?
Yeah.
5:45.
Does it start? You want us to log in at 5:40 or
5:45 should be good because audience take another few minutes to anyway should join in.
Thank you. Thanks. Bye.
Hi, Sanjay.
Hey, hi, Sashi. How are you?
Sorry. So in the questions that I've sent, in the second round of questions, I'll ask about iSafe. Is that
Sure,
okay?
sure. Yeah. Works out.
Yeah, Aditya.
Shashi, can we get started?
Yes.
All right, so I think everyone is here. Good evening, everyone, and thank you for joining in for this very exciting session on startup investing. I mean, I think this is a topic which is close to everyone's heart, and we've got a very heavy-duty panel here to discuss about how this entire startup investing space is shaping up. So when I was looking at this panel, I could think of three things in which anyone would wish to work with this panel, especially with the likes of Sanjay Mehta, Sanjay Nath from Bloom, Vikram Gupta from Ivy Cap, and Sunil Goyal from Yournest. So typically on the wish list preference order, you will have first, you would want to create a startup where one of these guys invest. If you don't have the entrepreneurial capability or the idea for that, then the next you could wish for to work with one of these people in their teams. And if you can't do even that, then the third best thing you can do is organize a conference like this and get them to talk, join you for a session. So that's exactly what I have done to get all these excellent investment minds together. And thank you, Shashi, for agreeing to moderate this session. I know it's going to be a very, very responsible task. We've kind of pulled you into this, but thank you for taking all the efforts. Thank you, Sanjay, both Sanjays, Vikram and Sunil for agreeing to be part of this event. Before you start, a quick take on this the entire platform. So what we're doing is we are using two different platforms. You all have joined in through Zoom, and all the audience, they're watching you live through a virtual event platform. So audience who recently joined for this particular session, you have a ask a question tab on your screens. After the session or during the session, if you have questions for any of the speakers, feel free to put in your questions there, and I'll be happy to take those questions on your behalf towards the end of the session. So that's about it. Shashi, over to you.
Thank you, Aditya, and congratulations for making this a successful summit 8th year in a row. Good evening, ladies and gentlemen. And it's been a long day for all of you all. And I think this is the most interesting session of the whole day. And that's why Aditya has purposely kept it in the evening, just to wake you all up. I'll just touch upon some data points for this startup ecosystem that we're talking of. 52 unicorns from India, 153 billion combined valuation of these, 46 billion total fundraising done by them. In this year alone, in the last 4 years, already 10 unicorns. Yet, 86% of the unicorns come from US and China. So we've just started, and it shows that we're catching up fast. In this whole thing, we've seen a pandemic which has been quite long, 1.5 years or so. And today what we're trying to see is how the startup ecosystem from all perspectives has changed or emerged post the pandemic. We've seen that a lot of digital acceleration has happened from the regulator as well as acceptance from the investors alike. With all the stalwarts that we have with us, I'm sure all the questions will be answered. So I'll start with our questions with the panelists. And the first and the obvious point that we want to focus on is how is this pandemic affecting the startups? Has it killed them? Has it made them stronger? So Mr. Nath, my first question to you is, has it helped in accelerating the digital growth and its acceptance, both from the regulator as well as clients? Or has it killed the startup ecosystem?
Sure, Shashi. First of all, thanks for having us. And it's wonderful to see my friends also here. All of us know each other well, and it's just good to see everybody safe and well here. And I hope the audiences, these are trying times. So, kudos to putting this together in trying times like this. No, when you're talking about India's vibrant ecosystem, and I think that that gap the delta is reducing, right? When you were comparing the number of unicorns to China and the Valley, of course they have more, but the gap has definitely reduced. Our our ecosystem is extremely vibrant. Like you see, Vikram and I have the same background, but he's all lit up behind us. So that's exactly what the Indian ecosystem is. It's interesting if you think about it. Last year, the Reliance deal certainly put India on the digital map, right? And if you look at where we all sit, all my friends here, because we're digital VCs, that acceleration was already happening, the digital adoption, and it's only accelerated, right? In one sense, I mean, we saw in our own case, we had a first unicorn in an academy, right? That became a unicorn partly because the way learning has changed and it just got accelerated, right? It was already happening. It's not like the pandemic and the lockdown suddenly caused it. And what is interesting is this is cutting across different segments, right? It is not just enterprises. I mean, enterprise behavior, Sunil looks at deep tech. Enterprise behavior is more to the cloud. Of course, today consumers are sitting and ordering on the apps, but also the small, medium business merchants in India, right? You look at we have a Love Local, you have Khata Book, you have Udaan. So that digital adoption is happening across the spectrum, right? It's not just for one segment. I think that's one. And that's why I think the VC industry, I mean, the venture and angel industry has, in one sense, been a beneficiary. If you look at, our private equity friends, it's a mixed bag, right? You have a lot of headwinds also because one is invested in hard assets, operational heavy businesses. If you look at where we are coming from, it's mainly all digital. And what's driving that is all corporations today either have or are even appointing digital digital officers, right? Chief digital officers. So I think the question is actually not how digital you are, but how non-digital you are, right? I mean, that is basically the wave. So in most cases, there are tailwinds. Of course, we have other challenges like you've got to take care of the health, your own personal health, your mental health, physical health, make sure that all of us come out of this much stronger. But there is no doubt, just quickly, one example, if you look at consumer, I think has always been the star in India, and we have even more unicorns. I think we had 6 unicorns since the start of this year and counting. But if you look at the other side, built in India for the world, that's also taken off. I mean, all of us have that. If you look at Freshworks, which I don't think is any of our portfolio companies, but 300 mil ARR, right? It's amazing, staggering, right? It's a very proud moment for India. And what that is doing is creating more role models. And so other B2B startups are looking to that and saying, I want to not just conquer India, but take over the world. So I think overall, there's a lot of confidence. You're seeing more unicorns that are coming onto the scene with real businesses. And I'll just stop there, but just saying that definitely the wave has accelerated and has accelerated across the spectrum, right? Not just for only MNCs or only SMBs or consumers, but right across.
It's so heartening to see that one would have expected pandemic to slow down the startups, but it's been a big boon for these companies. Vikram, I'll quickly come across to you and ask you, how do you see changes post the pandemic from an investor viewpoint from this startup ecosystem? If any, are the investors coming in?
Yeah, thanks, Shashi, for having me on this panel, and same sentiments as Sanjay mentioned. It's great to be here amongst friends here in the panel, and I think quite a lot that Sanjay mentioned. I echo those points, but I would like to actually look at it in 2 different segments, and I think. There was phase 1, which happened last year, right? So which was actually a shocker for almost everyone. Nobody knew that there was going to be lockdowns, and people were not prepared for it. Even businesses which were actually generating huge demands, they just couldn't service to those demands just because the entire supply chain broke down all of a sudden. And the revenues came down, crashing down to even 0 in many cases. People were doing substantial revenues. And I remember reading somebody's tweet and they said, our revenues are similar to what Amazon is doing in the month of April. So those kind of comments. That was a different time when people actually got exposed to this kind of a situation for the first time. I think at that time, it was more about, the storm is coming, I think People were expecting a lot more damage at that time, but fortunately, not much damage happened around that time in terms of the actual number of cases and the impact on the lives. Of course, a lot of lives were impacted even at that time. People recovered. I think we noticed that July, August onwards, there was a substantial recovery, and some of the businesses actually recovered much faster. And some of them actually were then looking at their future projections very differently as compared to pre-COVID times. I think second wave, which we are in the middle of right now, actually again has come quite unexpectedly to to the entire sector, right? So this time, I think the situation is very different. Here we are actually seeing, people in the teams getting affected. Somebody's parents are affected. Somebody's losing their parents. Somebody's losing people in the team itself. People struggling to get beds. Medical supplies is a huge issue, and I think that's unfortunately this time the damage is much worse, and that has actually affected on the ground situation. And this time the mental health is much bigger issue, because when you're seeing so much devastation of life around you, you just can't focus on work. All that said, I think you're right about, just in this year itself, I think I saw the number of maybe 12 unicorns this year itself, which is in itself is speaking about how this India startup ecosystem is actually, despite all these challenges, issues, really, coming up. And a lot of this is actually being driven by things moving online, digitization increasing. And I think some of the sectors are changing fundamentally. I think the healthcare is going to change fundamentally forever. I think that you'll see huge changes. Therefore, the kind of business models which you would see emerging, I actually spent a lot of my professional career in healthcare, and I would say that healthcare will never be same again after this entire thing. EdTech has been a huge area, which I think we are seeing, from zero to $1 million kind of ARRs in just 3-4 months, kind of things happening. Same thing for newer sectors like cybersecurity, because of the volume of data which is actually out there. So that's another area which is going to emerge in big time. And of course, I think as Sanjay mentioned, even on the retail side, the entire shift towards online buying, and even I believe that penetration of internet towards tier 2, tier 3, rural India, you will see a lot more of that happening. So the opportunity building up in the multilingual areas, accelerating growth in those areas. So it's quite exciting also from the investors' minds perspective, despite the fact I think the immediate need is to address the current kind of situation, which I think we are all trying to see whether we can, handle that and manage that well before we go across this.
Also, I would say a lot of access of such kind of products to investors has increased in the last 4-5 years, which has been helpful in getting them to invest in such startups. So Sunil, you've been doing a fundraise, and I would like to know from you, how has it impacted or changed the fundraising post-COVID?
Before, let me share the sentiments. Good to see all of you healthy and hale and hearty. But we are in midst of the worst of times. Philosophically, we always knew death is a certainty, but we never knew that it can come so soon. And it has major implications all over. We always, time is the one that we wanted to spend with friends, family, colleagues, relatives, with nature, with our hobbies. All that mind is taken away by this COVID incidence. And we believe the value of time is going to be far more multiplied in the times post-COVID. And because of that particular stuff, anything that is going to be resulting in automation, tools, faster decision-making is going to be invested. So given that background, fundraise, whether it is for a portfolio company, whether it is for us, it can get delayed just because you're not able to physically meet the investor. However, the thing that we are seeing is it is time to continuously keep on pitching, keep on reaching out, keep on connecting. Do not leave that particular touch with the investors. Even portfolio companies, what we saw in March, April, May last year, it seemed like everything had come to a halt. But then when it picked up with vengeance. The money started coming in last year in 2020 from all across for funds, for startups, and these unicorns were born. What we are seeing in the fundraise, if you are doing a first fund, it's a tough times. If you are doing subsequent raises with some background, history, qualification, etc., it is much easier. Second time, entrepreneur is finding it easier to come and make a pitch, and rather is able commanding a higher valuation from all of us, and we have to move faster to be able to fund those ventures. So this is one side of it. There are two other developments on the fundraise that have happened. One, because of the COVID scenario, government has been listening to us. The government has opened the tap for the domestic pool of capital. Pension funds, provident funds, private sector superannuation gratuity, as well as the insurance fund of funds. So there is a new pool of capital that is getting unlocked, and they will come in through various fund of fund programs to be run by larger fund of fund managers. That's one thing that is happening. Second, in the last year, many of us have seen significant exits. It is strategic exits happening, or the exits that have happened to subsequent VCs who have been buying our companies. That pace is giving confidence in the Indian ecosystem that these exits have now proven and kept a major gap or a major question mark for India behind. Hence, the fundraising is becoming easier on the back of those circulation or velocity of money that is getting circulated. And for us, all of us, this, a large business house like Tata is coming and buying out a significant stake in Big Basket for cash. This is dramatically multiple times more impactful than Walmart coming and buying Flipkart. So that's the kind of change that has taken place. With that, we believe the fundraising process will continue to be healthier despite the pause that we are seeing for the last 2-3 weeks, that there is no work. Our mind is in a helpless state, not able to help many people around who are seeking help at this point in time.
Thanks, Sunil. And I agree totally with you that the situation this time around has been quite grim, and we're seeing hale and hearty people suddenly getting under attack and not able to cope up with this pandemic. But you're right that there's a lot of interest, and investors are looking at it. We also saw in our businesses towards July to December, things move very fast. So, Mr. Mehta, I'll come back to you asking, while we've understood and listened from all these gentlemen on how the ecosystem has fared in this COVID, how investor point of view is there and what is happening on the fundraise, we want you to tell us if there's any change in the composition of the kind of startups that you are seeing today compared to the pre-COVID era. Are you seeing more of tech-enabled digital startups coming your way?
Sure. Thank you, Sashi. And hello, Sanjay, Sunil, Vikram. It's great to meet you guys online. If this was a real conference, we would have been rubbing shoulders with each other. It has been a while seeing all of you in person, but this pandemic, let me just put it in this way. It is said that the plural of anecdote is not data, right? So the single example of pandemic, yes, it's a long period, but should not be extrapolated as a broader rule kind of stuff. So, and VCs have, followed that to the T and investing across for future, assuming that things will become normal while we have the second wave and third wave. We at 100x.vc, we had a survey, sentiment survey, which a lot of the investors and founders filled up. And personally, we see across, so we run in a class mode, 100x.vc, and we see thousands of deals and we select few. And the data, what we see across is deep tech and SaaS companies have grown in multifolds. And almost in our survey, it was shown across 63% of the data on and SaaS. So that's going to be the prime stuff. And what our team is looking into is two, places. One is home economy. Anything which is, touching your one location or a home. Any ideas around it, the whole business around that location or the home economy, be it entertainment, be it education, be it payments, anything which is happening in the home, right, is of an interesting, consumer behavior change which has happened across. And the second one, which we are looking at very closely, is future of work. How the future of work is going to get defined. Today, how the information will get collected, disseminated, hiring. There are so many aspects at the work, right? So home and work, these are the two things which has changed quite a lot in this last 18 months. And we see, this consumer behavior change happening across and continuing in some part even after once things become normal. So these are the two things which we at 100x.vc are personally looking at. Having said that, rest of the sectors in the survey, be it healthcare, wellness, fintech, these are all the sectors which people voted across as an interesting sector to invest across in the investor survey side of it. So that's my 2 cents on the sectors which are trending. Shashi, you are on mute.
Yeah, circling back to Sunil, from your side, Yawnest, the first fund looked at very different kind of investments that you did. What is the change that, or the shift that you are seeing in the kind of investments that you're looking at now, or the investments coming your way now?
See, we all get to see the general stuff on the health tech and education tech, etc. There is a change when we go to the jury members of business schools and where youth is presenting. The change is much more of sustainability and environment-oriented startups are being talked about. If I have to give an example, this year or the next couple of years, it is going to be going green around electric vehicles. That's an easy thing. Everybody is adopting to it. There are many innovations that have to happen on the electrical vehicle side, on the SaaS side, on the IoT side, on edge computing side. So there are ventures that will be there. This is just one example of it. Otherwise, going green, I believe, is going to be one of the themes that will give some opportunities for us to be investing in. Second, while this work from home and remote working is happening, how do we keep on trusting the documents wherein signature or a stamp of a CEO or an authorized signatory were required? Going forward, we believe the importance of blockchain. Blockchain will now enable the way internet happened to do for information, blockchain will do for transactions. For supply chain, for any kind of banking transaction, the speed and the pace at which blockchain will multiply may not be imagined by us at this particular point in time, but definitely that will bring in trust out there. Cybersecurity has always been talked about. The kind of problems that we are seeing of mental health of people, when you talk to families, parents and the family members are so annoyed that every of their their family members who are working, they are stuck on the computer for all the time for 8 hours to 10 hours. How do we make that change? So Sanjay Mehta talked about this particular stuff, that there is going to be some innovations happening there. So we are looking forward to the changes that will take place post-COVID scenario in these areas, and hopefully some investment will happen on a change. The change that is going to be seen by us particularly or seen by us in the last 3 years. Earlier, we used to be getting engineers who had worked in the software engineering sector and coming and launching their products. Today, we are seeing product first engineers coming and presenting to us. These product first engineers have never worked in any of the services company. Rather, they have worked in R&D centers or product innovation centers and created some computer products or so, are coming and starting their ventures. So that's the other new theme that we are catching on, that there would be better quality product innovations or product startups will be available to us using technologies across that we've talked about.
Yeah, that we're witnessing. In fact, all of us are witnessing a gradual shift happening in the consumer behavior, the way we do things. Mr. Nath, I'll come back to you. With the digital adoption, is funding becoming faster and more accessible to startups? Are we as funds open to now VC meetings, everything online? Is that a shift that you're seeing?
Yeah, absolutely. I'll say, but it's also challenging, right? If you think about, all of us on this panel are involved in early stage. Venture versus private equity, and whichever way you slice and dice it, you have an investment team member do a analysis of an Excel file, and Shashi, you're from the financial industry. You're essentially making a bet on the founders, right? Now, how do you assess a founder over Zoom, right? You can do 10 Zooms or 50 Zooms, you're still not meeting in person. So there are other challenges, right? Obviously, technology is got better. But the answer is yes for a couple of reasons. I think, Sanjay Mehta, Sunil, and Vikram all highlighted a couple of thoughts. So one is, I think, we've heard LPs complaining for the longest time that all of you are very proud about being active investors, right? Where are the exits, right? Show me the money in one sense. You operate in a world where it's all about, show me the money because you're trading in and out and all of that. And I think that's been very positive. And I know we'll cover it later in the panel also, but if you look at the upcoming IPOs, right? If you look at whether Zomato or others, it's very important because earlier these companies were quote unquote just running, to NASDAQ or overseas exchanges, right? Because, when you put so much effort into a startup, you want to increase the probability of success faster, right? You don't want any obstacles. So we can't get around the obstacles. We say, let me just go to the path of least resistance. The fact that these companies are on the way to profitability and want to actively list in India, like Sunil was saying, is very positive, right? That's number one. So the reason funding is more accessible, a couple of reasons. I think that's one. The other is there are many more serial entrepreneurs out there, what we call 2X founders, who are not only starting up, but are also available to mentor, right? And mentor younger startups. So in fact, we like it. If you look at the way when rounds are done, my advice to startups is, of course, take money from VCs. That's our business. But also bring together some strategic angels and mentors with specific maybe domain expertise or people who trust you, and bring them in because they're going to help you with operational aspects of the business, right? They're going to help you scale. They're going to help you activate the business. So that's another reason why, more 2X, there are more 2X founders in the ecosystem and there's more funding available. Fact also is that the tech IPOs and the public markets in the US have done very well, and they have so much cash to throw off. As a result, valuations have become very expensive in the US. So they're actually looking to India and saying that we're able to get, like I think Sunil put it well, the early avatar of India cross-border was all services, right? Because most of the founders came from the Wipro and Infosys, and today they're PLG, right? Product-led growth. They're coming up from the R&D labs and product first, and then sell. It's not a services model. The fact that you've got great talent there, even growth investors saying that, hey, we're looking at Druva Software, we're looking at Freshworks and Postman. Where are the next Postman? Where do we want to find them? And that's why you're also seeing funding. You're seeing, it's interesting, right? You're seeing, if you look at the trajectories of all of us, I think all of us have, our AUM is larger than when we started. Of course, we have moved up the value chain. And you're seeing the later stage investors coming in earlier, right? They're all setting up different pockets. They have a seed program, they have a venture program, they have a growth program. So the ecosystem is benefiting, right? Because today there are more pools of capital. Everybody has their own space. But I will come back to fundamentals, right? I think ultimately growth is fantastic, but you have to make money. You have to part to making money. And I think IPOs are important because I think what India has not shown traditionally is that you can recycle the cash, right? That's very important, because if a LP gives you 10 crores and you give them 30 crores back, they're really happy because they will give you, 20 crores for your next fund from that cash that you return from the distributions, and that is typically not happening. So I think even the acceleration for funds returning capital will become shorter, and overall it's good for the ecosystem. We need to look at growth as well as fundamentals.
Yeah, I would agree, and I deal with most of the investors on the other side, and the biggest issue is that how are the exits happening, and we've not seen too many exits here, but shortening of the whole life cycle to reach an IPO will be of a great help. Vikram, I'd like to talk to you about what is it that, if you can elaborate more on what's happening on the exit side for these companies, and Sanjay started the lead, and maybe you could touch upon this in greater length, because that's one of the worries all investors face today.
So I think that's Sanjay has highlighted it quite well, but I think the core point here is ultimately the LPs invest in VC funds like ours with the hope that, in a certain time frame, they'll receive their money with certain returns. And I think historically, I'm talking about the domestic venture capital industry, and I think all of us on this panel would have started around the same time, to set up our funds. And, it's been almost like a 10, 11 years journey for all of us. And I think the expectation of the LPs is to, at some point, start seeing those money coming back and, get some returns. At the time when I was raising funds in 2012, kind of a time frame, we actually went to all the institutions in the country, banks, insurance companies. And one of the reactions was that they had invested in private equity funds earlier, domestic private equity funds. These were like sponsored by some of the largest houses like Tata Capital or Birla or Reliance, those kind of funds, fund houses which had set up private equity funds or real estate funds or infrastructure funds. And the experience was extremely bad. People had not seen any returns over a long period of time. Therefore, there was this hesitation of, will this asset class ever return money? And I think that mindset was there until very recently. Interestingly, in the last 6 weeks itself, just from 3 exits, we returned 500 crores to our domestic investors. And I think that actually we've seen has actually changed the mindset of our investors quite substantially. As Sanjay said, a substantial part of that comes back into the follow-on funds, because when people get that confidence, want to then therefore put their money back, because then they start seeing the proof of the pudding. And I think the exits now we are seeing not just happening at certain stages, but I think across the stages. Even when we are doing Series A transactions, we are also looking for opportunities where we can give exits to angel investors. We don't like, a cap table having 100 investors. So we want to make sure that the cap table is reduced to as few investors as possible. And similarly, a company like PharmaRack, we invested in 2019. We just sold it just like a few weeks ago, just because there was somebody just wanting to buy this. I think the corporate India is also now looking for opportunities to buy out. Reliance is looking to buy out. Quite a few startups have done that already. So I think that the whole idea of the whole ecosystem of looking for assets to acquire and buying this, and I think his mindset has already started building, and this is actually boosting the confidence amongst the LPs, and is therefore also creating newer LP classes like Sunil mentioned. The pension funds. I think even they've started now, while the policy was not there earlier. Even if there was a policy, I think they would still hesitate if there were no exits or no demonstration of exits. Now I think they're seeing that this asset class works, and I'm quite bullish that in the next few years you will see more and more newer categories of LPs coming and investing in funds like ours, and therefore it's very good for the ecosystem. There'll be newer funds that will be set up. In fact, quite a few funds were set up last year. We'll see a lot more new funds coming this year, and hopefully that should be very, very positive for the entire startup ecosystem.
Shashi, if I may add something out here, I must compliment Vikram for one aspect. We are all familiar with the terminology called unicorn. There's a new terminology for which the Vikram has set a benchmark lately, which is a dragon in a portfolio. Dragon returns are the one wherein one company returns the entire fund corpus back to the investors. Okay, and that was missing in India for long. There are 5-6 such companies that have fund that have made an exit. Vikram's one exit of Purple, wherein 1.35 times of the fund was exited by one exit. Now, these are the exits that give confidence to the investors that one company in a portfolio can give the entire money back. It is 4 to 10 times difficult to have a dragon in a portfolio versus having a unicorn. So, that means you have to invest in a company far, far earlier and take some stake in the company and then double up. More and much such exits will happen. That will set a new benchmark for India.
Agree totally. And in fact, as Vikram started, the early memories of people who've invested 10 years and 12 years back into those high-profile private equity funds and real estate funds had a bad experience. But now people have been able to erase those memories only because of funds like this, which have been able to return money back to the investors in a shortened period also. I'll come back to you, Mr. Mehta. And your firm has done good enough research on the startup ecosystem. And I would like you to throw some light on how iSafe is benefiting investors in the startup ecosystem.
Sure. Thank you, Shashi. That's a pertinent question for 100x. We are in First Check VC fund, and we invest before all the guys, be it Sanjay, Nath, Sunil, and Vikram. We take the first check, invest very early, like how angels would do across. We are more like a discovery platform, and the idea was to invest into large volume of deals, 100 deals a year, while we have not been able to achieve the target, but hopefully very soon. Right now we are at 50 deals kind of stuff. And iSafe, safe notes have been very popular in Silicon Valley for early stage investing, and we pioneered that in India. And in the recent survey, we checked out with almost over 200 plus founders and near to around 100 odd investors. And almost 67% of the founders found it very, very useful to quickly close a round, get the money into the bank account. While shareholder agreements take anywhere around 3 to 4 months to close, iSafes are done like over the counter with investors. And for the investor side, it has been a huge benefit using iSafe. Almost 72% of the investors said that they have liked using iSafe. And because we have made it open source, people can just download and use it across. So it is now becoming like a standard in the industry to use across at early stage closure. So for a quick deal closure, iSafe has been very, very handy for investors, and it helps across, get out of those valuation discussions at early stage, close it very quickly without getting into so-called rights and legal discussion, which typically shareholder agreement would have across. So in that sense, it becomes a great opportunity to close a deal very quickly using safe notes. And India, simple agreement for future equity. Anybody can download it from 100x and use it across. It's open source document.
Yeah, that's a big plus point for the investors. So coming back to the forum, and I would leave this question open to anyone who wants to take it. Will we see a flurry of IPOs coming from the unicorns or the startups which have matured? We're hearing Policybazaar, Swiggy. What's your take on this sentiment?
So if I were to share the survey insights, we had one of the questions in terms of how would we be seeing across IPOs. Almost like 65% of the investors said yes. 16 said didn't have a view, and 19% said it will not happen. So sentiment-wise, if you look into the survey, a lot of the investors are looking at IPOs happening. With revised SEBI guidelines, on the innovator growth platform, listing is going to be becoming easy. So hopefully that flight of capital, which was happening earlier, will now not happen across. And hopefully we'll see those IPOs maybe in 2021, not in 2021, maybe in 2022, but it should happen across. For investors, this is a great opportunity to exit. So IPOs were non-existent in India earlier. Hopefully we had very few like IndiaMart, Naukri, which are like hardly anyone. Quick Heal was one venture funded which got listed, but not really, we didn't see large amount of listed startups. So hopefully, yes, and most of the guys here who are up the value chain after 100x would have much more insights, be it Sanjay, Vikram, and Sunil.
Yeah, Shashi, I'll just add to this. It's definitely going to happen, right? You see Dipinder at Zomato and, Yashish at Policy Bazaar already talking about them. These are very institutionalized cap tables. You look at the quality of the investors who are coming in, they're almost public investors, right? If you look at the proportion of public, these large investors that they're investing in public versus privates has increased. So it'll definitely happen. LPs will also push that, and I think it's good for the ecosystem. Just coming back to something that Sunil and Vikram were talking about, I think on a lighter note, we need some new animals also, right? We've got unicorns, we've got dragons. But it's an interesting point about dragons, for Vikram, in the sense that I think as an industry, we all get excited about the hot new deal. And I think we don't have enough discipline about thinking of exits, right? And I think so it's kudos to Vikram to do that, because that's what LPs and eventually are rewarding you for, right? You say you're the most active investor, that's great. And think about the quandary you have. Imagine it's already a dragon for the fund. So you say, should I exit? Because now it may become 2x, right? It becomes a 2x dragon. And then there's an opportunity cost to that. So I feel that what will be good for the industry is when these IPOs happen, it'll also instill a different sense of discipline on us to think about exits in the same way, give it the same attention that we give investments.
Yeah, which is very important that exits also happen in a disciplined manner. Yes, Sunil, you want to add something?
Sanjay Mehta talked about, because this is a forum of the wealthy, I just want to emphasize on the point of IGP, the Innovative Growth Platform. SEBI is coming up with this guidelines from the point they are revising the guidelines, and they're revising it from the intention to have a NASDAQ in India created. Now, for that to happen, we need people who are accredited investors, who can invest minimum 2 lakh of rupees in a company, nurture and hold on to that particular investment. We VCs are going to be looking forward to that route to list our companies and then grow from there, because we'll have a fungible currency. We'll be able to acquire businesses, we'll be able to grow faster. So what Sanjay Mehta talked about, for early stage VCs like us, Innovative Growth Platform will be a good platform. You may be able to invest in companies at $100 million, $200 million kind of valuations. You don't have to wait for the IPOs at unicorn valuations to happen on the BSE or NSE. So that opportunity is another one coming up.
Thank you. Another very important question that I want to ask you all is that what is the India opportunity that we are witnessing? We're seeing a lot of B2B and SaaS platforms being built in Bangalore, Gurgaon, Pune. Is this a big opportunity for India?
Maybe I can go first. And I think the way I see it is that B2B opportunities are, India startups catering to the world. And I think basically a lot of that is happening. Indian companies are building very good products. Sanjay talked about Freshworks, and I think it's a great example, how they've been able to take their business to all the corners of the world. And there are quite a few in the making when it comes to B2B. On the other hand, when you're talking about B2C, I think people even from outside are actually eyeing the India consumer markets. It's a huge consumer market, which is actually further building up with the internet penetration going deeper into remote areas. Rural is a big opportunity. Anything which is in tier 2, tier 3 areas coming up in a big way. So I think on the B2C side, more and more opportunities will come up. And I think we're going to see newer kind of opportunities of business models building up there. So that's broadly how I would classify.
Just to add to that, product first engineers from these cities coming at and developing products, whenever we are investing, we have to keep in mind whether in our investment horizon, the company can be $100 million revenue company or not. And that for a B2B business, it is essential for them to service customers globally. They cannot be done only from India. The amount of revenue of Zoho or Freshworks that comes from international markets is a testimony that we have to make that those companies have IP, get that enterprise orientation to go and seek customers worldwide and serve them. If that is ingrained in the company from the beginning, we can see B2B and SaaS businesses scaling up faster, better, and defensible business models will be there.
Very well said. And while we're already shooting through our timelines, and it's been a very interesting discussion covering. And to summarize, I would say it's a very, very sunshine area for the investors from the investor point of view, and also for new promoters who are looking at newer areas of developing businesses. Funding is faster, more LPs to invest in. Any closing remarks from any of y'all on the system? Anything that y'all want to say? Otherwise, we'll then take up some questions.
Okay, one remark which is personally very, very close to my heart. We keep saying angels should be investing in startups. Startup money has to come in from every pocket, every individual, because we want the children of ours to be having a job. Entrepreneurship, innovation has to be nurtured by each and every one of us. Today, there are national pension scheme, NPS, we save some money, 50,000 rupees a year. Government of India has given you the privilege to do an active choice and allocate 5% of that 50,000 rupees every year towards alternate assets. We are not asking for something big, but at least start allocating that 5% by going and making an active choice. Don't be a passive investor with your NPS. This money is going to be there till the time you're 60 or 70. Put that money into alternate assets by allocating only 5%. That's a very, very heartening appeal so that we have larger pools of capital for our startups.
To add to what Sunil said across, and echoing the sentiment, personally, I've been an angel investor, and investing into startups, almost 150 odd companies. My IRR has been over 100% last 10 years. So it has been extremely rewarding. So I'm just trying to add to what Sunil mentioned across. This is possibly the only asset class where you can influence an outcome. You buy real estate, you buy equities, you can't influence an outcome. Here you can work with startups closely, nurture them, mentor them. We invited Sanjay Nath for our mentoring session, and what a beautiful session he took across. So people like Sanjay and Sunil's partner, Girish, who did a great fab job helping us nurture and mentor startups. It's just amazing how this young companies can be nurtured and blossom to a bigger and larger company. So I would recommend across a lot of the listeners and audience, startup is an asset class where you should look and invest in.
I'm sure listening to all of y'all and the kind of startups coming our way, the kind of returns that one could expect, all investors should compulsorily allocate a part of their portfolio to startups. And you have now a lot of VC funds which are very accessible, and people could look at doing their bit in their portfolio with this segment, which is slowly emerging as a necessary segment in one's portfolio. With that, I thank all of you all gentlemen to be with me in the panel. It's been great talking to you all. Is there any questions we want to take? Yes, Sunil.
Thanks for hosting it so well.
Thank you so much.
Yeah, so Shashi, I'll just come in. Audience, if you have any questions, please put it in the Ask Question tab quickly. We have only a few minutes left for the next session, so I think we can take 2 or 3 questions at max. Okay, there's a first question to all the panel members, which is the one sector that is seeing the majority of new startups right now?
I think deep tech SaaS is the biggest winner into that sector.
Yeah, I think same thing. We're seeing a lot of AI and deep tech startups coming up.
I would add EdTech also to that. I think what is interesting about AI is absolutely agree with Sanjay and Vikram, and in fact Sunil's core is that I think what we're seeing is AI being applied to different use cases, right? Earlier AI was only for B2B, but you're seeing that for vernacular content, you're seeing it for healthcare, preventive heart attacks and strokes. And I think that's the way, right? If you can apply deep tech to real world impact issues, correct? So I think, and EdTech, of course, is also taking up because the way, everybody from children to everyone is learning and upskilling is changing.
So when Sanjay mentioned about healthcare startups and using AI, one more dimension, if it is the data is for AI is being captured using sensors and IoT, the reliability of that data is multiplying. And if you can use those tools to capture the data and then analyze and then give a feedback on the health of a person is going to be far more valuable rather than any data being fed in manually or so. So that's how we are seeing the trends would be more AI, IoT, sensor-led startups.
Sure. So the next question for all the panel members here again, are your funds, do your funds have any plan of investing in international startups? Are you already doing it or plan to do it in the future?
At 100x.vc, we only invest in Indian startups. We don't invest. Personally, our family office, we have got almost like 60 plus startups invested globally.
So I'll just add to this, before Vikram, if you think about cross-border deep tech SaaS that we've just been talking about, right? And you think about the cross-border corridor, we just talked about the importance of, building products and selling them to global customers. So many of those companies in all our portfolio, they have R&D and CTOs and founders here. But very often one of the founders, the CEOs and the head of sales are based in North America, Singapore, wherever it is. So de facto, you are investing in companies, but they are outside, but they all have an India angle. They have an India connect, right? But they basically, like, I think one of you put it beautifully, built in India, but, built in India for the world.
Yeah, no, same as what Sanjay said. We technically invest in INR, it's Indian currency, but we have been investing in a few startups which have global footprint. That even founders have moved to the US and are doing very well. So as long as they have an India connect and in India subsidiary as well, so I think we can look at investing in them.
Sure. Next question: do you foresee VCs partnering with wealth managers or financial advisors so that their clients can get exposure to startup investing? Are you working closely with the wealth management community to reach out to HNI or super HNI?
That's a very, very welcome question. We would love to engage with any and every wealth manager in the country, take it to deeper into the people who are having wealth. I must tell an incident. In 2001, I joined Bharti Airtel. Within 2 months of this thing, we had a board meeting and Sunil Mittal made a pitch to Warburg Pincus and others, $300 million committed by them. And in the next 4 years, they went back with $1.2 billion. And when they went back by $1.2 billion, I, instead of rejoicing, I was saddened that an opportunity that was so large and so visible like telecom, not a single Indian could get an opportunity to invest in that asset class. Today, we have this opportunity. We are investing in early stages of these companies which are having future, and so this is an asset class. We are taking it to everybody, and we want to partner with more and more wealth managers and kind of educate the HNIs that this is a reliable asset class which can deliver alpha returns versus any other asset class that they own.
Yeah, I can add to this, Shashi. This, the best question has been saved for last. I think it's actually a wonderful opportunity. It's not only are we okay doing it. I'll give you an example. I mean, this is in the public news. Vikram knows, all of you know, one of our partners, Ashish Fafadia, who, and here's the interesting part, right? When you have an interesting, good portfolio, there's a lot of interest into it. If you look at the rise of domestic capital, I can't think of any homegrown manager today that doesn't go after domestic capital. And I like the way Sanjay Mehta used it. We look at all of you as partners, right? Not as investors, because it's not just the capital you're bringing in, but the mentorship and the ideas and advice. And we've been raising opportunity funds in addition to our core funds, Shashi, right? You also may be aware, where you either have a blind pool or you have a basket of securities. And it's a great opportunity for wealth management platforms and investors to do direct angel investments, to invest in funds, to invest in opportunity funds. We actually say, do all of the above. There's no one right answer, right? Because all of them have different risk return characteristics. It's a fantastic way to be part of the ecosystem. And we were really surprised because, on a lighter note, earlier you would take a plane to Calcutta or to wherever, to Baroda or Jodhpur for 2 meetings. And now you're sitting and you can do eight meetings a day on Zoom. And you're seeing a patriarch, who runs the family office, dying from Calcutta, the son who is abroad just finishing his studies, all on that Zoom, and you're doing 6-7 Zooms in a day. So I think it's not only is it okay, but it's a wonderful opportunity to participate in the wealth creation with us, and we're happy to do that.
I would like to add, having associated with one of the largest wealth management outfits in the country, that wealth managers are the bridge between the startups and the startup funds and the investors. And this is the route to bring more and more investors into the startup arena. And we're seeing a lot of increase in interest and positivity from investors to look at it.
Sure. So thank you so much, Shashi, and all the panelists. I'm afraid we are out of time because we have a next session and a speaker has already joined us here. So on behalf of all the participants and the AIW Bank community, I'll like to thank all of you, Sanjay Mehta, Sanjay Nath, Vikram, and Sunil, and of course, Shashi, for putting up this fantastic panel. Discussions like this, you just can't get enough of them. But I think paucity of time will have to kind of wind this up. Hopefully, look forward to keep engaging on similar discussions in the future. So thank you all, and take care and stay safe. And we move on to the next session.
Thank you.
Thank you all so much. Thank you. Bye-bye.
So audience, continue to be seated. I think we'll quickly move on to our next session by Mr. Brian Kelliher. Brian, I believe you've already joined in. Hello, Brian, can you hear me?
Can you hear me? Yeah.
Yeah, I can hear you. But
Hi,
I can't.
Aditya.
Yeah. So if you could, yeah. Okay. I'll quickly help you set up the. You'd like to run a PPT, right?
Yes, please, Aditya.
Yeah. You're the co-host now, Brian. You can just put up the PPT. We'll start another couple of minutes. Yeah. Can you share your screen, Brian?
Yeah, just about Aditya. Just 1 second. Can you see that, Aditya?
Yeah, it's visible. So we'll just get started in another couple of minutes. Yeah.
Okay, perfect. Yeah, we can see that. How do I page up, page down? Oh, and I go here. Yeah. Okay. Perfect. Thanks.
All right. So, audience, we'll get started with our next session, which is going to take us through how the Irish ILP is a means of accessing European capital. With us as a speaker for our next session is Mr. Brian Kelleher, partner, Dillian Eustace, Dublin, Ireland. Brian's firm has been at the forefront of facilitating investments for Indian companies in Europe through Ireland. And Brian has been part of various thought leadership and advocacy efforts through IAAIF also in the past. So Brian, welcome back to an AIWMI session. Regret we can't have you in person here this year, but hopefully soon. And looking forward to your session. So apologies, we're running a bit late, but we've got another 20 minutes, so take your time. If towards the end of the session, if there are any questions for you, I'll be happy to take those on behalf of the participants for you. So over to you, please.
Thank you. Thank you, Aditya. Hello, everybody, and good evening to all listeners in India. As Aditya mentioned, I'm a partner in Dillon Eustace, a law firm in Dublin in Ireland. Some of you may know me from previous summits where I've personally attended. Delighted to be invited to participate in this year's summit. And indeed, I look forward to returning to Mumbai, perhaps next year or 2023. So the purpose of today's presentation is to focus on the Irish Investment Limited Partnership and perhaps discuss about its the interest Indian investment managers may have in that ILP structure. So over the next 15 to 20 minutes, I propose to give an overview of the Irish Investment Limited Partnership, or ILP as we call it. So I'll focus on maybe the structure and the parties to the ILP, the liquidity profile and the key features and the tax status of the ILP. And then I'll finish up by talking about the marketing of the Irish LP. So to begin with, I would like to give a snapshot of the Irish funds currently. And this particular slide shows, as of the end of February of this year, assets under management in Irish domicile funds. And you can see from the slide that there's over 3.3 trillion in assets, European assets under management. And 75% of those assets under management are attributable to UCITS structures, and 25% are attributable to AIF structures, which would include the ILP. And this figure is expected to grow significantly over the next couple of years when, I suppose, as a result of the renewed focus in the ILP, and I suppose focus as well on the real asset sector. So to begin with, just to give a brief snapshot of the legislative and regulatory framework applicable to the ILP. So it has been on the Irish statute book since 1994, but it's as a result of an amendment to that act in December of 2020 that has brought about renewed focus and vigor in the ILP. Those amendments very much ensured alignment with international standards and expectations of investment limited partnerships. And as I said, as a result, it has been very much revitalized. The ILP is an EU AIF, an alternative investment fund, and consequently, the Alternative Investment Fund Managers Directive is applicable to it. And I'm sure most of you are familiar with that in the context of European AIFs. And certainly, if in respect of an Irish ILP, the AIFMD legislation applies. And then closer to home, because it's a regulated structure and our competent authority is the Central Bank of Ireland, the Central Bank's requirements are set out in an AIF rulebook, and so that's very much applicable. And in addition, the Central Bank issues guidance in relation to AIF structures, and whether they be open-ended or closed-ended. So just some information on the structure of the Irish ILP. It's not a corporate structure, and therefore it doesn't have any separate legal personality. It's constituted by way of a partnership between one or two general partners and the initial limited partner. All contracts are entered into by the GP itself. Given the ILP, it does not have a separate legal personality. And one of the key distinguishing features of the Irish ILP is that it can be established as an umbrella legal structure. So I suppose the merits or the advantages of that are it brings about economies of scale and speed to market where you want to establish other sub-funds within the umbrella. So essentially, it's one legal structure with separate sub-funds being pools of assets where the investment objectives, policies, and strategies may be different for each of those sub-funds. Importantly, there is statutory segregated liability between those sub-funds, and indeed, the LPA, the Limited Partnership Agreement, generally provides for contractual segregated liability as well. So focusing on the parties of the Irish ILP, as mentioned, the general partner is involved in the management and operation of the ILP, and it is the GP that assumes unlimited liability for the debts and obligations of the ILP. And therefore, typically what we see is that a single-use GP is used for each separate ILP structure. The GP is considered a regulated fund service provider in Ireland, and it's subject to the Central Bank of Ireland's fitness and probity regime, but it's not subject to authorization by the Central Bank itself. The GP is responsible for the issuing of the offering memorandum and for the publication of the audited financial statements, which generally must be published within 6 months of the financial year end. The GP also has statutory obligations under the LP Act, such as providing information and reporting to the competent authority here, being the Central Bank, and also to maintain statutory books of the ILP. So the limited partner itself can be a natural or a corporate person. Like most limited partnerships, it can negotiate with the general partner on behalf of the ILP specific terms to it in a side letter. And generally, those tend to be around the level of reporting and disclosure to the LP, perhaps different fee arrangements, liquidity arrangements, and you may also see the LP being excused from participation in certain assets where the exclusion is required for the purposes of regulatory or tax purposes. The limited partner has limited liability, so it doesn't have liability for the debts and obligations of the ILP, provided it's not involved in the conduct of the business of the management. But importantly, the amendments to the LP Act in December 2020 made clear that the limited liability status of the limited partner is not impacted by the LP being involved in certain matters, such as, for example, participation or membership in the advisory committee, or voting on certain matters, for example, termination or dissolution of the LP or the ILP rather, or voting on changes to the LPA, or other voting issues around, for example, the investment objective policies. Because the ILP is a regulated AIF structure, the appointment of a depository is required. Now, there are multiple choices for the appointment of a depository in Ireland, but generally, because the ILP tends to be investing in illiquid assets, it's a real depository, real asset depository that's generally appointed, and the real asset depository has the benefit of not being subject to the full, I suppose, authorization requirements and liability requirements, which most depositories have under the AFMD regime. As mentioned, because the ILP is an EU AIF, an AIFM must be appointed. There are a number of considerations here just to be borne in mind. If it's possible for an EU AIFM to be appointed or a non-EU AIFM. And if an EU AIFM is appointed, well, that AIFM needs to comply with the full AIFM directive and requirements. If a non-EU AIFM is appointed, the obligation is on the Irish ILP to ensure that it and the non-EU AIFM complies with the local requirements that the central bank imposes on the ILP, but also certain provisions of the AIFM directive needs to be complied with. So this slide gives, I suppose, a chart setting out the typical structure of a single strategy ILP. This is a non-umbrella ILP. And you can see that it's the general partner that appoints the real assets depository, who may in turn appoint a sub-custodian if required. You'll also see that it's the AIFM. Now, this is whether it can be, as I mentioned, an EU AIFM or a non-EU AIFM. And it's that entity that's responsible for the management of the ILP. And it can perform those functions itself, or alternatively, it can delegate the performance of some of those functions to an investment manager, for example, who can be based, for example, in India, or it can delegate the marketing of the ILP to a placement agent or a distributor. And it also appoints the administrator responsible for the fund administration, the transfer agency of the ILP, and it can also appoint separate specialized service providers that, depending on the strategy of the relevant, I suppose, ILP. So, for example, if it's a real estate fund, you would see an independent valuer being appointed. The next chart or slide gives you a flavor of what the umbrella ILP looks like, and you can see that that this structure here, or chart here, focuses on subfund 1 of the ILP. But the important point to bear in mind is that this same structure applies to each of the other subfunds that may be appointed, because the umbrella ILP is one legal structure, and what is established are separate pools of assets, which, as I mentioned, can be managed in accordance with different investment objectives, policies, and strategies. And consequently, what you're seeing are service providers that are common to each of those subfunds. And so the general partner, the depository, and the AIFM would be common to all subfunds. And indeed, there may be other common service providers, depending on who the AIFM appoints. But the AIFM may choose to appoint depending on the particular strategies of the funds, may choose to appoint a different investment manager, for example, for different sub-funds, or alternatively, the promoter sponsor may wish to act in respect of all those sub-funds. So there's a lot of choice and discretion there in respect of different sub-funds. So now, while I explained that the Irish ILP is a legal structure, it can be established as one of two regulatory structures. So it could be marketed, for example, to retail investors, where it would be considered a retail investor alternative investment fund, or RAIF, as we sometimes call it. And as you would expect, where an ILP is sold or any AIF is sold to retail investors, the regulatory obligations are much more onerous, and indeed the dealing frequency is I suppose much more periodic, in order to give retail investors an opportunity to redeem. The other type of regulatory structure is an AIF that's marketed to qualifying investors. And these investors tend to be professional investors, or other investors that have been appraised as having the necessary expertise or experience, or alternative investor who certifies that they are an informed investor in accordance with certain prescribed criteria. And as one would expect, where you have an AIF that's sold to those types of investors, the requirements of the central bank are not as rigorous as those that are applicable to an AIF that's marketed to retail investors. The other feature of an AIF marketed to qualifying investors is that there's a minimum subscription, or in the case of an ILP, a minimum commitment requirement of €100,000. And I suppose the other important point that I would raise is that QAIFs may be established as open-ended, in which case investors can have an opportunity to redeem on a periodic basis, or they can be open-ended with limited liquidity, in which case the investors have a limited opportunity to redeem their shares or interests throughout the life of the fund. Or alternatively, the QAIF can be set up as a closed-ended fund, depending on the nature of the assets and duration of those underlying assets. So turning to the liquidity profile of the Irish ILP, because the ILP typically invests in private equity, venture capital, and other illiquid assets, they tend to be established as QAIFs, in other words, AIFs marketed to qualifying investors, and they tend to be established as closed-ended funds. And that probably can be explained by the fact that a lot of these illiquid assets, the value can only be extracted after a certain period of time, and therefore it's important that the funds or the ILPs are closed-ended. And I suppose common to other closed-ended limited partnerships, what we'll see in some of the following slides are some key features which are there to protect the interests of the LPs, considering they are investing in these structures for the medium to long term. One important point, however, in relation to closed-ended funds that are established is that there must be a finite term. And at the end of that finite term, the GP has discretion to either to wind up the limited partnership, or alternatively convert to an evergreen or open-ended ILP, or alternatively extend the closed-ended period with the approval of the LPs. So turning to some of the key features of the ILP, so mentioned excuse and exclude provisions, which are important to LPs, again, who are invested in a closed-ended fund, and who don't want to participate or cannot participate in a particular asset for regulatory or tax reasons or whatever. And the important point is that excuse and exclude provisions are permitted by the central bank, subject to certain opinions being obtained by the LP, setting out the basis on which they're invoking that provision, and the GP and the AIFM being satisfied with that opinion. We mentioned side letters previously, and I suppose there's some regulatory provisions to be aware of. Clearly, there can be preferential treatment given in side letters to one LP, and it's important that other LPs are not materially disadvantaged by those. And as in addition to that, it's important that the types of preferential treatment and the types of alternative investors availing of that preferential treatment are set out in the LPA and the offering memorandum. Defaulting investor provisions are very important in order to protect the interests of the non-defaulting LPs and particularly and perhaps also the ILP. Importantly, the ILP Act confirms that any defaulting interest provision would not be considered unenforceable because of the penal nature of that provision, which is an important point in the interest again of the LPs and the ILP. And it's generally the case with defaulting provisions that the general partner or the GP is given full discretion to try and avoid the defaulting event, and therefore it's generally given discretion to permit cure periods. And another feature of the Irish ILP is the advisory committees, and where LPs can participate and represent the interests of other LPs and ensure that their interests are aligned with those of the GP and the investment manager. And finally, one of the additional key features I just want to raise is the carried interest provisions, whereby some of the income and gains and losses are reallocated from the LP investors to the management, whether that be your GP or the investment manager. And generally, the LPA and the offering memorandum will provide a distribution waterfall mechanism whereby the management will receive their participation once expenses have been paid and the LPs have been repaid their paid up capital and any expected, I suppose, preferred return or hurdle rate. So as a regulated AIF structure, there are regulatory disclosures to the LPs, whether they be pre-contractual, periodic, or an annual basis. And I've summarized some of those on this slide. So turning to the taxation framework applicable to ILPs, importantly, the ILP is treated as a tax transparent vehicle from an Irish tax perspective, and therefore the income and gains and losses are deemed to arise and accrue to the limited partners as if that income and gains and losses had not passed through the hands of the ILP. Importantly as well, distributions that are paid by the LP to the LPs are not subject to any Irish withholding tax. Now, although the ILP is not considered tax resident in Ireland because of its tax transparent nature, and therefore the ILP itself cannot avail of the double taxation treaty, individual partners may be able to avail of treaty benefits in their own jurisdiction in order to avoid or reduce withholding taxes from underlying investments. And where that's not possible, it's also possible for the ILP to establish a holding or special purpose vehicle so that perhaps the treaty benefits in the jurisdiction of that vehicle can be availed of. And I suppose the other point I'd just like to raise that while the ILP is considered tax transparent from an income and a gains perspective, I suppose from all other purposes it's not, and therefore it can register for VAT and avail of VAT exemptions, and there's no stamp duty in any assignments of the ILP interests, and which is an important point. And similar to all other funds, it's treated the same for FATCA and CRS purposes. Finally, I just want to turn to the marketing of the Irish ILP, importantly, the big advantage of the Irish ILP is that it can be marketed throughout the EU, provided an EU AIFM has been appointed. because the EU AIFM has a passport under AFMD, it can market the ILP cross-border throughout the EU without having to seek authorization in each individual EU member state. It's also possible for the AIFM to provide to appoint a local distributor or placement agent in order to market the ILP in specific EU member states, provided that distributor or placing agent has the relevant license. If a non-EU AIFM is appointed to the ILP, then it's still possible to market the ILP in the EU, but it will be subject to the national private placement regime in each relevant EU member state. And finally, I would just like to add that it's also possible for an AIFM to appoint a non-EU distributor, such as, for example, an Indian or distributor, and they can potentially market the ILP into individual EU member states, provided they're availing of the safe harbor provisions in those member states under the relevant MiFID provisions in that member state. Importantly, the ILP can also be marketed outside the EU, and for example, in the US, it is possible for the ILP to attract both taxable investors and non-EU taxable investors, given the tax transparent nature of the ILP. In conclusion, what I think what's important is that post-pandemic, it is expected there will be a lot of opportunities for investment in private equity, venture capital, infrastructure, and other real assets. And Indian investment managers, similar to international investment managers, will no doubt be seeking tax-efficient solutions in order to be able to finance those investment opportunities. I think my message today is that the Irish ILP is expected to become the fund structure of choice, and particularly where it's intended to take advantage of the European capital markets. That concludes my presentation, and thank you very much for listening. And I might just hand it over to Aditya to see if there's any questions that I can answer.
Brian, I'll have to request you to take these questions offline, as we've kind of finished time, and there's another section now which is going to happen. So can we share your presentation and details with all the participants so that they can reach out to you?
Please do so, Aditya, and thank you for that.
Yeah. So thank you so much, Brian, for joining in. I'll get back to you after the event is over, and we'll be happy to kind of help you connect with all the participants here.
Great, very much. Thank you very much, Aditya. Bye-bye.
All right, so all right, so I think without further ado, we should get started with a ceremony that has been in the making for almost 4 months this time. I'll quickly request all my fellow jury members to, if they can start their videos, I can, and we can quickly check who all are already here, who all have joined. Hey, hi Shiv, good evening.
Good evening, Aditya. Good evening, everybody.
Hi, Sanjay.
Hey, good evening. Good evening to all.
I believe Shiv Sehgal is already here. Punita is also
Hi,
here.
hi everyone.
Anurag has not joined in. I think we should get started because we're already running 10 minutes behind schedule. If that is okay. I've messaged him though. So guys, can we get started or should we wait for him?
I think let's kick off.
Yeah, because I think we are anyways 10 minutes late. If he's able to make it, I'm sure he'll join sooner or later. Punita, you there? Okay, I can see Punita online, but not responding. Guys, give me just 1 minute. I'll quickly ask her on the call and then we can get started. Okay, so I can't really reach Punita. She's not picking up. Nevertheless, let's hope she joins in quickly. But we'll get started. So thank you everyone for joining in. And as I said, thank you for patiently waiting for this entire campaign of Top Under 40 to culminate. This year, we've taken almost 4 months to complete this campaign. Sorry, more, I believe it's more, almost 5 to 6 months. We launched it sometime in November, December, and we are now almost in May. And can't really thank enough my jury members, all our jury members who've been patiently participating in this process this year. All the first 3 years, and Shiv, you're a part of last year, you'll agree. I mean, all the first 3 editions, it was all a start to end, start to finish kind of a marathon jury meeting where we could take a call on who are the shortlists and who are not. This year, thanks to the just the diversity, the sheer diversity of the profiles, or you just say the kind of or maybe the change in the campaign also for us, it was slightly more difficult to pick those top under 40. But yeah, as I said, thank you, jury members. We almost took 3 meetings this time, unlike first 3 years when we could finish it off in 1 meeting. So that goes a long way to say that the finalists who've been chosen today have definitely gone through multiple rounds. I mean, we've taken their profiles through multiple rounds of discussions and search at our own ends. And finally, we have the list for this year ready. A small change between this year and earlier 3 years. Earlier 3 years, we were calling this campaign 40 under 40. And we used to select 40 people every year from the alternative investment space. But as we completed the first 3 editions, and we already have that pool of 120 winners. Unlike all other campaigns, it was always a conscious call that we don't want to repeat our winners, so that we are able to acknowledge more people in the industry, and we are able to kind of recognize them for the great work they're doing. So that call was taken right in the beginning, in the first year, where that we will not be repeating our winners. And so after the 3 editions were over, this year, the jury collectively decided that we are going to not compulsorily select 40 people under 40. We'll keep that number open. If we find good profiles, we'll select them. If we don't find good profiles, we'll not be under compulsion to just put any candidates through. So that goes a long way in telling all of you, all the audience, that this winners for this year have really not got it easy. And add to it that 5 months of wait. So all I can say is, guys, times are such, none of us could help it. But finally, we are here. It would have been wonderful to catch all of you in person or during an event, live event, on-ground event. But we have to do with this virtual thing right now, with a promise that whenever things get back to normal, all of us gang up and we get all your 120 seniors from the first 3 editions together and have a mega party. So on that note, I'll quickly invite all my jury members to join me and share a few words about their experience of being part of this entire process, and their insights, and any suggestions or tips they would like to give the winners or the others who would like to nominate themselves in the future editions. So let me start with you, Shiv Sehgal. We both have been a part of this for 2 editions, so I thought let me start with you. You will be just share your views on how the process went this year.
Sure, thanks, Aditya. I mean, I guess before we get into that, just want to let everyone know that the current situation with the COVID has plunged our country into definitely uncharted waters. We are everyone is kind of looking at ways of rebuilding the country and the economy. And I guess the success of all industries, including wealth management and the AIF industry, will depend on our ability. Everyone was on this call and all the jury members along with the awardees to bounce back from this challenge and deliver on the full potential, that the sector presents. And for me, if the current crop of winners of the top 40 is anything to go by, I would say that the alternative industry is in very good hands. It was very pleasing to see the talent, the confidence, and the enterprising nature of every candidate. As Aditya mentioned, I think we took a lot more iterations. There was a lot more deliberation this year. There were a lot more debates on the making sure that we recognize the right candidates. And I'm glad that AIWMI and Aditya at the forefront is taking initiatives, taking the right initiatives to build this ecosystem and recognize the next generation of talent that is entrusted with furthering the space. So I'll keep it short. We're running behind time, but congratulations to everyone on this awardee, and to all the candidates who applied. I think you're all winners in your own right. My only advice would be that to learn from the current crisis I think we faced this year. I think every ecosystem is adopting to digitization and embracing flexibility, and I think that's going to become a way of life forward. We are doing this virtually. I really hope that going forward we can probably do it the big party bash that Aditya has promised. But congratulations everyone, and over to maybe Shiv Gupta to kind of say a few words.
Okay, thank you, Shiv. Thank you, Aditya, as well, for letting me be part of this jury. I think it's a real privilege for me, because I think that alternative investments are a very important part of the capital markets and investment management ecosystem, and they've been growing leaps and bounds over the last few years. And I think that kind of exponential growth is set to continue. And it's important for us to recognize the people and the talent that populates that ecosystem, that contributes to that ecosystem. So thanks for that, and absolutely echo Shiv Sehgal's words on congratulating all the people who've been part of this, not just the people who are being recognized specifically, because I completely expect that in the years to come, some of the people who've been nominated and not recognized will nominate themselves again, because we think that they deserve to be recognized with a few more things that they can do in the interim period. So please do nominate yourselves again, is one message I'd like to carry to people. It's also been a pleasure interacting with this illustrious jury and the lively debates that we've had. Like with anything else, I think we've also had to improvise using the digital medium. But I don't think that in any way that impaired our ability to get down deep into evaluating things that we thought were important. And I thought that process was very lively and very enriching for me, certainly. And also what struck me was the diversity of the nominees, right? And Aditya, you mentioned this, that if you're talking about the growth of the ecosystem, right, it's not just the investment managers who are going to bring about that growth of the ecosystem. There's people who are responsible for the operating architecture, the legal architecture, the investor awareness, the distribution architecture, the regulatory piece. And it was very pleasing to see that diversity of profiles across and the kinds of contributions that different people are making. And I really, really hope that continues to broaden as we go along. Because once again, I mean, the size is set to grow quite dramatically from where we are. Just a note to the nominees and those who nominate future nominees as well. I do think that these nomination processes have some inherent limitations.
in terms of information. And the more work someone puts into making clear what their contributions are, the easier it is for jury members to actually, bring them to life in their own minds. So, specifically bringing out your contributions to the ecosystem can really help strengthen the candidature. And also using testimonials, because that's the best validation that you have for the work that you've done by people who recognize it. So I would just say to future nominees that, those are a couple of things that maybe they want to keep in mind. But other than that, as Shiv said, these are difficult times. I think, all of us are dealing with, a surreal environment in which we're operating, but we want to make sure that, we continue with the work that we do every day whilst taking care of those around us. And recognizing people in this way in a felicitation ceremony is in fact symbolic to that extent. So once again, congratulations to everybody and all the best.
So can we move on to Sanjay?
Thanks, Aditya. It was very interesting to see across various applications, especially coming from a VC world. Trying to see across what kind of alternative, fund managers are there. There were some wealth managers whom we had to, for some reason, because this was more from an AIF perspective, we could not include. But I would like to leave one tip or, a kind of advice to most of the, nominees who participated and could not win. And there were winners also, that try to increase your digital presence. It helps us, get to know you better. While application forms definitely, if you fill it in the right way, it gives you much more chance. But your digital presence, especially LinkedIn's. So we went across not just by the, the application, but we also tried to look upon, we did few calls across to people within the organizations, tried to do some ref checks. So it was a quite interesting process in every aspect, trying to get insights into it. And most of the jury members either would have some or other connect across to your organization. So I think this is a great platform and to make you shine. And I'm sure this honor or recognition, which has been, parted across by AIWMI and Aditya, is going to go a long way in your career and journey. And I wish all the best to all the winners and the participants also. Hopefully next year you would also be a winner. And I wish all the best. I think Punita is here. If Punita can take it up next.
Yeah, thank you. Thank you, Aditya. Thank you, everybody. And first of all, congratulations to all the winners for today. We, as a jury, had a difficult time deciding amongst very many qualified people. And we did our best, applied our judgment, and which isn't always necessarily going to result in everybody getting selected. So there will be obviously some people who are going to be disappointed, but I wanted to say that all of you, the very fact that you've been nominated and have been and reached a short list for the jury to review itself is a success that you should feel happy about. For me as a jury, I think this was a very good learning experience as well, interacting with other jury members, listening to different perspectives, as well as seeing how many of you are contributing in many different ways to the industry through the ecosystem and making it stronger. So whether it's from the legal profession or the operations side, in addition to just the fund management side, I think there is a whole body of industry that often gets neglected. And in this award, we have tried to make sure that the neglected professions that are also contributing very much to make the alternative industry stronger are recognized as well. So whether it's the wealth managers, the legal, as I said, So there are many, many ways in which you can contribute to the growth and strengthening the alternative investment profession. We've also tried to be sensitive to not just restricting ourselves to just one segment. So, we've tried to pick maybe the best from the wealth, pick the best from the legal, pick the best from fund management. So we've tried to, diversify and broad base our winners so that we don't concentrate just on one segment, because all segments are contributing to the success of this industry. We've also been sensitive to the gender diversity. Having said so, the women who have been selected haven't made it because they're women. They've made it because of their own merit, and they've contributed as much, if not more, than anybody else who's a winner. So while we've wanted to make sure that we don't end up in a situation where there isn't enough gender balance, we didn't have to worry about it, because naturally a lot of women also emerged into the winners list on their own merit. So I think keep up the good work. It's great to see so many young people as the future leaders. I've learned a lot about each one of you. Many of you I did not recognize earlier, and so reading through your profiles was a learning experience. As Sanjay said, I think, and Shiv has said, that for next year, those who didn't make it, please continue to keep up the good work. And when you do submit your application, I think it would really help the jury if you all communicate your messages as clearly as you can, as crisply as you can, without any errors, because sometimes if everything else you've done is great, but you've written it wrongly or you've made a lot of grammatical mistakes, that can sometimes put off some jury members. So I would recommend that you all, put together a very professional communication and a professional package, and give us as much information about yourself, including testimonials or recommendations. But thank you very much. And thank you to all the jury members for a very great learning experience and a wonderful interaction.
Thank you so much, Punita. So before we move on to the announcement of the winners, on behalf of our designing team, I must quickly express some regret to Shiv and the entire Edelweiss team. They have been our partners and co-conspirators in designing this entire campaign from day one. And before, we were just going to announce and put our communication out there in social media, and I realized design team has just not got itself updated with the logo of Edelweiss. So the Edelweiss team will get this thing sorted and get back to you. And winners, you'll have to wait for a few some time after the ceremony is over to get your individual banners and the report. We'll get that thing sent over quickly to you. So for now, we'll have to do with this particular PPT that we created to announce the winners. I believe we'll have to kind of continue with that. So Manan, are you ready? I'll quickly request Punita. Punita, if you could start. I mean, we can quickly get on to announcing the names of the winners. I don't think Anurag has joined in, so if you can please mention the names which Anurag was supposed to declare as well.
Okay. So I'm going to start. This list is alphabetical, so I'm getting the honor of starting with the A's first. So I'm going to start the announcements. Abhilash Sethi, the principal at Omnivore. Ami Sampath, Vice President at Derivium Tradition Securities. Amit Janwar, Director, Unitas Capital. Anjana Seshadri, Head ESG, NEV Fund. Archana Khosla Burman, Founder Partner, Vertices Partners. Should I continue Anurag's list as well?
Please.
Arnab Kumar, India Director Strategy, Payments and FinTech Process. Ashish Aluwalia, Co-Head Direct Equity, Consumer, Healthcare and Food, CDC. Ashish Ahuja, Managing Partner, IIFL Wealth and Asset Management. Jahnavi Papriwal, Investment Director, Avishkar Capital. and Kailash Nath, Vice President, Bharat Innovation Fund. Congratulations to all of you and keep up the good work.
Congratulations, all of you. Sanjay, can we please on to you? Sanjay, are you there?
Aditya, I don't have the names.
Okay, so Manan will help you. Manan, can you keep moving ahead?
Sure.
Yeah, Sanjay, that's on your screen now.
My screen.
I believe you're on the mute. Is it? No.
No, Aditya, I'm not able to get anything on my screen.
No worries, no worries. I think I'll ask Shiv Gupta to read out the
Yeah,
names.
please. Sorry for this.
Shiv, you have the sheet ready with you?
Shiv, you're on mute.
Sorry. Kisle Shashwat, Senior Investment Manager, Xiaomi Technology, India. Neeraj Ojha, Senior Vice President, Structured Products and International Business at Centrum Wealth. Congratulations. Nidhi Chawla, Director, Product Advisory, Kotak Investment Advisors. Congratulations, Nidhi. Ninad Mohan Hebat, AVP Legal, Kotak Investment Advisors. Congratulations, Ninad. Newtpol Handik, Senior Manager, AIF Products at Nippon India Life AIF Management Limited. Congratulations, Newtpol. Rajkumar Rathi, Vice President, ICICI Securities. Congrats, Raj. Rohan Paranjpe, Head Alternative Investments, Waterfield Advisors. Congratulations, Rohan. And Rupan Olak, Managing Director, Pi Ventures. Congratulations to all of you. I think I will hand it over now to Shiv Sehgal.
Thanks, Shiv.
Go to the rest of the names.
Perfect. So congrats, Sarika Shah, Head Legal and Compliance for Julius Baer Wealth Advisors India Private Limited. Mr. Sharad Pashisha, Chief Executive Officer, Sage One Investment Advisors. Congrats, Sharad. Mr. Siddharth Pai, Founding Partner and CFO, 3on4 Capital Advisors LLP. And Suraj Malik, Partner, BDO India LLP. Congrats, Suraj. And Aditya, over to you for the last four.
Sure. So Swati Bhartiya, Vice President at Tata Capital Healthcare Fund. Congratulations, Swati. Next is Tapan Bhatt, Managing Partner, Toro Finserv LLP. Congratulations, Tapan. Vijay Dhanuka, Principal and Executive Vice President at Motilal Oswal Private Equity. Congratulations, Vijay. And last but not least, Vivek Sharma, Partner at Cyril Amarchand Mangaldas. Congratulations, Vivek. So guys, thank you so much for joining in. And I will now quickly request all winners to, put on their videos. Happy to, please come share your excitement, your reactions. Happy to do that. As I said earlier, we would have loved to see it in person, but we have to do with this virtual platform right now. So happy to hear your views, happy to hear your exciting responses, and happy to see you all in person. So if you could just put on your videos, we can quickly hear from each one of you, and before we wind up the session. So who's going first? And there's no particular order, so feel free to speak.
Good evening, everyone. It's an absolute hi. This is Archana here, Archana Khosla Burman. I'm the partner of Vertices Partners. Thank you so much to all of you. It is an absolute pleasure, in fact, to be here today. And I would like to extend a warm note of thanks to the esteemed jury. This makes it all the more reason special because the more we were hearing about the process which was followed and, the way you have looked at each and every detail, I think that is very, very special to me. So it's an honor to be receiving this award. And thank you so much to AIWMI and IAIF team for putting all of this together and for organizing such a wonderful event. Thank you so much. Appreciate it.
Thank you, Archana. Yes.
Shall I start?
Yeah, please.
Yeah. It's an absolute pleasure and really happy to be, receiving this award. Can you hear me, guys?
Yeah, Sharad, we can.
Yeah,
Yeah, we
sure.
can hear you. But could you please introduce yourself?
Sure. So I'm Sharad. I spearhead the organization called Sage One Investment Managers as a CEO. It's a pleasure to receive this award, and I would really like to thank the jury, for recognizing my work and the professional journey so far, and finding me worthy of being part of this coveted club. It means a lot. Certainly, this would not have been possible without opportunities thrown at me by the organizations I worked before. Edelweiss was my, organization where I've worked for 13 years, and now I'm with Sage One. So, my deep gratitude for whatever I've received from these organizations in terms of opportunities. And a special mention to AIWMI platform, Aditya and team, for putting this up together. And I think they have created a very differentiated platform, conceptualize it, and even maintaining this for a good period of time. And it's I think a great forum to promote alternative investment platform and professionals in the country. So thank you guys once again.
Congrats, Sharad. Well deserved.
I can go next. Hi, this is Anjana Seshadri, and I very humbly and affectionately accept this honor. Thank you very much to AIWMI team and the jury to have given me this opportunity. I would also like to state that my fund and the work that I do has really mainstreamed the ESG, social and governance, and
I think we lost her there.
Yeah, so someone else can come in now, and maybe we can
I can go now, actually, with everyone's permission.
Yeah, please.
Hi, I'm Siddharth Pai. I'm the founding partner of 314 Capital. First off, congratulations to all the people on this call for winning this prestigious award. I think it's a fantastic to actually see that the Indian alternative space has so many young champions who will actually keep the entire space riding and going forward. We've done a large amount of work over the past 5 years in terms of unlocking large pools of domestic capital, as well as creating a large broad base of acceptance of Indian alternatives, and to ensure that the inroad to Indian equities is no longer through Mauritius, but it's actually going to be through Mumbai, through Bangalore, through Bombay, as well as all the other cities of India. I would also like to thank all my portfolio companies and their founders. Without them, it would be very hard for any of us to actually have an opportunity to actually win this particular award or to be nominated for that matter. And I think the startups as well as the alternative space in India is really poised to grow as of now. And with all the people on this call and with the blessings of the entire jury for honoring all of us with this particular award, I'm sure the Indian alternatives are actually going to become the mainstream in terms of asset allocation for family offices and Indian institutions going forward. And I look forward to working with all my peers who are also on this call very closely as we start we actually mainstream the alternative space. Thank you so much.
Thank you.
Sure. Hi everyone. This is Rajkumar Rathi here. When I applied for this award, I was with ICICI Securities. When I got this, now I am with Kotak Wealth. I had the equity products there. It's an honor to be shortlisted as top under 40 winner. I thank AIWMI and the entire team for this initiative. I'm also thankful to all the industry colleagues and seniors for their support and guidance. And I wish all the participants and all the winners a great career ahead. And thanks again, the organizing committee, for this wonderful event. Thank you.
If it's okay, then I'll take up from Raj. He is my colleague from Kotak. So I thought I will just continue from his side. Thank you for giving this award. 7-8 years back when I was at a vendors and kind of making a switch from the regular equity debt share classes to alternate. Frankly, I was nervous. I was scared if the investors and the investing community will share the same passion as I did for this space, and very happy to have made that switch and see the way the asset class has evolved, see the way platform such as AIWMI has come up to facilitate to felicitate people in this space from all parts, whether it is distribution, whether it is the investment community, whether it is the legal or tax community. So thankful to all the jury members for appreciating and kind of building this platform to appreciate us. Thank you for this.
Thank
you.
you.
Can take from there. So Aditya, Shiv, Sanjay, and Punita, thank you very much for this recognition. It's not only recognition of the work that the cohort has done, but it's also an added responsibility to keep doing the good work. Quick introduction: I lead strategy and investments for Prosus. It's one of the largest tech investors. Earlier used to be called Naspers, and I have done a fair amount of work before joining Prosus for Niti Aayog, Government of India. Absolutely delighted to be part of this cohort. Looking forward to learning from all of you. Congratulations to everybody. And thank you, AIWMI, for this recognition.
Thank you, Arnab.
Thanks, Arnab. Maybe I can take on from there. Thank you, Aditya. Thank you for pulling off this event in such difficult times. Thank you to all the jury members. My name is Ashish Ahluwalia. I head direct equity investments globally in healthcare, food, and consumer for CDC. Just, a huge thank you to all our portfolio companies. As they say, they do all the hard work. We just move the money around. Thank you for them, these entrepreneurs who are building fantastic businesses in our country. I do a lot of work in healthcare, so a special shout out to all the entrepreneurs and leaders in the healthcare sector, from whom I've not just learned business lessons, but also life lessons from the work that they've been doing through this crisis over the last year. Thank you.
Thanks, Ashish. Congratulations. Yes. Any else?
Hi, Aditya. Hi. If I'm allowed, I can pick it up from here. Hi, everyone. This is Newt-Paul Hendrick. I'm currently working with Nippon India as a product lead. And first of all, thank you, AIWMI, Aditya and team, and all the elite judges who have taken out their valuable time in, shortlisting us. I really feel privileged to be part of this group. So thank you so much. I have been a newcomer to the industry. I joined the AIF industry in 2016. In this short span of time, I have launched approximately 15 funds and have worked on multiple strategies across various asset classes such as equity, real estate, credit, technology, VC, fund of fund. So it has been a wonderful journey, and I would say it's like an addition as to what you can do next and what you can do good, or how much you can contribute to the industry. So I'm really thankful and really fortunate to be part of this industry, and thankful to my leaders and
some connection issue, I believe, with Newt-Paul. Guys, anyone else there would like to quickly?
I'd like to go in next. I'll go in. Sorry.
Yes, sure. Please go ahead.
Okay. Thanks, Tammy. Hi, Aditya. Thanks. I'll come in next. Thanks to the jury, the AIWMI team to pull off this event and recognizing our work. I'm extremely honored to be receiving this award and be recognized here in this forum. Quick introduction about myself. I'm part of investment team of Tata Capital Healthcare Fund. It's an AIF, dedicated healthcare and life sciences private equity fund. So I am responsible for the entire deal cycle, monitoring investments and exits. Would like to thank my team, mentors, and especially the promoters who make us look good, both in resumes and in actual life. And with that, I would just like to conclude. Thanks to everyone.
Congratulations.
Thanks.
Thanks, Swati. Going in next. Hi, I'm Janvi. I'm an investment director at Avishkar Capital and largely focus on agri-food, healthcare, clean energy, and so on. And I'm a cheerleader of impact investing. Firstly, let me share that it's an absolute honor and privilege to be a part of this coveted club. In fact, I've been closely following the awardees since 2018. And I found all of them stellar. So it was hard not to visualize myself winning this award one day. I would like to tribute this to, of course, my family, colleagues, and mentors, and would also like to credit it to all the entrepreneurs, not just the ones I've closely worked with and invested in, but also to those entrepreneurs who grow and thrive without capital support. They are the true risk takers and return generators, and my love and respect for the investment profession would continue to grow thanks to them. Thank you so much, everyone, for this honor. Over to you, Abhilash.
Hi, thanks, Janvi. Congratulations. Hi, everyone. This is Abhilash. I'm part of the investment team at Omnivore. We are an agri-tech-focused venture capital fund. I hope everyone is doing well in these testing times. I feel I humbly accept the recognition here. I feel great to be a part of this group. I'm glad that I'm able to continue the legacy of one of our partners, Rehem Roy, who was part of this group back in 2019, I think. I take this as a great motivation to continue my work in Indian agriculture through the investment route. Thank you.
Hi, I think I can go in now. This is Suraj. I am maybe with all the frontline people here, if I may call them, from the investments and the front side. I'm actually associated with the industry more as a back support. So I come from the tax, regulatory, structuring domain, and I've been active in this space right from the time the regulations came out. Worked with various committees, contributed to a lot of thought leadership material on the tax framework for AIFs and the SEBI regulations as well to an extent. That gives me a great pleasure, and in whatever times we are in, I think an award like this and to be part of a cohort and to get recognized by AIWMI is really a big thing and a really nice feeling. And I congratulate all my cohort members as well. Thank you so much for this recognition to everyone.
I can go next. Sorry, Kailash, go ahead.
Okay, great. Hi, I'm Kailash Nath. I'm part of the investment team as Vice President at Bharat Innovation Fund. We are an early stage deep focused venture capital firm. And I would really like to thank everyone on the call and the esteemed jury members. It's indeed very humbling to be receiving this award amidst this wonderful community of investment professionals and AIWMI. I still remember looking through the list of awardees from the previous years, right, and then finding some of my role models and people who I really look up to in the industry. And as we live through this testing times, I really would like to thank everyone who's been a part of my journey. So starting from my parents, my wife, our 4-month-old daughter, my teachers, mentors, colleagues in the industry. Very importantly, the entrepreneurs who have been constant source of inspiration and learning. And most importantly, in fact, the investors who have backed us, the risk capital. A big thank you to all of you. I consider myself extremely fortunate to be part of this investment ecosystem, frankly, and I firmly believe that the best years of Indian VC are ahead of us. So I would like to also take this opportunity to congratulate my fellow top under 40 winners, and I wish them the best in their careers ahead, onward and upward. Thank you.
Hi, thanks, Kailash. Congratulations, everyone who won this award today. Thanks a lot to jury member AIWMI and IIAF for giving the opportunity to win this award. Really appreciate this. I'm part of investment banking team at Unitas Capital, boutique investment bank focused on impact investment banking. And actually, it's my dream to make it as a mainstream activity, be it on the investor side or be it investment banker or the corporate. So ESG and the impact has to come first before anything else. So that's my dream, and I want to continue in this journey. Thanks a lot for giving this opportunity to get this award as well.
I think Hi everyone, this is Ami Sampath here. I would just want to begin with thanking the jury members. I really feel honored for this award, and even Aditya and the platform that is there. Just a brief introduction. I head the wealth partnerships and the structured credit team at Derivim Tradition. I started this particular team and it's been a long journey from there. But yeah, thank you very much for the recognition. Thank you everyone.
Congratulations, Ami. So guys, anyone left right now?
Yeah, hi.
This is Sarika here, Sarika Shah. I head the legal and compliance of Julius Baer Wealth Advisors. I'm really thankful to the jury members and Aditya and team, of course, for and especially recognizing the legal and compliance field. I really like that generally the awards are always on the front side, and as one of the participants mentioned that we are the support system, and I always feel we are the backbone to the industry. So thank you for recognizing that and giving us this honor. Thank you so much.
Congratulations, Sarika. So do we have any other winners left? Of course, I believe there are few who couldn't join in today, but anyone else here yet to speak? Okay, I think so guys, I believe we're done with everyone. So quickly, like to thank my jury members again, and as well as Edelweiss team, without whom this entire campaign wouldn't have been possible. The winners award is of course one part, but what is waiting for you is that very exciting small little world we have created on WhatsApp for all the winners of the last few years. So we are going to add all of you today there. And last year when we had our third edition in January, we already had 120 winners, and we thought now we should plan some kind of an offsite with all winners, maybe hopefully with their spouses and all. And COVID happened. So as luck would have it, probably we all were waiting for the fourth edition guys to join in before we could plan something like this. So glad to have all of you on board. Our team will be adding you all to the WhatsApp group soon, where all your 120 seniors are waiting to kind of meet you and get to know you better. So it's a very exciting, enriching knowledge exchange platform, that small little group that we have, and we keep doing. There's a lot of collaboration and exchange of thoughts and knowledge that keeps happening. So I'm hoping that all of you will only make it better, and all of us together will be able to contribute significantly to the alternative investment ecosystem in the country. So on that note, jury members, if you have any parting words, please share, or we all can wind up and get back to some celebrations.
Just a hearty congratulations to everybody once again, and all the best for what I'm sure are very exciting careers that you guys have ahead of you. Like someone said, there's a lot more to come ahead, and I'm sure you will have make a lot of exciting contributions in the future. So really well done, and all the best.
Congratulations to all the winners, and I'm sure this honor and recognition will take you places in your career, and I wish all the best. Good luck.
Congratulations to everybody. And Aditya, I would think that we missed an in-person award ceremony. So once COVID is over, I would like to meet all the winners in person.
For sure.
I think it's important that we actually meet them and talk to them and get to know a little bit more about them.
Absolutely.
I would second that.
Absolutely.
So guys, your trophies will reach you as soon as the courier services are open and things are been slightly back to normal. The 40 top under 40 report and the winner banners, everything will be sent to you tomorrow. So please feel free to share it on your social media handles or on any other platforms that you wish. Well, that's about it for tonight. So thank you all, and take care, stay safe, and look forward to seeing you.
Perfect. Thanks, Aditya. Thanks, everyone.
Thank you, everyone.
Bye, everybody.